This chapter on internal reconstruction is only based on logics. There is nothing, extraordinary in this chapter. There is nothing that you need to remember in this chapter. It is purely based on logic. Right now, what is the logic? Typically, what happens is in a question which is based on your what do you call it? Internal reconstruction, you will be given balance sheet of a company with some assets, with some liabilities, some equity component, and generally losses. Okay. A company which is suffering losses, which has made losses, right? So generally, this is the category of balance sheet that will be given. And the question of reconstruction basically means we are reconstructing. See, construction is fresh construction. We are building a company of fresh. When we say reconstruction, it is basically our house has become old. There are some problems in the house. There are some seepage issues. There are some other issues. So what do? We try to do some kind of reconstruction activity. We try to break down something, add new things. That is what is called reconstruction. Of course, this has to be approved by the court of law. It has to be agreed upon by the creditors, by the shareholders. All of that is the legal part. Okay. Now, in our examination, we are bothered about what do we do with this balance sheet which has to be reconstructed. Okay. Now, typically, when you see reconstruction of a balance sheet and when there are losses in the company, what generally tends to happen is if the company is continuously incurring losses, it will not be able to continue for a long period of time. So if the company is not able to continue, the liability holders, that is your loans who have given you loans, your creditors and all of these, they will not be able to recover the money. They will not be able to recover the money. So what do? Is they come and they agree for some sort of a compromise or arrangement. So basically what they'll say is, okay, let's say for example, loans outstanding is 1,000. The company says, I don't have money to pay 1,000. If you keep on asking me money, if you keep on asking me repayment of loan, I will not be able to repay. I'll close my business. I will file for bankruptcy and I'll say, I don't have money. Do whatever you have to do. Now, this is not the right thing both for the lenders and also for the company. See, someone who has given the company a loan, they want to recover some amount. If they keep on saying, pay me now, company may not be able to pay, so these people will lose out. Same way, equity holders will also lose out, and the company will not be able to continue. Right? So, in the arrangement, what happens is these liability holders they come up and they say, okay, we'll forgive some part of the loan. We will give you some more time to repay the loan. Convert our loan into equity shares. Do something so that our interests are also protected, and you have some breathing space. You have some time to continue the business. You have some time to reorganize the business. Subsequently, when you make profit, you will be beneficial. For example, instead of loan, the person may say, okay, I will forgive 250 of loan. This is forgiven. I forgive 250 of loan. Means don't pay 250 of loans to me out of 1,000. Then, out of the remaining 750, give me equity shares of 250 and balance 500 will continue as loan. All past interest, whatever is there, I don't want. Now, in these kind of arrangement, what is happening is the creditor or the lenders, they are bearing some loss. They are also taking some equity so that in future, when the company does really good, they can make profit and some part of it continues as loan. Okay. Now, think of a scenario. If these liability holders, the lenders and the creditors, if they are giving up something, they will also want the owners, the equity shareholders, the preference shareholders to give up something. So each party who has to receive some money from the business, they will give up something. They will give up something, right? And then after the arrangement, what happens is then they will continue. The business will continue in the hope that in the future we will make some profit and we will be able to repay this, right? That is on the liability side. On the asset side, what happens is there would be some assets which do not have the value that is shown in the books. So we will bring down to their realizable value. Then there are some assets which the company may not need, which are not core assets for the business. For example, let us say we talk about something like a investment. The company is already into so much of losses, so much of problem. So the company says, okay, I don't need this investment. Let me sell off this investment. I will get some money. With that money, I can maybe settle some liabilities, or I can use that money for my subsequent working capital purpose. Okay, this is the whole scenario where a reconstruction happens. That is the first part. Now, how do we account for it? That is what is more important, right? They have given us balance sheet. In the balance sheet, we have assets, we have liabilities, we have equity, we have losses. How do we account for it? What is the accounting treatment to be done? Now, the only rule that you need to remember is, if there is a gain because of an adjustment, I'll open one account called capital reduction account. If there is any gain means either my assets have gone up or my liabilities have come down. Either my assets have gone up or my liabilities have come down. Assets going up means what? Debit assets. Liabilities going down means what? Debit liabilities. So either there is an increase in asset or there is a decrease in liability. Whenever this scenario arises, if my asset value increases, I gain. If my liability value decreases, I gain. So I will credit capital reduction account. So any increase in asset, increase in asset, or by liability decrease in asset, we will prepare an account called capital reduction account. This similar to what you do as a revaluation account in partnership. You would have done, all of you would have done, right? Revaluation account, same thing what we are doing here. Okay, nothing new. Then, if there is a decrease in asset, if there is a decrease in asset, or if there is an increase in liability, that is a loss. So all my losses will come here, all my gains will come. Same way, equity generally will be loss only, gain only, because equity holders have to sacrifice something. So if there is any gain means what? Equity value we have reduced. So here you will say by equity, this is a reduction in value of equity. That results in gain. Then there may be some fictitious assets which may no longer be required. We have to write off. It's a loss. So to fictitious asset, not fixed asset, fictitious asset, it is a reduction. Okay. What to do with losses and all will come based on each type of question we'll handle. But generally the scenario under capital reduction account is, any gain I will credit, any loss I will debit. Now in the examination, the question requires you to pass journal entry. That is what is the question. When they ask you to pass journal entry, typically you also need to prepare cash book or bank book and capital reduction account. These two ledgers you have to prepare generally. Even if the question doesn't ask, in your interest, you have to prepare these ledgers. Alright, so we will prepare capital reduction and we will prepare cash and bank book. Now, a lot of you generally face this problem of, while passing journal entries, we may tend to forget whether to debit, whether to credit, whether to increase, whether to decrease. It can be a confusion. So for that, what you can do is, on a safer side, you can start looking at capital reduction account for practice purpose. Start posting in capital reduction account first and then pass the journal entry. That will help you. For example, increase in value of asset. You will say by fixed asset. When you post it here, what is the journal entry? Fixed asset to capital reduction. So that way you can do. Okay. Now, some of you have this doubt. So do we pass combined entry, single entry? Depending on your comfort. Okay. All assets revaluation, you can pass a single entry. All liabilities revaluation, you can pass a single entry. Then we will see special cases like asset is taken over, liabilities are taken over, something like that. There we have to pass and one by one. Okay. So far, do you have any question in all of these discussions that we had? Any question, any doubt? Please let me know. Otherwise, we will continue to the next part. Okay. Now, the next thing that comes is for equity. Now, as far as equity is concerned, typically what happens is, generally most of the questions, one, there is a reduction in face value. For example, original face value is 10, new face value is 2. Number doesn't change. Face value changes. What does that mean? Earlier, the company said we had to pay 10. Of course, only when you have money you will pay 10 to the equity holders. Now we are saying we will pay only 2. So, equity has reduced. By what amount? By 8. This 8 becomes my gain. So, what will I do is, I will say equity face value 10, debit 10, to equity face value 2, credit 2, to capital reduction. This is my gain. Sometimes the question doesn't talk about reduction in face value, the question talks about split. Now when there is a split in shares, there the total value does not change, only the number of shares changes. So in case of split account, splitting, it is only equity face value 10, debit 10, to equity face value 2, 10. So here it is 1 share of 10 rupee, which has become now 5 share of 2 rupee. Here there is no gain or loss. This generally doesn't happen. Most of the time this is the scenario that you will see in the examination, right? Then the balance that is left over in capital reduction account, this is a gain. This gain will be used to write off assets as given in the question. All fictitious assets must be written off, but other assets, only if the question asks, then only you have to write off. Then you will use it to write off losses. If any balance left, balance will be transferred to capital reserve. Balance will be transferred to capital reserve. Then you will be required to prepare sometimes balance sheet after reconstruction. There what you have to do is assets plus or minus based on this capital reduction account. Same way, liabilities plus or minus, equity plus or minus, losses, whatever was there, there will not be plus, of course, there will be minus, capital reserve if at all there is a balance. Okay, this is how the flow works. Now, the best way to do this chapter is to take up questions, and we'll take up examination questions to see what are the things we should keep in mind and where are the mistakes that students normally do. That is the first thing. And second thing is how to read the adjustment. See, this question is all about understanding the English in the adjustment. If you are able to do that, most of the problem in this chapter is absolutely solved. Okay, so let us go to the questions. 14 marks question in May 24. Following is the summarized balance sheet of Z Limited on 31st March of 24. You have share capital, equity shares of 100 each. Now here numbers are very important because they will say 100 became 50, 100 became 20. You have to read carefully. 8% preference shares of 100 each and 10% debentures of 100 each. So you have equity, preference, debentures. Trade payables, so much. So very carefully you have to read the balance. Amount you can leave it, but these balances you have to read very, very carefully. Goodwill, 81,000. Property, plant and equipment, 72. Trade receivables, 1375. Inventories, 980. Cash at bank, 133. Own debentures, nominal value of 6 lakh, 576. Own debentures means you have purchased your own debentures, which is there in the balance sheet. Profit and loss account, 1235. This is a debit balance. Okay, so these are the numbers. Now, on 1st April, court approved the following reconstruction scheme for Z Limited. This balance sheet as on 31st of March. On 1st of April, the court has approved. Okay. What is the approval? Equity shares shall be subdivided into 10 equity shares of rupees 10 each, fully paid up. After subdivision, equity share capital will be reduced by 40%. So now, the key to solve this is to understand each adjustment properly and pass the necessary entries simultaneously. Okay, simultaneously you have to pass the entries. Only then you will be able to solve these questions on time and you will not miss out on anything. Okay. What does first thing say? Each equity share shall be subdivided into 10 shares of 10 each. What do we have currently? 1 share of 100 each will now become 10 share of 10 each. Is there any gain or loss? There is no gain or loss. So in the first entry, when we are subdividing equity shares, there is no gain or loss. So simply what you will do, you will say equity share capital old face value rupees 100, debit 60 lakhs. Where do I get this 60 lakhs? This full value. Then 2 equity share capital rupees 10, 60 lakhs. 100 became 10, total value did not change. Total value did not change. This is called splitting of share. First thing you have to keep in mind. Okay. Then after subdivision, equity share capital will be reduced by 40%. Now here the problem is, or confusion is, to by 40% means if it was 100, I will reduce by 40%, I'll bring it down to 60. If it is 240%, it was 100, I am bringing it down to 40. Difference is there. Okay, so here we are saying by 40% means what? 60 lakhs whatever is there, of this 40% is as if we are cancelling them out, or as if we are writing them off. If I am reducing equity, tell me whether it will be gain or a loss. It will be a gain, right? So how much gain? 60 into 40%, 24 lakhs. 60 lakhs into 40%. Equity share capital account debit rupees 10. So this is important here. Rupees 10 it has become to capital reduction account 24 lakhs. Sir, we get confused when we pass journal entries. You can prepare the capital reduction account and write here by equity share capital 24 lakhs. By equity share capital 24 lakhs. Okay, then when you prepare the balance sheet, what will happen? From this 60 lakhs, you have to do minus 24 lakhs because 24 lakhs has been written. Preference shares dividends are in arrear for last 4 years. Preference shareholders agreed to waive 75% of the dividend and accept payment for the balance. What are they saying? How much it is outstanding? There it is outstanding for 4 years. What is the rate of dividend? 8%. Okay. So what do you have to do? Now for this, you can prepare a working note because that will help you calculate easily. Or while passing the journal entry itself, you can show the note. Okay. What is the amount? 8%. Preference shares of 100 each, 21 lakhs. So dividend is equal to 21 lakhs into 8% into how much? 4 years. 4 years it is outstanding. What have they said? They have said that 75% of the dividend claim they have waived off. Okay. Now, first thing, is this dividend recorded somewhere here in the balance sheet? It is not recorded. It is not recorded. If it is not recorded, then whatever has been given up or whatever has been foregone, whatever is the gain is irrelevant for us. Because the dividend payable liability is not recorded. A liability which is not recorded, even if somebody says I don't want that money, it does not impact my balance sheet. Okay, so first thing is the 75%, because it is not recorded, I don't need to worry about it. What do I need to worry about is balance payment they have accepted for 25%. Payment means what? Have they given up? No. They want money. How much? 25%. So into 25% if I do, this becomes 25% into 4, again becomes 100. And 21 lakhs into 8%. So 21, 1, 2, 3, 1, 2 into 8%. 1,68,000. 1,68,000 into 25 into 4 if I do is 100. So 1,68,000 is what I need to pay. Now is this liability recorded? No. If liability was recorded, I would have said dividend payable to bank. But now dividend payable is not there. The liability is not there, but I still have to pay. If I'm paying, money is going out and it is a kind of a loss for me because I'm paying extra which is not recorded. So 1,68,000 becomes my loss, which will be debited to capital reduction account. So capital reduction account to bank account 168. Simultaneously post here to bank, you can write in the brackets dividend 160. Okay. Are we clear how to break down? Can we pass combined entry for first two? You should not, because the question has said first we have split and then we have reduced. It is not split and reduction together. First split, then reduce. So pass two separate entries. By saving one line, you will not save you will not save much of time. So better to do it separately. Then own debentures of rupees 2,40,000 nominal value were sold at 98 cum interest and remaining own debentures were so own debentures of rupees 2,40,000 nominal value. How much is the total nominal value? 6 lakhs, right? So what happens is, the way it works is, or I'll show a separate working note that will be easy. 2,40,000 nominal value. What is the total nominal value? 6 lakhs. For 6 lakhs nominal value, cost is 576. I need to know what is the cost for 2,40,000. How much? I can do a simple cross multiplication. That is 2,40,000 into 576 divided by 600. What will this give me? This will give me cost of own debentures which has been sold. So, how much is that? 2,40,000 multiplied by 576 divided by 6 lakhs, 230,400. 2,30,400 is the own debenture which is sold. The cost which is sold. Sold for how much? Was sold at 98. Sold at 98 means 98% of 2,40,000. So 98% of 2,40,000 if I do, it comes to 235,200. 235,200. Sir, what about this cum interest? See, balance sheet we have prepared as on 31st of March. Okay, as on 31st March, debenture interest would have been paid. On 1st of April, we are selling. There is no information of what is the interest accrued and all of that. So, ignore this part. Simply take 98 to 2,40,000. You get 235,200. What is the cost? 230. Sale value 235. When I sell an investment, I will say bank debit to own debenture. To own debenture to profit. Profit will go to capital reduction. Okay. Come interest, X interest, some more discussion we'll have when we do accounting standard 30, no need to worry about that. So what is the gain? 4,800. This is recorded. Now in capital reduction account, how will the entry be passed? You will just take this capital reduction. You can say by bank 4,800. By bank profit on sale 4,800. Okay. Then debenture holders of rupees 6 lakhs agreed to accept one machinery of book value 9 lakhs in full settlement. What does that mean? Out of whatever machinery we have 72 lakhs worth of machinery. Debenture holder says, you give me 9 lakhs of machinery and whatever is the debenture out of this 18 lakhs, 6 lakhs, we will say we don't want it. We have 6 lakhs of debentures that you need to pay us. Give us machinery of 9 lakhs and we will go away. Now what is happening? Liability we are reducing by 6 lakhs. Asset we have to reduce by 9 lakhs. It is like I have to pay somebody 6 lakhs. I am paying that person 9 lakhs. Means what? I am paying extra. Maybe the book value, the realizable value of this may be lower. But 6 lakhs of liability I am settling by paying 9 lakhs of asset. So asset has gone down by 9 lakhs. So what you will do? You will say, when asset goes down by 9 lakh, you will say to asset or you will credit 9 lakh. Here you will debit only 6 lakh. Debenture liability will debit only 6 lakh. Where will I debit the balance 3 lakhs? The balance 3 lakhs will be debited to your capital reduction, which is a loss. So the way it works is 10% debentures 6 lakhs, the liability reduction. Machinery or PPE 9 lakhs, that is what I have transferred. 3 lakhs is the loss. So when you are preparing the balance sheet, 6 lakhs will go off from your 10% debentures account and machinery or PPE 9 lakhs will reduce. Balance 3 lakhs will be to the capital reduction. In capital reduction, you will write to PPE 3 lakhs. Now you may have a doubt, sir, how do we know whether we need to write 2 or what? See, capital reduction is debit. Debit is 3 lakhs. 2 or 2 machinery or PPE. Are you clear how to pass this breakup entries? Yes? Okay. Remaining property, plant and equipment were valued at 60 lakhs. Means what? We have 72 lakhs. Out of 72, I gave 9 lakhs to someone. How much am I left with? I am left with 61 lakhs. Not 61 lakhs, sorry. 63 lakhs. This 63 lakhs, they are saying that you have to value it at 60. You have to bring down the value by how much? 3 lakhs. So 3 lakhs you have to reduce. Capital reduction account, to property, plant and equipment, 3 lakhs, 3 lakhs. Right? Then Trade payable, trade receivable, inventories were valued at 15 lakhs, 13 lakhs, 9 lakh 44 respectively. Goodwill and profit and loss account are to be written off. So, first, trade payable, trade receivable, inventories were valued at 15, 13 and 944. Trade payables, they are saying 15 lakhs. How much do we have? 16 lakh 80,000. Means, what is the reduction? 1680 to 15 lakhs, 1 lakh 80,000 is the reduction. Means I have to debit trade payable by 1 lakh 80,000. Okay, so what will I do? I will debit trade payable by 1 lakh 80,000. Then trade receivable is now at 13 lakhs. How much do we have in trade receivable account? Trade receivable, we have 1375. Now they are saying trade receivable, you bring it down to 13. Means what? I have to reduce by 75,000. If I have to reduce by 75,000, I should debit or credit? I should credit the trade receivable. So, to trade receivable, 75,000. Same way to inventory, 36,000. And whatever is the difference, I am taking up to capital reduction account. That is, reduction in trade payable and reduction in other assets. Balance goes to capital reduction. Okay. Then they have said, goodwill and P&L debit balance are to be written off. What is the goodwill value? Goodwill value is 81,000. You have to write off. So debit capital reduction, credit goodwill, and P&L debit balance 1235 has to be written off. So goodwill 81,000, P&L 1235, capital reduction. If the question does not say write off goodwill, you will not write off goodwill. But debit balance in P&L, to the extent balance is available in capital reduction account, you will write off. So this goes to debit of capital reduction account, right? Then company paid 60,000 as penalty to avoid capital commitments of 12 lakhs. So they had some commitment, they had to pay some amount, penalty of 60. This you will debit capital reduction, which is a loss or penalty, to bank 60,000. So they have said interest on 10% debenture is paid every year on 31st March. We didn't see this information. Of course, in examination, we will see the full question first and then only come to the solution, right? So here, if some other date was given, that interest accrual would have made sense. 60,000 is loss. So that loss is 60,000 to bank. Okay. Now, all these entries, make sure you pass it to capital reduction and bank account simultaneously. For example, here capital reduction, this entry is done. This entry you have to pass. Bank account also prepare, because that will help you to calculate closing bank balance easily. You are required to pass journal entries, capital reduction and bank. The question has said capital reduction and bank. That's why we have passed it. If balance sheet is required, definitely capital reduction and bank is also required. So wherever bank is there, ensure you have posted it simultaneously. Bank to own debentures. This I'll come to it subsequently. Then debentures, debit to debentures, capital reduction debit. Wherever you see capital reduction, ensure you have passed the corresponding entries. Okay. So this is all what has happened. Now come to the balance sheet. Is there something left? Share capital done, equity share capital done, 8% done, this is done, goodwill, PP is done, trade receivable, inventory is done, cash, we have prepared account, own debentures nominal value of 6 lakh. Now here, own debentures nominal value of 6 lakh, even if nothing is mentioned, we generally assume that they will cancel out their own debentures. Now what they have done, they have sold this amount, 240 into 576 by 600, that part is sold. What is sold? The cost of debentures that is sold is 230,400. What is the total cost? Total cost is 576. So if I do 576,000 minus 230,400, if I do the subtraction, so this is 600, 5, 7 minus 3, 4, 3. 345,600, this is the cost of debentures which is left out. This is the cost of debentures which is left out. This I will cancel. So if I have to cancel the debentures, I will credit own debentures. To own debentures 345,600. Then 10% debentures account at face value. How much is the face value? Out of 6 lakhs, 240 is sold. So 360 is the face value, and the gain is 14,400. So this is how I will cancel the own debentures. Okay. Then once you prepare the capital reduction account, whatever is the balance left over after passing all these entries, that will be transferred to capital reserve. If nothing is left over, the account will close on its own, otherwise this will be transferred to capital reserve. Right? Now, if balance sheet was asked, how to handle? If balance sheet was asked in the same question, how to handle? If balance sheet was asked in share capital, we know there is a 40% reduction, so you will show it at the reduced value. Then preference shares, nothing has happened. Only the dividend has been given up. Preference shares will continue as it is. Debentures, out of these 18 lakhs, what did we do? There were debentures of 6 lakhs which we had bought back. Out of that, we cancelled, I think, worth 360. So, 18 lakhs minus 6 lakhs we settled by giving machinery minus 360, that is debited. How to know? If at all you get confused, in the journal you can see 10% debentures 360 here and 10% debentures 6 lakhs here. So 360 and 6 lakhs is what we have to reduce. Okay. Then trade payables, there is a reduction. Goodwill we have written off fully. Property, plant and equipment here minus 9 lakhs which has been transferred and minus 3 lakhs which has been written off. Then trade receivable value is known, inventories value is known, cash at bank will come from cash account. Own debentures is no longer there, P&L debit balance also no longer there. Your balance sheet will automatically. Right? Almost all the questions are based on this structure only. There is nothing new which will be asked in the examination. Okay. In this specific question, is there any doubt, or after having seen this question the way we have solved, do you think you still have some more confusions in this capital reduction chapter? Can you please let me know, yes or no, in the chat box? And some of you may have this doubt as a narration is required. Definitely required. If you don't write narration, about 2 marks you are losing. No need to write long narration, just write some simple one, being in assets and liabilities revalued, something like that. Okay, so that is 2 marks for narration. Capital reduction account, so how they'll mark is, I'll just give you the breakup of this mark. So there are about 11 journal entries. Okay, about 10 marks here, about 3 marks here, and about 1 mark. That is what will be tested. So now tell me, even if you misunderstand one particular adjustment, at least remaining journal entries you can write, you will score marks there. This also, out of 3 you will be able to score 2, and this may be 1. So very, very high scoring chapter, I would say. Okay, that's what you have to do. So if in own debentures sold come interest, if accrued interest is there, how do we treat it? So what happens is, if you sell it along with interest, so if for example it was sold at 98, assume 1 is interest component. Okay, 1 is interest component. So the amount that you will receive from the other party as one amount that you have received as interest, that will go off and knock off the interest component that was payable, right? But at your level, such complexities will not be tested. That complexity will not be tested. This one that you will receive, so you will receive basically in bank, you receive 98, your own debentures will be 97. To interest payable, you will add one more to the interest payable. Because it was your own debenture, you would not have added interest. Now that goes and gets added to the interest accrued portion. Okay. Now, here, next question. Earlier it used to be 20 marks, now it will be 14 marks only. So here you have share capital, reserves, long-term borrowings, trade payables, short-term borrowings, other current liabilities, short-term provisions, PPE, intangible asset, non-current investment, current assets, inventory, trade receivable, cash and cash equivalents. Breakup is given, share capital, debit balance of profit and loss account 9.10. This has to be written off. 3200 10% debentures. Interest payable on debentures is given separately. Provision for taxation, land and machinery, furniture and fixture, patents and copyrights, investment, market value 1,10,000. This is 1. Okay, now let's see the adjustment. Each equity share is to be subdivided into 10 fully paid equity shares of 10 each. After subdivision, each shareholder shall surrender to the company 40% of his holding for the purpose of reissue to trade payables as necessary. Now here there is a share surrender. There is a share surrender. Now what is share surrender? Basically equity share capital. So first we will do equity share capital 100 to equity share capital 10. Do it this way only. Don't try to combine the entries. You will get confused. Then equity share capital 100, that is what is 16. Share surrender account 6.4. So what is this share surrender account? Please note here we have not used capital reduction account because I am not cancelling the shares. I will hold these shares for subsequent issue to some other party. So we are not cancelling out the shares. So you will not use capital reduction. You will use share surrender. To equity share capital 9.6. Okay, so this is the reduction entry or surrender entry. Preference shareholders would give up 30% of their capital and 12% debentures shall be issued to them for the balance holdings. What does this mean? Here, preference shareholders would give up 30% of their capital. What is their capital? 8. 30% give up means 8 into 30%, 2.4 given up. Given up means reduced. Given up means reduced. And 12% debentures shall be issued to them for the balance holdings. So, entire 8 is gone. Entire 8 is gone. In place of that, what is happening is 2.4 is cancelled and 5.6 I will issue 12% debentures. So, preference share capital fully gone to capital reduction account, or you can say reconstruction account also. This is 100, 2.4 and 12% debentures 100, 5.6. This is a new liability. This is a new liability. When you prepare the balance sheet, you will add it to the right. Then the company would issue additional 12% debentures for rupees 4 lakhs for the purpose of meeting working capital requirement and final settlement of bank overdraft at 90% of the amount. Now there are two things. One, what they're saying we will issue for 4 lakhs for meeting its working capital requirement and final settlement of bank overdraft at 90%. What is bank overdraft value? Bank overdraft is 1.4. What they're saying is that 1.4 we will settle at 90%. So when we settle at 90%, we will pay only 14 into 9, that is 1.26. Only 1.26 will be paid. Only 90% will be paid. Balance 0.14 is a gain. 0.14 is a gain. And what is the value of debentures issued? 4 lakhs. So first bank account to 12% debentures 4 lakhs. This is the issue. Okay. Then bank overdraft 1.4 fully cancelled. So we will debit the bank overdraft account to bank paid 1.26 to capital reduction account 0.4. So what happens is, what you need to do is, each adjustment you have to carefully break down what are they trying to say. Now some of you may have a doubt. Sir, can we say 4 lakhs for working capital and more amount for final settlement? No. They have directly said issued for 4 lakhs. So don't make extra assumptions. Alright. Then existing debenture holders would accept furniture and fixtures in full settlement. Existing debenture holders are where? They are at 3.2. 3.2 is going out fully. If 3.2 is going out fully, we will debit 10% debentures 3.2. What are we giving in turn for that? We are giving them furniture. Where is furniture? Furniture. How much? 2.8. Okay. So liability is going down by 3.2. Asset is going down by 2.8. I gave 2.8 worth of asset to settle a 3.2 worth of liability. Is there a gain or a loss? There is a gain. So what I'll do? Liability going down by 3.2. I will say debentures debit 3.2. Debentures debit 3.2. 2. Furniture and fixture. How much? 2.8. Balance is my gain to capital reduction or reconstruction account 0.4. Debentures 3.2. Oh, so see, missed it, no? Interest was also there. Sometimes, we tend to miss. Debenture holders would accept in full settlement of their dues. While reading the question, we saw there is interest payable also 0.32. So 3.2, 0.32. For that we are using 2.8 of settlement. So what you can do, if you don't want to pass this entry, you can directly say 10% debentures, interest payable 3.2, 0.32, 2 furniture and fixture 2.8 because furniture is going out, 2 capital reduction or reconstruction account, the gain 0.72, that is basically 0.4 on principal and 0.32 on interest. This is how you will get past the entry. Or you can say 10% debentures interest payable to debenture holders, then debenture holders to furniture fixtures to reconstruction. All right. So this thing. Now, how to avoid missing these kind or making these kind of mistakes? Once you are done with passing the entries, please run through the entire balance sheet once, so that you get to know if you have missed out something. Trade payables claim shall be reduced to 70%. In the previous case we saw buy, now we are saying to 70%. It is to be settled by issue of equity shares of ₹10 each out of share surrender. So what they are saying is trade payables claim shall be reduced to 70%. How much is trade payable? Trade payable in the balance sheet is 1.15. Okay, this has to be reduced to 70%. Means 1.15 you are settling only 70%. So trade payables 1.15, trade payables 1.15, %. So 70% of that is 1.15 into 70%, 0.805. I'll do it again. 1.15 into 70%, 0.805. Out of 1.15, we have to give, we are settling it at 0.805. Now this 0.805 is being settled using the share surrender account. We are settling this 0.805 by using the share surrender account. Right now, trade payable total balance is 1.15. Trade payable 1.15. We are cancelling out, so we will say trade payable debit 1.15. Then we have to give them shares out of share surrendered account to the extent of how much? To the extent of 0.805. Are we paying any cash to them? Are we paying any cash to them? We are not paying any cash to them. We are only using the share surrender account to issue them equity share capital. We are only using share surrender account to issue them equity share capital. We are not paying any money. We are not incurring any further losses. We took some shares from the equity shareholders account and now we are directly giving them to the trade payables account. So when you are giving it to the trade payable account, what you can say? Trade payable account debit. I cannot say to equity share capital because I am not raising a fresh share. I am not raising a fresh share. So this entire 0.805 whatever is being settled is settled using my existing shares. In other words, can I say my liability towards trade payable has been extinguished? Can I say the entire liability, first 30% is written off and balance 70% is also through shares surrender account. So entire trade payable has been cancelled and I have a gain of 1.15 which I have transferred to the reconstruction account. Right. Now, how do I settle this? What I'll do is, using the share surrender account, I will use 0.805 to bring it back to the equity share capital. So, share surrender to equity share capital account 0.805, this number. Balance, the question, what the question has said, the share surrendered and not reissued shall be cancelled. So, the balance will be cancelled and credited to reconstruction account 5.595. Once again, this is a typical adjustment. We have trade payables of 1.15. This 1.15 I am paying by using shares surrendered. How much? 70%. 30% anyways is cancelled. 30% anyways is cancelled. If it was a fresh share issue, what I would have done? I would have said trade payable 1.15 to equity share capital 0.805 to capital reduction the balance amount. But here I am not issuing fresh shares. I am using share surrender account. Now can I again credit share surrender account? I cannot credit, right? Because I am not getting shares from anywhere. I am not getting shares. I am not getting it back from somewhere else. So I cannot credit here. Basically what I am doing is the share surrender account that is there, I am using that to settle the trade payable. So what would happen? This trade payable fully will go off, and in place of this, equity share capital of 0.805 will come from the share surrender account. So that is why the full value of trade payable is as good as cancelled, because I am not paying. Think of it, if I had issued a debenture, if I had made the payment, if I had agreed to continue the liability, then it would have been a different case. Here, I am not paying anything afresh. I am using the existing share surrender account to settle the liability. So, share surrender account 6.4, equity share capital 0.805 to reconstruction account 5.595. Alright, then the taxation liability is to be settled at 50,000. 50,000, how much is the liability? Liability is 42,000. I had to pay 42. Now I am paying 50. Means I will say to bank 50. But I only have how much? 0.42. Provision for taxation 0.42. To bank 50. I had to pay 8,000 extra. 8,000 is my loss. So capital reduction or reconstruction account 0.08. 0.4 to 0.08 to 0.50. This is 2. You can directly write this as 2 back. Then investment value to be reduced to market price. What is the value? Market price is 110, actual price is 1.8. So 1.8 is the value. I have to bring it down to 1 point, means 0.7 of loss. So debit reconstruction 0.7 to investment 0.7. I am reducing the value of investment 0.7, 0.7. Balance of P&L to be written off. This will do it towards the last. Value of inventories is to be increased by 32. Increase by 32 means asset increase, gain. So inventory, debit, gain. Then provision for doubtful debt is to be created at 5% of trade receivable. This is a new provision created. Do we have any provision in the balance sheet? If you come to trade receivable, they have not given us any information. So trade receivable 4.32 into 5% will create. So 5% of this will be 4.32 into 5% will be 0.216. We have to create a provision. To create a provision means to provision for bad debt. We are creating a liability, or we are reducing the value of the asset. So this will be credited 0.216. Provision for doubtful debt 0.216. Inventory account debited 0.32. Increase in the value of inventory to reconstruction account 0.104. Now sometimes some of you may face that, sir, but to pass combined entries we find it difficult. You can pass separately. Inventory to reconstruction separately, then reconstruction to provision for doubtful debt separately. That is also possible. But if they are given 4 or 5 items together, increase in asset, debit, decrease in liability, debit, decrease in asset, credit, increase in liability, credit, and balancing figure to reconstruction account, that can also be done. Then the profit and loss account balance to be written off 9.1. Whatever is the leftover balance, capital reserve will be transferred to 0.229. So what you can do is, here they have not prepared, but I strongly suggest to prepare capital reduction account, because lot of time while doing totaling in these journal entries, we may miss out. We may make mistakes. After doing so much of effort, if we do a calculation mistake and lose marks, it is not worth it. So it will not take much time. Prepare capital reduction account properly, and bank account you can do because only 2 or 3 entries would be there. Balance you will, you can do it from that. Now, how to handle the balance sheet? Again, share capital, there are changes. So what are the changes? One, there is cancellation of shares, so that is the reduction. Then there are shares which have been issued, okay, so that has to be returned. Reserves and surplus, this 9.1 has been written off, but capital reserve will come. Then long term borrowings, debentures, existing debentures settled, new debentures have come. So like that you can present it. Issued capital, conversion of equity without payment being received in cash. All shares are allotted as fully paid up pursuant to capital reduction scheme. So that you can write a note of that. Then capital reserve, whatever balance we got. Unsecured loan 12%. So we have 2 breakups. Plant and machinery 5. Well, I don't think there is any change in plant and machinery. Plant and machinery 5. Furniture and fixture 2.8 has been taken over, right? So you have to note from that. Then intangible assets, you pay attention, copyright. Don't write off unless the question asks you. Okay. Losses you can write off. This you should not write off. Investments, we have brought it down to the book value. Inventory, appreciation is there. Trade receivable, provision is there. Okay. So with these notes and the balance sheet will be. Any doubt here? Any doubt? Goodwill, the question has said, no? Here there is no goodwill. The breakup, if you see, it is only patents and copyright. Goodwill also, only when it is said, only then you will write off. We cannot assume that goodwill is worthless. Okay, the question will mention specifically. In the previous question, if you see, goodwill and P&L account are to be written off. P&L you will write off because P&L is fictitious. P&L is fictitious, you will write off. Goodwill, patents and all, we believe they have some value. Unless the question mentions, we will not write it off. Any preliminary expenses shown in the debit side, okay, any fictitious asset, what I am saying is, any fictitious asset you will write off. Okay. Otherwise, you have to see the question what they have mentioned. Now, see, almost all the questions will be in the same pattern. So we will see some adjustments, a couple of more adjustments, so that we have more clarity. Okay. Here, preference shares are converted from 6% to 8%, but revalued in a manner in which the total return of them remains unaffected. Now, what does that mean? Here, if you see, you have 6% shares of 6 lakhs. 6% share of 6 lakhs. What they're saying is, from 6%, we'll make it 8%, so that the total return remains unaffected. Means, on 6 lakhs, how much is the return into 6%? That is, the return is 36,000. Return is 30. Now, what they're saying is, this 36,000, they should earn 36,000, but at 8%. How much should they get? They should get 36,000 divided by 8%, that is 4,50,000. Or what you can say, or what you can do in case you are confused, what you can do is, you can say return, 36,000 return is needed and we need 8%. So 8% of preference share capital should be equal to 36,000. If 8% of preference share capital is 36,000, preference share capital is 36,000 divided by 0.08, which is 4,50,000. So, new preference share capital is 4,50,000, balance amount goes to capital reduction. Okay, then value of equity shares is to be brought down to 8 per share. What is the value? 10. From 10 you will bring down to 8. Arrears of dividend on preference shares are to be cancelled. Is there any arrear given in the balance sheet? They have not given, so there will be no entry for that. Okay, because see, if dividend payable is there in the balance sheet, then we can cancel and then there will be a gain. But if dividend payable is not there in the balance sheet, there is no point in cancellation. Debit balance of goodwill account is written off entirely. So whatever is there in the goodwill, I think 1,20,600 entire value, right? No, sorry, 84,636. Only goodwill has to be written off. Book debts amounting to 14,400 are to be treated as bad and hence written off. Reduction in value of your receivable, hence a loss. Company expects to earn profit at the rate of 90,000 per annum from the current year, which would be utilized entirely for reducing the debit balance in P&L account for 3 years. The remaining balance of the said account would be written off at the time of capital reduction. So they are saying 90,000 for 3 years. Now, what do we have? Balance. Balance is 3 lakhs. Out of this, we will earn 90,000 into 3 for the next 3 years. That is 2,70,000. So balance 30,000 has to be written off. So what we'll do? We'll write off balance 30,000 in the P&L. The balance of total capital reduction is to be utilized to write down the patents. Now here they have said specifically balance left over, you will write down the patents. So for that, you will prepare a capital reduction account, and whatever is the balancing figure, you will not transfer it to capital reserve, but you will use that to write off the patents, which is 24,000. So that is done. Secured loan of 4,80,000 bearing interest at 12% is to be obtained by mortgaging tangible fixed asset for repayment of bank overdraft and for providing additional funds. What does this mean? 480, we will raise new loans and we will use that loan to pay off overdraft. How much is overdraft? 2 lakhs. 2 lakhs. Bank overdraft 2 lakhs has been paid off. Then you can prepare the balance sheet. Now while preparing balance sheet, again line by line, changes in share capital, write it. Reserves in surplus, this will now be 2,70,000. Short-term borrowings has been paid off. Trade pay. Now here actually they have not told that overdraft is short-term borrowing. We have assumed it because there is no other information available. We have assumed that. Okay, same way goodwill is written off fully. Then patents, we have brought it down. So like this, if we do step by step adjustment, we will be able to solve the question. And even if, I'm again telling you once again, even if you leave out one question, you miss out one question, don't worry about that. You will be able to score good marks out of it. Okay, it's a very simple question, 5 marks. That's okay. So this question, the only thing to solve it in the examination is be patient, have a lot of patience. Okay, and because you are patient, you have a lot of patience. What you can do is read the adjustment properly to buy. See, we'll make mistakes only in calculations. They would say 5%, earlier it was 12% debentures, now we're making it 10%, same earnings, what we saw in preference share case. Okay, then they would say, we'll write it down by this asset has been taken over by this person, this liability, that could be one scenario. Investments to be brought to the market value, that could be one scenario. Right. Apart from that, there is no other critical adjustment that you need to do. Practice 2 to 3 questions before the examination. That is more than sufficient. Alright. Now, when we talk about amalgamation, basically the scenario that we are looking at it is from the examination point of view. There is one company, that is A Limited. There is one more company, that is B Limited. Either A Limited purchases B Limited, okay, or A Limited and B Limited, they come together and they form something called as AB Limited. That is the typical way in which it works. Now, why and all of that, that you will be anyways aware of. There is one more scenario that you need to be careful about, especially when you are doing amalgamation as per accounting standard 14 and when you are preparing consolidated financial statement, let us say accounting standard. What is the difference? The difference is there could be a scenario that A Limited acquires 100% of B Limited. A Limited acquires 100% of B Limited and B Limited no longer exists. B Limited no longer exists. In that case, what is happening is A Limited has acquired 100% of B Limited. B Limited is no longer existing. What exists is A Limited. This is typically covered under accounting standard 14 of amalgamation. We can use the term, sir, it is a merger acquisition. Yes, that can be used. Okay, this is what is ACE 14 scenario. But same thing, A Limited acquires 100% of B Limited, but B Limited continues to function and even A Limited continues to function. Then in that scenario, we say A Limited is the holding entity, B Limited is the subsidiary entity, and what we prepare is consolidated financial statement. See, even in consolidated financial statement, we have to calculate goodwill capital reserve. Even in accounting standard 14, we need to calculate goodwill capital reserve. The only difference, and here also we need to combine the balance sheet in present. There also we need to combine the balance sheet in present. So to that extent, these two chapters are very much interlinked. But the distinguishing factor is that when it is AS 14, when you have acquired the other company and the other company no longer exists, that is when we apply AS 14, and A Limited becomes a combined entity, whereas in case of consolidated financial statement, B Limited continues to function independently. B Limited continues to function independently. That is when we take the treatment to accounting standard 21. Right now, in the question, what you have again, you will have A Limited. A Limited has some assets. A Limited has some liabilities. A Limited has equity. We have B Limited. B Limited also has some assets. B Limited has some liability, and B Limited has some equity. So technically what is happening, or typically what is happening, is that our A Limited is acquiring B Limited. So how can they acquire? What are the ways to acquire? One is A Limited can say, shareholders of B Limited, I will pay you cash. I will pay you cash. A Limited says, I will pay cash to shareholders of B Limited. You give up your shares or transfer all the shares. We'll take over your business and we'll continue to run. Or I will give you cash. You give me all these assets and liabilities. All these assets and liabilities, you give it to me. I will give you cash, and we will run the business subsequently in the way we want to. That is one thing. Second thing is, A Limited can say, I will not give you cash. I will give you equity shares of A. So we have equity shareholders of B here. They will get equity shareholders of A. They will get equity share, not shareholders, they will get equity shares of A. So A is saying, I will give you my equity shares. I will give you my equity shares as payment. You transfer all the assets and liabilities to me and we will continue. That is another way to do it. Or we can do a combination of cash and shares. Or A can say, I will give you cash, I will give you shares, I will give you some debentures, I will give you some other asset. Basically, I will make you some kind of payment. What is A saying? A is saying, shareholders of B, I will make you some kind of payment, and please, I will transfer the asset, I will acquire the asset. Okay, so that is what is called acquisition. And this payment that is being done to the equity shareholders, or if there are preference shareholders, basically whatever the buyer pays to owners of B, this is called purchase consideration. This is the most important thing that you need to determine when you have to do a question on amalgamation. How to calculate, what to take care, what not to consider, all of that will come to it. But understand that A Limited is paying something to the owners of B Limited, to the equity shareholders of B Limited, to the preference shareholders of B Limited. That is called purchase consideration. All right. Now, if equity shareholders of B or preference shareholders of B, if we issue debentures to them, this also is a part of purchase consideration. This is 100% a part of purchase consideration. But if there are debentures of B, if there are debenture holders of B, and to settle these debenture holders, we are issuing equity share of A, this is not purchase consideration. So basically what I am trying to say here is, anything that has been given to the owners of the seller company or the selling company or the acquiree or the vendor, whatever name you put it, that is called purchase consideration. So we have buyer, this is also called as acquirer. We have B Limited, which is the seller or the selling company or the vendor company or the acquirer. If less than 100% is acquired, then the treatment comes under accounting standard 21. It does not come here. Accounting standard 14 will come only when you have acquired the entire business. Right now, please keep one more thing in mind, that we said assets are acquired, liabilities are acquired. It is not necessary that all the assets and all the liabilities are acquired. It may be possible that some of these assets are not acquired. Some of the liabilities are not acquired. That is possible, yes. Sir, now what do in the exam? The examination will tell, the examiner will tell you, or the question will tell you, A has acquired this asset, this liability. In that case, only those assets and liability will be considered. If the question does not mention anything, the question says A acquired assets and liabilities of B, and they have not mentioned anything, then we will assume that all the assets and all the liabilities have been acquired. Okay, so that is the overall structure in which the transaction flows. So we said payment, whatever is the payment to equity shareholders and preference shareholders is called purchase consideration. Is called purchase consideration. Okay, now against this purchase consideration, A Limited, the buyer, gets what do they get? They get assets and liabilities. They get assets and liabilities. So you have B Limited and you have A Limited. B Limited has some assets. B Limited has some liabilities. These liabilities, these assets will be transferred to A Limited. Liability to come here. So here you will have assets of A plus assets of B. Liabilities of A plus liabilities of B. Okay. So now which liabilities of A and which assets of which liabilities of B and which assets of B? Only the assets which have been agreed to be taken over. So what will happen is they will transfer the assets and liabilities to the buying company, which is A Limited. So A Limited basically is purchasing assets and liabilities. Purchasing assets and liabilities as a business. As a company, they are purchasing in wholesale. They are not buying one by one. Right? Now, let us say assets which has been taken over has an agreed value. They have agreed that assets are worth 1000, liabilities are worth 200. Assets are worth 1000, liabilities are worth 200. Then we say net assets is equal to 1000 minus 200, which is 800. So A Limited basically gets net assets of 800. Sir, how do we value this number? In the examination, they will tell you whether it has to be taken at book value or whether it has to be taken at agreed value. They will mention clearly. Okay, if agreed value is given, we will assume it is taken over at agreed value. If nothing is mentioned, we can assume that it is taken over at book value. So net assets of 800 has come in the balance sheet of A Limited. So A Limited says plus 1000 of assets plus 200 of plus 1000 of assets plus 200 of liabilities. From where? From B Limited. B Limited has given this asset and liability to A Limited. Now what happens is A Limited has also given something to B Limited or the shareholders of B Limited. What did they give? Assume for a moment they gave 1500 in cash. Just for example, they gave 1500 in cash. To whom? To B Limited. Now when I say to B Limited, it also implies shareholders of B Limited. Okay. 1500 in cash has been given to B Limited. To what? By what? 1000 of asset and 200 of liability. In other words, 800 of net asset. How much did we pay? 1500. When we paid extra, why did we pay extra? That amount paid, purchase consideration is 1500. The extra amount we paid 700. This is because of goodwill. Why goodwill? That's why we pay more, right? When we are paying something more than the value, we are paying it because we feel there is a goodwill.
It's 11:30.
It is goodwill angle. So 700 of goodwill has come. So what we'll say, assets 1000 plus 700 of goodwill has been recognized minus 1500 of cash has been given. So 1000 plus 700 minus 1500, net change in the balance sheet is 200, net change in the liability is also 200. Balance sheet will always tally. That should be the last problem. Okay. Sir, what if cash was not given? Shares were given. Okay. If shares were given, then you would have said plus 1000 of assets plus 700 of goodwill plus 200 of liability plus 1500 of share capital plus securities premium. 1700 tally. Never will be tallying the balance sheet your problem in the examination. It will be the correct treatment of the items that we discuss. Okay. Any questions so far on this? Whatever we have discussed. The framework, is it clear? Oh, perfect. All clear. Now, when it comes to amalgamation, it is covered under Accounting Standard 14, which prescribes us as to how do we account for amalgamation in case one company acquires another company. Basically, it is combination of two companies. Now, it is possible it could be like A acquires B, B no longer exists, or A plus B, they come together and they form AB Limited. Multiple scenarios are possible, but that does not change the way we do the accounting. Right now, as far as Accounting Standard 14 is concerned, they mention or they prescribe two types of method or two types of amalgamation. Two types are, one is amalgamation in the nature of merger, and the second one is amalgamation in the nature of purchase. The underlying difference between merger and purchase is that when there is an amalgamation in the nature of merger, it is simply A plus B, the owners coming together and they are running the business. So A has some owner. Let us say A is the owner of A and B is the owner of B, for example. Okay. When you are saying it is in the nature of merger, A and B, the combined entity, it is combinedly run by A and B as if nothing else has changed, just that they have removed some kind of a wall between themselves. So there are two companies A and B, they are just breaking this wall, they are coming together and running it as a combined entity without any changes. Without any changes means without any significant change. Okay, there may be minor changes here and there, but most of the things will continue as it is. New entity, but the owners will continue, both the owners will continue to run, and there will be no changes in values of the asset, there will be no changes in the value of the liability. Simply one balance sheet, second balance sheet, you are combining, that becomes amalgamation in the nature of merger. And there are some conditions what AS 14 prescribes. Let us have a look at it. First, all the assets and liabilities of the transferor company, this is the selling company, become the assets and liabilities of the transferee company. Transferor, the one who is selling, transferee, the one who is acquiring. All, when I say all the assets and liabilities, without any asset being left out or without any liability being left out, all assets and liabilities must become the assets and liabilities of the transferee company. That is the first condition. Then, shareholders holding not less than 90% of the face value of the equity shares of the transferor company become equity shareholders of the transferee company. So what is the meaning of this? If B has 100 rupees 100 of share capital, at least rupees 90 of share capital should come and join A. They have to hold shares of A. They have to continue to be the shareholders of the combined entity. Remaining 10%, the smaller portion, they can do whatever they want to do, but majority 90% substantial owners should continue to become the shareholders of the transferee company, which means they will continue to become the owners or continue to remain the owners. Then, when we have to fulfill this condition, this also means that cash should not be given. Cash can be given for small components, but generally cash should not be given. The consideration for the amalgamation receivable by the equity shareholders of the transferor is discharged by the transferee company wholly by the issue of equity shares in the transferee company. Cash may be issued for or paid for fractional shares. So, consideration for the amalgamation receivable by the equity shareholders of the transferor, whoever are the shareholders who have agreed, for example 90% have agreed, those equity shareholders who will receive the shares, receive the consideration should be by way of equity shares, wholly by the issue of equity shares in the transferee company. You can pay cash for fractional share. Fractional share means sometimes what happens, they will agree 1 share of A for 3 shares in B. Okay, now I have 100 shares in B. If I have 100 shares in B, I need to get 33.33 shares of A. Now A cannot issue 33.33 shares, right? So this 0.33 share is fractional. This can be settled by way of payment in cash. The business of the transferor company is intended to be carried on after the amalgamation by the transferee company. So business also should continue, and no adjustment is intended to be made in the book values of the assets and liabilities of the transferee company except for ensuring uniform accounting policies. So if I have to summarize, all assets plus liabilities, 90% of shares in face value terms. Consideration will be in equity share capital only. Then business will continue and everything will be recorded at book value except if there are any accounting policies mismatches. Okay, if these all 5 conditions are satisfied, we say it is amalgamation in the nature of merger. We say amalgamation in the nature of merger, 5 conditions. Now in the examination, how do we know whether these conditions are satisfied or not? Best case scenario, the question says it is in the nature of merger. You will simply take this method and do it. Okay. Second is they have not said. Now we have to check. Check all assets transferred. Yes. Shareholders holding not less than 90%. All shareholders have agreed. Okay. They become equity shareholders. Okay. Then consideration receivable by the equity shareholders of the transferor is discharged by equity shares. Okay. This 4th condition is generally not given in the question, that they want to continue the business. So in that case, on the safer side, you can say it is assumed that it is amalgamation in the nature of purchase and you can solve it. Okay. If this condition, 4th one is given, see book value will be given, these 3 will be given. If this also is given, then you can assume it is amalgamation in the nature of purchase. Are we clear? Are we clear on how to distinguish? Now, if any of these conditions are not satisfied, it is not that all conditions is not satisfied. If any of these conditions are not satisfied, then we say it is amalgamation in the nature of purchase. Amalgamation in the nature of purchase. There is a very small, not small, overall process will be the same. There is one specific difference when you follow merger versus purchase method. In merger, we use something called as pooling of interest method. In purchase, we follow the normal business purchase. Okay. Now, purchase consideration we understood. Anyways, let me again explain it to you. Purchase consideration is defined as aggregate of the shares and other securities issued, payment made in the form of cash or other assets by the transferee company to the shareholders of the transferor company. Shares and securities issued. Shares can be equity share capital, preference share capital, securities can be debenture. The securities can be debenture or any other securities. Payment made in the form of cash. I can transfer cash or other asset. I can give other assets also. Okay. But the moment you say other assets and all, the moment you say other securities and all, then it will be in the nature of purchase. By the transferee company, the selling company, to the shareholders of the transferor. The shareholders are both preference shareholder capital and equity share capital. So please keep in mind, if I issue debentures to the equity share capital holders or if I issue debentures to the preference shareholders, then it is purchase consideration. But if I issue equity shares to the debenture holders, that is not purchase consideration. Okay, so that is one thing you have to keep in mind. So what is included? Any sum paid towards equity and preference shareholders. Sorry. What is not included? Any sum paid other than to equity and preference shareholders, that is not included. Okay. This method and all will come to it subsequently before doing the question. Now, having understood this, and we have also understood how to calculate goodwill and capital reserve. In the examination, when you get the question, you may get a question on. So one is the buyer or the transferee. Then you have the seller or the transferor. Okay. Now questions are generally from the buyer point of view, generally, but there is a seller related question also. Here they will ask you to pass journal entries and prepare the balance sheet. Okay. In selling company also, when they ask you, they may ask you to pass journal entries. Then you prepare something called as a realization account and close the books of selling company. Okay, so one is from the buyer's point of view or from the buying company's point of view, what are the journal entries and what are the balance sheet requirement, how to prepare the balance sheet. From the selling company's point of view, journal entry, realization account and closing the books of the selling company. First, let us see what is to be done in case of seller. Okay. Now, as far as seller is concerned, you will be given a balance sheet with some assets, with some liabilities, equity, you can have cash, you can have preference, equity and preference, the treatment is same. Okay. Now, what you have to do is, you prepare something called as realization account. This realization account you have done in case of partnership account, the same logic works. All these assets you transfer to realization account, all the liabilities you transfer to realization account. Sir, do we transfer cash to realization account? Generally no, because whatever balance is there in cash or whatever expenses you have to incur, you may get some money by selling off assets or something like that. Then you prepare a separate account called cash account and you prepare a separate account called equity shareholders account. So for example, if assets are 1000, cash is 200, liabilities are 800 and equity share capital is 400, what you do is in realization you will say by liabilities, all the liabilities 1 by 1 800 to assets 1000, okay. Cash to balance brought down 200 and equity shareholders by equity share capital 4. Okay. Now assume for a moment this business is sold. This business is sold for, let us say 1000 plus 2 1200 plus minus 400 there. It is sold for 500. It is sold for 500. Okay. Now when it is sold for 500, what does the company get? The company gets 500. The company, selling company gets 500, right? Now when the company gets that 500, something is coming in, so you can put here by A Limited. A Limited has to pay us how much? 500. A Limited has to pay us 500. Then 800 plus 500, this is 1300. 1300 minus 1000, there is a profit of 300. This profit will be transferred to equity shareholders account 300. Basically what I am saying is, this business has a book value of 1000 plus 200, 1200 minus 800. Okay. We have assumed cash has been kept separately and we have assumed that it is sold for 500. So cash is not sold. So 1000 minus 800, this is sold for 200 on a net basis, net asset which has been sold. Against that 200, we got how much? We got 500. So 300 is profit. This 300 goes to equity shareholders account by realization account 300. Right? Then, how will A Limited give this? Assume for a moment A Limited pays us cash. A Limited pays us cash. So you have A Limited account. In A Limited, you can say to realization 500 by cash 500. Can they give shares? Yes, they can give shares also. In that case, there will be equity shares of A. You can do that also. 500 is the cash. This A Limited, whatever cash they have given as 500, I'll say to A Limited 500. So now I have 700 of cash. What will I do with this 700? After meeting all the liquidation expenses and all, assume there is nothing for now. This 700 is paid to the equity shareholders. So you'll say by equity share capital or shareholders account 700. Here you will say to cash 700. So if you see, assets account closed, liability closed, cash account closed, equity share capital account closed in this way. Sometimes there may be a situation where preference shareholders are also there. Generally they will not complicate it, but if preference shareholders are there, first you will close preference shareholders account. If there is any gain or loss on account of preference shareholders account, that you will transfer to realization account, and the net gain or loss from the realization account you will transfer to the equity shareholders account. Okay. Now, how to pass the journal entry? Realization account to assets, liabilities to realization account, then A Limited, if whatever is transferred to equity shareholders account. Then if at all there are any cash movements, and how do we close the equity shareholders account? Okay. This is simpler, generally less tested in the examination, because This is similar. If you have done partnership and all properly, this is similar to what you would have learned in the partnership. Right? Now, when it comes to the buyer side, the one who is purchasing, here is where it becomes slightly more tricky, where we have to pay extra attention, extra effort. The moment it comes to the buyer side, what happens is, first, you have to calculate something called as purchase consideration. Purchase consideration. Second, you have to see what is the net assets which are taken over. Then, if purchase consideration is more than net assets, this becomes goodwill. If purchase consideration is less than net asset, this becomes capital reserve. So, what is the meaning of purchase consideration less than net asset? Say net assets are 1000, we are buying it for 800. Means we are making a gain, but it is not a revenue gain. It is a capital gain because it is happening. It has happened at the time of acquisition. So this becomes a capital reserve. This becomes goodwill. Please keep in mind, if you are following pooling method, then goodwill will not appear. If you are following pooling method, goodwill will not appear. Any difference that comes will be adjusted in the reserves. When we take up questions, I will actually tell you how do we handle that in case of reserves. Okay. So once this is done, then the third thing you have to do is, after you have taken the purchase consideration, calculated net assets, you have to prepare combined balance sheet. In combined balance sheet, this is the most simplest step. You will take A, you will take B, you will take assets of A, B total. Then liabilities of A, whatever is there in B total. Whatever that means, this is what is taken over. Whatever you have taken over, you will consider that and you will do the total. Then, if at all there is goodwill, alongside asset, you will also have goodwill. Then you will have equity, A limited, equity plus new issues. Okay. Then, if there is a capital reserve, you will include that. Okay. If there are preference shares issued, existing plus new issue. You will not take the equity and all of B limited. Okay. That is handled separately. Like this, when you prepare the combined balance sheet, this balance sheet will tally. Now, to maximize the score in this question in the examination, again, balance sheet carries about 4 marks, 4 to 5 marks. Okay. Notes to accounts will carry about 4 marks. Calculation of purchase consideration 1 to 2 marks. Goodwill calculation 2 marks. So 4 plus 4, 8, 9, 10, 11, 12. Then some other here and there working note, you will get 2 marks. This will make it 14 marks. Even if your goodwill is wrong, even if your goodwill calculation is wrong, purchase consideration calculation is wrong, by doing this, and if at all, notes are asked in the examination, you will score 6 to 8 marks easily. And if you do it carefully, I have seen students scoring during when I used to check the papers, it used to be a 16 mark or a 20 mark question, 16 out of 16. And you have the ability to score 14 out of 14 in this chapter. There cannot be a doubt that we cannot score 14 out of 14. Yes, you might be scared by looking at the question. My simple advice to you when you are handling these questions in the examination is, unless there is an adjustment which is very tricky and which is breaking your head out, if in case that happens, then you do it towards the end. But attempt this question. Definitely attempt this question. It will be worth attempting. Unless there is a very, very tricky adjustment, not clear adjustment which you are not able to figure out, then do it towards the end. Otherwise, during the mid part of your examination, you do it. 14 marks question, if you are able to spend and finish it in 25 to 30 minutes, nothing like that. Okay. Now, with this background, today we'll pause here. I'm not really, will be energetic to move further. Tomorrow, we'll take up questions thoroughly. At least 3 questions we'll solve thoroughly. Highlighting what all mistakes can happen, where you can go wrong, what you can do to make things right, and how to understand the questions. Especially, a lot of us get confused when it comes to, sir, which method to follow when. Don't worry about this method, though it has been given in the material, it has been given in the notes. Our objective is to understand what is being paid. That is what is needed. Okay. We'll also take how to calculate intrinsic value, how it is exchanged on the basis of intrinsic value. All of those type of questions we'll do it tomorrow and be perfect in this particular chapter. Okay. So we'll see you tomorrow at 10 o'clock and we'll continue. Any specific question you want me to solve in the class, you please, you can message me in the group. I'll take that as well. Now, when it comes to amalgamation, the question what it typically would say is there is one company, there is another company, A Limited, B Limited. Either A acquires B Limited or A and B come together and they form a new company called C Limited. Right? Now, the acquirer, the one who acquires the company or the one who purchases the company, what they will do is they will issue. Now, the company which acquires, let us say A Limited acquires. A Limited has to pay something to the shareholders of B Limited. They can pay shares, they can pay cash and all of that. How will they pay? Okay, now what kind of varieties can you see in the question? First is simple and straightforward. They would say A Limited issues, let us say, 2 shares for every 3 shares of B Limited at rupees 20 per share. Now, what does this mean? This basically means that if there are 3 shares in B Limited, let us say B Limited has 30,000 shares. B Limited has 30,000 shares. For every 3 shares, 2 shares will be issued. So, how do we calculate? Number of shares is equal to 30,000. For every 3, 2 shares. For every 3. So, for every 3 that comes in the denominator, 2 shares comes in the numerator, you have 20,000 shares. Okay. Now, this 20,000 shares, when we calculate the purchase consideration, we should say 20,000 multiplied by what is the value? This value will be given. This value 20 will be given. If that value is not given, there could be one more variety when they say calculated or at intrinsic value, measure at intrinsic value, something like that. But here it is 20. So what we will do, 20,000 into 20, that makes it 4 lakhs. Now this is the purchase consideration. From accounting point of view, what we need to do is this 20 per share, whatever is there, this 20 per share has face value and premium. We have to split between fair value and premium when we do the accounting for it. Okay, this is one standard way. Sometimes they would say, apart from shares, they could say cash of, let us say, 10 lakhs. This is a direct cash payment. That is not a problem. Then we have one thing which says issue of shares based on intrinsic value. Based on what? Intrinsic value. Now here is where a lot of students make mistakes or they get confused. We'll take one question and see how to handle the intrinsic value thing. Now first of all, what is the intrinsic value? When we say intrinsic value, what we do? We have A Limited, we have B Limited. A Limited will take all the assets and liabilities at the market value or the agreed upon value if nothing is given at book value. So let us say assets is 10,000, liability is 6,000. This 4,000 is the net asset. And let us say number of shares is equal to 1,000. So intrinsic value will be the net assets after all the adjustments what we do divided by number of shares, you get 4 per share. So intrinsic value is 4 per share. Same thing you will calculate for B Limited. Let us say assets we have 5,000. Liabilities, let us say we have 4,000. So net assets we have 1,000. Number of shares, let us say 1,000. So intrinsic value is 1,000 by 1,000, 1. Right. Now, how many shares are to be issued? How many shares are to be issued? We have 1,000 in net assets. The buying company's intrinsic value is 4 per share. So, number of shares will be the total worth of the selling company 1,000 divided by intrinsic value of buying company 4, that is 250. So, A will issue 250 shares. A will issue 250 shares valued at 4 per share. Okay. Any confusion or any question in these 3 things we have discussed so far? So, we can have lump sum method where they pay a lump sum or fixed amount to the shareholders, where the question will say, okay, this is the lump sum amount. Then net payment method where you can have form of issue of shares, debentures, cash or other assets. So here what will happen is, here what they'll say, they would say 10 lakhs is the amount. In the second scenario, they would say they will issue 1 lakh shares at so much, so many debentures at so much. Okay. Then net asset method, where it is based on the net asset of the transferor company, where you will take the net assets and do it. We'll take a question and we'll figure that out. Then intrinsic value, similar to net asset method, where you will take the assets available to equity shareholders divided by number of equity shares, you will get the intrinsic value, and based on the intrinsic value you will calculate how many shares have to be issued. Now one typical question what a lot of students ask me is, sir, which method to follow? Which method to follow? You have to look for information. First, have they given information about the total purchase consideration? Means the company has acquired the other company at, let us say, 10 lakhs. If that information is given, you will take that information. If that is not given, then what you need to see, do we have information on number of shares? Do we have information of number of shares issued, number of debentures issued and all of that? If that is there, then accordingly you will calculate. Otherwise, the question will clearly tell you that it has to be based on the intrinsic value or the, based on the assets taken over. That information will be available properly. Now, one more scenario, sometimes what can happen is, they would say, net assets, they will not mention anything, but they would say issue sufficient number of shares valued at 25. If this happens, then first you calculate the net assets. Using this net assets, when you divide by 25, what will be the number of shares? That will be the purchase consideration. Okay. Now, there are two methods we have seen, pooling of interest method and purchase method. Purchase method is generally tested most of the times in the examination. You have questions around purchase method. Now when we say purchase method, it is basically you will take all the assets taken over, all the liabilities taken over, you will get what is the net asset. This you will compare with purchase consideration. If you have paid more, it is goodwill. If you have paid less, it is capital reserve. Whereas when it comes to pooling of interest method, you will take all assets, all liabilities, reserves at book value. Okay, here it can be book value, it can be fair value, it can be agreed value, depending on the question. But here everything will be at book value. Okay, and the difference whatever comes, that will be taken to your capital. Your reserves, so it will be adjusted to reserves. General reserve, depending on whether it is excess or less, everything will be adjusted to the reserves only. Nothing will be shown as goodwill when it comes to pooling of interest method. Okay. Now, pooling of interest method, a very simple way to do that is, let us say we are talking about B Limited, and see, no need to remember, when you practice questions, you will automatically get to know. Let us say assets having book value of 1000, liabilities have book value of 300, equity share capital, let us say 200, reserves, let us say 500. Okay, this is the balance sheet. Now, when A Limited acquires, they will take assets at 1000, liabilities at 300, reserves at 500, and let us say purchase consideration issued, it will always be in terms of equity share capital is 300. Currently equity share capital is 200, now we are issuing it at 300. This difference, whatever is there, 300 minus 200, that will be adjusted against reserves. Or what you can say is, I will record 1000 of assets, I will record liability 300, I will record equity share capital 300, what is issued, balance I'll credit to reserves 400. Basically 500 minus 100. Okay. Now that is how the accounting will be done. This is the theory part. Share capital issued plus other consideration minus share capital will be adjusted from the reserves. Basically, the balancing figure will go to the reserves. That is what we have to remember from examination point of view. Then, sometimes when there are reserves, especially in the case of amalgamation in the nature of merger, all the reserves as it is will be transferred. And in both amalgamation in the nature of merger as well as in the nature of purchase, if there are statutory reserves, we will transfer that as well. Okay. Now, statutory reserves will transfer by using amalgamation adjustment reserve account debit to statutory reserves account. So that is how it is done when we have statutory reserves in case of purchase. In case of merger, all the reserves as it is will be taken. Right. Now, coming to the accounting part of it. How do we close the books of selling company and what do we do in the books of buying company? In the case of transferor company or seller company, we have to close the business. I have already discussed this in the previous class. I am again revising it before we go to the questions. For closing business, debit realization with all assets, liabilities debit to realization account with all assets. So basically, realization account, you transfer all the assets and you transfer all the liabilities. If some assets have not been taken over, and have been realized independently, debit bank credit realization. If some liabilities have not been taken over and we have settled it, debit realization credit bank. So basically, this realization account becomes my final settlement account. I have transferred all the assets, I have transferred all the liabilities, then whatever amount is received or receivable from the other party, that is from the buying company, that you would say to, you have transferred all the assets, the net amount that is receivable, say by XXX, whatever is the company's name which is purchased, and you will credit that to realization account. Okay, I think I wrote it wrong here. Assets have to be on the debit side, liabilities have to be on the credit side. All the assets here, all the liabilities here. Okay, then cash. Here is again a lot of students have a doubt. So what do we do with the cash account? If cash is taken over, you will transfer that to realization account. If cash is not taken over, then you will not transfer to realization account. If there are realization expenses, you will say realization account debit to cash account, whatever has been incurred. Then purchase consideration, you will debit the transferee company because it is receivable to realization account, you will credit it. Once we receive the purchase consideration, in what form we have received? Debit those respective firm. If we receive equity shares, debit equity shares, credit transferee company. If we receive debentures, debit debentures, credit transferee company. If we receive cash, debit cash, credit transferee company. Okay. This ultimately what will happen is this will be transferred to equity shareholders account and will close that account. Realization expenses, if it is borne by transferee company means what? Buying company is bearing. Then in my books I will not pass any entry. If I am bearing, I will debit realization, credit bank. If incurred by selling company and reimbursed by buying company, I have incurred but buying company will pay. So I will say transferee account debit to bank. Here, if I am bearing, it is my expense. If the transferee company is bearing, transferee company has to pay me. So I will debit transferee company, credit bank. Then we will close the realization account, and whatever is the balance will transfer to the shareholders account. But if there are preference shareholders, let us say preference share capital 1 lakh, we have to pay them 1,10,000. We are paying 10,000 extra, right? This 10,000 extra, whatever we are paying, this you can transfer to realization account as loss. Meaning to say, in the preference share capital account, you have 10,000 balance, you paid 1,10,000, that 10,000 extra is a loss that will be transferred to the realization account. And from that, balance amount will be transferred to the equity shareholders account. And finally, when you settle the equity shareholders in cash, equity shares, preference shares, debentures, any other assets, you will pass it. Okay. Any question here? In this set of entries, or when you are normally solving questions, do you have any question on how to handle these ledger accounts or close the accounts? All clear? Okay, great. Then, when it comes to amalgamation in the nature of merger, as I told you, all the assets, all the liabilities, P&L, reserves, everything you will incorporate. You will incorporate by crediting to business purchase account with the amount of purchase consideration. Okay, this is all at book value only. This is all at book value only. Any difference will be adjusted against the reserves. Any difference will be adjusted against the reserves. Now, if there are liquidation expenses, liquidation means the other company we have to wind it up, and for that we are incurring some expenses. If these expenses are borne by the transferee company means what? The company which has purchased. That means it is an expenses for amalgamation for them. Okay. Now that if it is in the nature of merger, we will debit it to general reserve. If it is in the nature of merger, we will debit it to general reserve. But if it is the nature of purchase, we will either debit it to goodwill or will debit it to capital reserve, depending on whether there is a goodwill or capital reserve on account of purchase. Okay, this is one thing you can keep in mind. Then, if the new company is being formed, means we are forming a new company, then in that case you will debit it to preliminary expenses. Then sometimes what happens is we take over assets and liabilities, we discharge some liabilities, you will debit the liability and credit the original liability. So debit the original liability, credit the new liability. Okay, that is when it comes to amalgamation in the nature of merger. Then we have purchase method, amalgamation in the nature of purchase. Here also, what will happen is, you will take all the assets, you will take all the liabilities. What value? The value either first agreed upon value. If agreed upon value is not given, agreed upon means A is acquiring B, they have agreed that this will be the value at which we will be acquiring. Okay. If that is not available, then you will take the book values. You will take all the assets, all the liabilities, and credit it to something called as business purchase account. Now, instead of this business purchase account, can I directly write liquidator of transfer company? That is also allowed. Okay, to liquidator of transferee company. The difference, if net asset acquired and purchase consideration, if purchase consideration is more, if we are paying more, we call it goodwill. If net asset is more, we transfer it to capital reserves. Then, from the liquidator of transferor company, whenever we receive the consideration, we will debit them, credit the respective consideration. If there are statutory reserves which we need to maintain, see, this problem does not arise in case of amalgamation in the nature of merger, because there we are taken all the assets, we will take all the assets. But here, if statutory reserves are there which we need to take over, we will debit amalgamation adjustment account and credit statutory reserve. If liquidation expenses of transfer company are borne by transferee company, goodwill to bank. But if at the time of initial recognition it was capital reserve, we can debit capital reserve to bank. Formation expense we have already discussed. If there are both goodwill and capital reserve, they may be written off against capital reserve. This will not be necessary in exam condition because either you will have a goodwill or capital reserve. Right? So this is when we incorporate. Right? When we incorporate, these are the entries we pass. So basically how you have to think at it is, if there are assets which you have taken over, debit all the assets. Liabilities that you have taken over, credit all the liabilities. Difference, whatever we get, will be transferred to goodwill. In difference between the net assets and the purchase consideration, goodwill or capital reserve. When does goodwill arise? When purchase consideration is more. When does capital reserve arise? When purchase consideration is less. After we have taken over all the assets and liabilities, there are some special adjustments to be done by the buying company. Now, one thing all of you have to keep in mind is, there will be questions which say that the debentures have been settled, the liability has been settled by the transferee company. All of these adjustments should be done after incorporating the assets and liabilities. Meaning to say, if there are, let us say, old debentures 10%, new debentures 9%. If the settlement is happening, transferee company is issuing new debentures, that adjustment should be done after we have incorporated all the assets and liabilities. Please keep this thing in mind, right? Then, if there are intercompany owings means what? A Limited has to pay 10,000 to B Limited. A Limited has to pay 10,000 to B Limited. Basically what it means, after amalgamation, it will not be paid. But this cancellation of A Limited and B Limited balances should be done after incorporating all the assets and liabilities. Don't do it before. Okay, or don't think that because it is my money only, I will not be receiving or I will not be paying. So I should not incorporate that. That should not be the approach. Take all the assets, take all the liabilities, record the purchase consideration, record goodwill, record capital reserve, then do this adjustment of intercompany owings, basically cancellation. How to cancel? The payable side will be debited and receivable side will be credited. Then sometimes we have stock related adjustments which we need to do. Generally in amalgamation it is not tested. Okay, now what does that mean? If let us say stock is worth 10,000, purchased at 12,000, okay, who purchased this? Selling company. Selling company is recording it at 12,000, original value is only 10,000, means 2,000 is unrealized profit. This unrealized profit in inventory, this is more relevant in consolidated financial statement. The profit element which is not realized, it is like I sold goods to you at 12,000, the goods were costing me only 10,000. When I get back the same goods, I cannot value it at 12,000, I should value it at 10,000 only, because accounting standard 2, lower of cost or net realizable value. So I have to reduce inventory value by 2,000. When I have to reduce, I have to credit inventory, then debit goodwill or capital reserve. Okay. Any questions in the theoretical discussions we had? Okay. Now what we'll do is we'll take up at least 3 questions. Today we'll take up maybe 2 questions and tomorrow 1 more question, so that we are fully confident on how to handle different scenarios in the examination. I'll also tell you where you can make more marks, score more marks, and cases where you might lose marks. Okay, so that is the idea. May 24 question, 14 marks, and our target should be at least 10 marks out of this 14 marks. Okay, how to read? Intelligent and diligent are carrying their business independently for last 2 years. Following financial information is available. Intelligent, diligent, equity shares, preference shares, payables, retirement gratuity fund, long-term P&L account, opening balance, profit for the current year, land 10 lakhs, land and buildings, plant and machinery 10 lakhs, inventory 7 lakhs, trade receivable 6 lakhs, cash in bank 4 lakhs. Okay, both companies. On 1st April, both the companies agreed to amalgamate and form a new company, Genius Limited. Now here is a case where we have a new company. Means what? All these assets will be taken over by new company called Genius. With an authorized capital of 40 lakhs divided into 30,000 equity shares of 100 each and 10,000 preference shares of 100 each. The amalgamation has to be carried out on the basis of following agreement. Land and building 11 lakhs, 8 lakh 50. Plant and machinery 9 lakhs, 4 lakhs. Inventory 6 lakhs, 3 lakhs. So land and building is done, plant and machinery done, inventory is done. Trade payables of Intelligent Limited includes 1 lakh due to Diligent Limited, and trade receivables of Diligent Limited shows 1 lakh receivables from Intelligent Limited. There is 1 lakh of intercompany payable and receivable. This cancellation will be done after the amalgamation. The purchase consideration is to be discharged in the following manner. Issue 22,000 equity shares of 100 each, fully paid up in the proportion of the sum of their profitability in the preceding 2 financial years. So this was the very rare type they sometimes ask, but what they're saying is issue 22,000 equity shares of 100 each in the proportion of sum of their profitability in the preceding 2 financial year. Now where will we get the profitability? So here they said last 2 years. 2 years profit and loss account, opening balance 4 lakh 50 and 2 lakh 50. So sum of this and sum of this. In this ratio will split the purchase consideration. Now here if they ask me, they have given us total purchase consideration. They have given us total purchase consideration. Now we have to split between the 2 companies. Preference shares of both companies are issued equivalent number of 8% preference shares of 100 each of Genius Limited at a price of 125. So you will issue equity shares, you will issue preference shares to the existing preference shareholders. That is also part of your purchase consideration. 12% debentures of 100 each in Genius Limited at par to be provided an income equivalent to 10% return on the basis of net assets in the respective business as on 1st of April after evaluation of assets. Okay, so 12% debentures of 100 each of Genius Limited at par. So whatever will be the 10% of net assets, 10% of return on the net assets in the respective business after evaluation of asset. On that, considering that, we will give debentures. Now this debenture is not to debenture holder. This is purely your purchase consideration. So what we need to do, we need to calculate net asset. On that net asset, we need to see what is 10%. To make earning equivalent to 10%, how many 12% debentures I need to issue? That is what we need to calculate for both the entities. Okay. Now, you are required to compute the amount of shares and debentures to be issued to Intelligent Limited and Diligent Limited. Prepare a balance sheet of Genius Limited showing the position immediately after amalgamation. Now here, the most difficult part in this question was purchase consideration. Not difficult, we have to think carefully before solving the question. Okay, a lot of time what happens is, because the question is tricky, we may tend to get lost how to solve it. But here, take one by one at a time and compute the shares and debentures to be issued. Now, to calculate shares and debentures to be issued, we need what? We need, here it is profitability, here it is net asset. So we also need the net asset. We also need the net asset for incorporation purposes. Okay. Now, one question a lot of you may ask is, sir, what do we assume? Do we assume only these three assets have been taken over, or do we assume all the assets have been taken over? See, generally, when an existing companies are dissolved and a new company is formed, unless it is otherwise specified, all the assets have been taken over. Okay. For these three, they are given value. For the remaining, we will take it as per the book values. Alright. Now, first, calculation of equity shares. How? They have said ratio of P&L. Ratio of P&L. Intelligent Limited, Diligent Limited. Opening balance from the balance sheet. Profit for the year 250, 150, 7 lakhs and 4 lakhs. Now, in this ratio, we will issue the shares. How many shares? 22,000 equity shares of 100 each fully paid up. Means you have 22,000 into 100. That is 22, 1, 2, 1, 2, 3. 22 lakhs will be split between these two in 7:4 ratio. So, number of shares will be 22 lakhs, 7 lakhs and 4 lakhs. So, either you can take 7 lakhs plus 4 lakhs and split, or you can do 7:4. Whatever way you are comfortable in handling the ratios. 7 plus 4, 11. Divide by 11, multiplied by 7. First company, 22 lakhs divided by 11 multiplied by 4, the next company. Okay. Now, what do we need? Number of shares. This is the total value. If you need number of shares, you will take 22,000 and do the split. Okay. So, this will be 11 into 2, 2 lakhs into 7, 14 lakhs will be purchase consideration for Intelligent and 8 lakhs for your Diligent. Number of shares? Number of shares 14,000, 14,000 and 8,000. Are we clear? This is the first part. Then, next is preference shareholders to be issued equivalent number of 8% preference shares at a price of 125. So, same number valued at 125. So, first thing, equity shares, we have seen 14 lakhs here and 8 lakhs here. Preference shares, same number is not changing. Value has become 125. So, number of shares, 3 lakhs divided by 100, 3,000 into 125, 375, 250. Third is debentures, for which again we need the working note. What is the working note in debentures? We need to calculate net assets. So, coming to net assets, land and building, agreed value. Plant and machinery, agreed value. Inventories, agreed value from the question. Remaining trade receivable, cash and cash equivalent, book value 6341. So 7 minus 1 is 6, 4 minus 1 is 3. That is how they have taken. Even if you take 7 and 4, finally the number will be same, because if you remove from trade receivable, you would have removed from trade payables also. So that 1 lakh you can take, and I would suggest you to take 7 and 4, not 6 and 3. Right? Then, oh sorry. 6 and 3 only, correctly they have taken. This is the alignment issue, my bad. Trade receivables is 6 and 3. There is a 1 lakh of intercompany holding. I thought they have adjusted, but this 7 lakhs is for inventory. Okay, so trade receivable is 6 and 3. They have taken correctly. You have to take it as per balance sheet only. By offsetting the intercompany receivable payable, also you can calculate. Answer will be same because you will reduce 1 lakh from here and 1 lakh from payables, but don't do that. Take it as per the balance sheet. 6 and 3. Okay, then cash and cash equivalents total of assets, right? This is the first step. Then trade payables gratuity fund. In the liability side, if you come, payables and retirement gratuity fund. Okay, these two have been taken over. So net assets comes to 21 lakhs and 13 lakhs 50,000. Now I will tell you the working, how you should be calculating number of shares to be issued or number of debentures to be issued. This will also apply when you have number of preference shares to be issued based on percentages. Okay, so typically what happens is an adjustment which keeps on coming in the examination. I have 10% preference shares, 1 lakh. Issue sufficient number of preference shares of 12% to ensure same dividend. These kind of adjustment keeps coming. You also get an adjustment of debentures. 10% debentures of 1 lakh, issue sufficient number of 12% debentures to ensure same dividend or same interest or same income. Okay. How to do this? First step, calculate current income. What is the current income? 1 lakh into 10%. 1 lakh into 10%, 10,000. Now I need to issue 12%. I need to issue 12% something, 12% preference shares, so that interest is 10,000. Meaning to say what? 12% of preference share should be equal to 10,000. So preference share should be equal to 10,000 divided by 12%, which is 10,000 divided by 0.12. 12 8s are 96. 12 8s are 96. 4,003. 4 12 3s are 36. 83 something. 8333. Let me just see. 10,000 divided by 0.12. 8,333.33. 83,333.33. This is the value of debentures to be issued. So shortcut for the examination, number of shares or debentures is equal to existing earning divided by new percentage. Existing earning divided by new percentage. What is my existing earning? Divided by whatever is the new percentage, that will give you not number, total value of shares and debentures. Alright. So in this case, what has happened is we have net assets of 21 lakhs and 13 lakh 50,000. Now what is the question saying? Question is saying that you give them 10% earning. You give them 10% earning, but you have to issue them 12% debentures. You have to issue them 12% debentures. So 10% of 21 lakhs, existing earning is 2,10,000. Take the existing earning, divide by new percentage, which is 12%. So 2,10,000 divided by 0.12 gives me 17 lakhs 50,000. This is value. If you divide by 100, you will get the number of shares. So 17 lakh 50,000. Same way here, 19 lakh 50. So 10% is 1 lakh 95,000 divided by 0.12. 1 lakh 95,000. 1 lakh 95,000 divided by 0.12. You will get 1625. Right? No, I took some wrong number. It's not 1950. I took 1350. 1350 I have to take. 1,35,000 divided by 0.12. So 135 divided by 0.12, I get 11,25,000. Are we clear on how to calculate these number of debentures or preference shares and the total value? Just follow the formula. Existing earnings divided by new rate. Most of the cases you will be able to handle. Okay. So first part is done. Purchase consideration, equity shares, preference shares, debentures. Now, sir, can we do working notes before this? Yes, you can do. You can combine the working notes here itself. You can do the working notes and prepare this table. You will get sufficient marks. Right? Now, second thing is, they have said prepare balance sheet. Now, before balance sheet, if we have to pass journal entries, how will we pass? Before balance sheet, if we have to pass journal entries, how will we pass? So, journal entries you have to pass for incorporating Intelligent Limited and Diligent Limited. How? Debit all the assets, credit liabilities. So what will happen? You will say land and buildings, debit, plant and machinery, debit, inventories, debit, trade receivables, debit, cash and cash equivalents, debit, to trade payables, to gratuity fund, to liquidator. How much? Purchase consideration. What is the purchase consideration? 35,25,000. Purchase consideration is, you will say to liquidator 35,25,000. This minus the net assets. So 35,25 minus 21 lakhs. You have goodwill of 14,25,000 by passing this entry. Or when you are preparing this purchase consideration or net assets, here only you can say what is the purchase consideration and you can calculate goodwill. Or here purchase consideration, here you can say net assets. Net assets are 21 lakhs. So the difference, whatever comes, 14 lakhs 25,000 is goodwill. Try to incorporate goodwill calculation along with purchase consideration so that you don't miss out. Net assets we have already calculated, purchase considerations we have already calculated, difference goodwill calculate directly. Okay. So here they have taken 35,25 minus 21, 14,25 and 8,25, 22 lakhs 50,000 as goodwill. This what I am saying is, this include it as a part of this calculation or purchase consideration calculation, you will save some time. Are we clear with that? Now, coming to combined balance sheet. In the combined balance sheet, this equity shares capital is no longer relevant. Preference shares no longer relevant. Payables 12 lakhs plus 4 lakhs is equal to 16 lakhs minus intercompany of 1 lakh. Then retirement gratuity 3 lakhs plus 2 lakhs you will take. P&L balance is no longer relevant, so you will not take. Land and buildings, revalued amount. Plant and machinery, revalued amount. Inventories, revalued amount. Trade receivable, 7 plus 4 minus 1 lakh. Cash and bank, 6 lakhs plus 3 lakhs, 10 lakhs. And goodwill you will add. Then, always remember adjustment. This purchase consideration is my adjustment. So I have to take 22,000 equity shares of 100 each. Equity share capital, preference shares 100 each which have been issued to the selling companies, this will be added. Debentures, whatever have been issued, that will also be added. So these adjustments make sure you incorporate. So what will happen is, in the combined balance sheet, I am again repeating, if it is and see, this is amalgamation in the nature of purchase. The simple reason being, we are giving debentures to the equity shareholders also. So that is why there is a amalgamation in the nature of purchase. So how do we prepare the combined balance sheet? Once again, please pay attention. When you prepare the combined balance sheet, when it is amalgamation in the nature of purchase, this existing number of equity share capital is not relevant. Preference shares existing number is not relevant. See, here not relevant because intelligent and diligent, both of them are being sold off. If intelligent was buying diligent, then diligent numbers were not relevant. Then payables will take 12 lakhs, 4 lakhs minus adjustment of 1 lakh. Gratuity fund will take P&L balance will not take. Land and buildings will take. Plant and machinery, inventories, trade receivable, bank, all of this will take. Wherever revised value is available, we'll take the revised value. Wherever revised value is not available, we'll take the book value. Alright, then adjustment. Trade payables of Intelligent Limited includes 1 lakh to due to diligent. So what you will do? You will reduce from payables, you will reduce from receivables. Then purchase consideration, very important adjustment. 22,000 equity shares of 100 each, will incorporate as it is. Preference shares, whatever shares we have issued, will incorporate as it is. Debentures, whatever we have issued, will incorporate as it is. Then take goodwill, your balance sheet will automatically tally. Sir, why will it tally? Because we are just adding two balance sheets. So if you see share capital, 22 lakhs here, preference shares 5 lakhs, right? Then securities premium. With securities premium, this is your preference shares 25 into 5,000, because preference shares have been issued at 125, out of which 100 will be captured here and 25 will be captured here. 12% debentures, the total what we have issued 2875, you can get it from here 1750 and 1125. Then gratuity fund 3 plus 2, plant and equipment, land and building, plant and machinery as added. Then all of this we have taken. Trade payables minus 1 lakh, this one adjustment, and this minus 1 lakh, one more adjustment, and you will put intangible assets as goodwill here. Now sir, for which all account we need to prepare working note? Always I said equity share capital, yes. Reserves also yes, because there is a P&L balance. But here P&L balance has been knocked off, only we have securities premium. Then long term borrowings, because debenture is a different name. Because it's a single line, you can also write debentures here. Other non-current liabilities, gratuity fund. Trade payables, directly you can show. Non-current assets, PP, breakup is required. Intangible assets, goodwill, breakup is required. Current assets, inventories, directly you can say. Trade receivables, direct. Cash and cash equivalent, direct. Alright, now coming to marks allocation. This is a 14 marks question. If this was previous exams, they would have asked this question for 16 marks or 20 marks. Now they have reduced it to 14 marks. Now how will we see how to score the marks? This first calculation would be around 3 marks. This balance sheet would be around 4 marks. 3 plus 4, 7. Notes to account, 8. And here 2, 10. Ratio of equity share 1, 11. Net asset 2, 13. This may be 1, 14. This may be 1, so it became 15. So what will happen is maybe they will reduce 1 mark from here. Balance sheet may carry only 3 marks, or this may carry only 2 marks. Now the idea is at least balance sheet score maximum, including notes to accounts and working notes to be done correctly. With that, 10 marks is in your pocket. 10 marks is in your pocket, but yes, to do this 14 marks question, you will take at least 30 to 35 minutes. You will take that much amount of time. So when you are writing in the examination, what you should do is, after you finish MCQs and finish easy questions on accounting standards, then pick up these type of questions. And don't get scared because you are seeing this for the first time. So read carefully, you will be able to crack it. Any question on this? Or is it all clear? Now, what I want you to do is, after the class is over, take this question once again and solve it on your own. Okay, see, I can solve any number of questions. You need to be clear about how to handle it in the examination. So, please take this question and solve it on your own. Okay. The next one, again, 5-mark question, but very lengthy question again. Raman Limited and Naman Limited decided to amalgamate and form a new company, Rana Limited, as on 31st March. 2 companies, 1 company. So Naman will go, you will get a new company. Yeah, equity shares, preference shares, reserves and surplus, trade payables, PPE, goodwill, inventories, trade receivables, and cash equivalent. Okay. Now, the purchase consideration is to be satisfied as follows. By issue of 4 preference shares of 100 each in Rana Limited, 85 paid up and at a premium of 30 per share for every 3 preference shares held in both the companies. So, see the way they have tried to twist the question. What they are saying, we will issue 4 preference shares of 100 each in Rana, new company, for every 3 preference share held in both the companies. So, here 336,000 divided by 3 multiplied by how much? Multiplied by 4. And then they are saying it will be at a premium of 30. So, the issue price will be 130. But again, paid up value will be 85. Then, by issue of 5 equity shares of 10 each in Rana Limited at 7 paid up and at a premium of 5 per share for every 3 equity shares held in both the companies. So, here also 5 for 3 divided by 3 multiplied by 5. In addition, necessary cash should be paid to equity shareholders of both the companies as required to adjust the rights of both the companies in accordance with the intrinsic value. What they are saying? Basically, if you break it down, first we need to calculate intrinsic value. Intrinsic value is the value attributable to the business based on the value of assets and liabilities. Now, when you calculate intrinsic value, if fair value or agreed upon value is available, you will take that value, or then you will take the asset value as per the books. Okay, so here they have said revalued numbers. So they have given the revalued numbers. Wherever revalued numbers are available, we will take the revalued numbers. This will give us what? This will give us net asset. This will give us net asset. Once we get to this net asset, we have to see what is the intrinsic value per share and how many shares have been issued. Now, with this net asset, the total net asset and how many shares have been issued, if there is any balance left, that we have to pay by cash. Alright? Okay. Now, first, what are the net assets? One more thing. Here we have something called goodwill 162. Should we consider? Not consider. Should we consider? Not consider. If any other information is not given, you can consider. And here they have specifically said revalued figures are for amalgamation purpose. We should take 162. But when you are normally calculating goodwill, if let us say there is a question, the balance sheet already has goodwill, and then you also need to calculate goodwill. In that case, you will not take that goodwill component. You will take other assets, other liabilities, and then determine the goodwill. Alright. Now, so here we have PPE. So what we will do, we will take the agreed upon value. 10, 58, 86, 50, 162, 278, 247. You have to copy one by one. Alright. So goodwill, PPE, trade receivable, inventory, and cash equivalent, even that has been taken. That is needed for calculation of net assets. Okay. Then Naman Limited, same thing, will take the remaining numbers minus the liability. How much do we have? 19 lakhs, 460, 856, 580. So basically total assets at agreed value minus total liability will give me net asset. This net asset, whatever is there, that is for the total business. That when I divide by number of shares, I get intrinsic value. But if you have to calculate intrinsic value of equity shares, then what you will do, from this net asset, whatever is payable to preference shareholders, first you will remove that, then you will divide by number of equity shares to get the intrinsic value. Now here we don't need to do that, because here we are saying whatever is the total net asset, first we will issue shares, and if any balance is left over, we will issue in cash. Now, how many shares will be issued? First, preference shareholders, if you see, preference shareholders, they are saying 100 each at 85 paid up at a premium of 30. So, when we are issuing, we are saying total value is 130. Total value is 130. But how much is paid up? Only 85 plus 30 is paid up. So, for valuation purpose, what is relevant is 85 plus 30. Because balance is not paid up, the preference shareholder has to pay that subsequently. So it is not a part of purchase consideration. So what do we do? 85 plus 30, 115. How many shares? 4 for every 3. So divide by 3, multiplied by 4. 3360 divided by 3 multiplied by 4 divided by 3 multiplied 4 valued at 115. Okay, then equity shares, same logic. How? 5 3 divided by 3 multiplied by 5 valued at 12. How is it 12? 10 each, 7 paid up plus 5 premium. So 7 plus 5 is 12. Now, after these two has been issued, if there is any difference as compared to the net asset 19 lakhs and 856, whatever is the difference, the balancing figure is settled by issue of cash. Now, this if you ask me, you can set a clock timer for 5 marks question. You will take at least 15 minutes to solve. Okay. So, while solving in the examination, for some questions you will take extra time. For some questions you will take lesser time. Our idea should be to cover. Now, this is question 5 out of 5. But if you don't have time, it may be difficult also. And because this language may be a new language to you, it can be tricky. So accordingly decide maybe to do it towards the end so that you don't lose out on other questions. First objective is to take care of all the easy questions that we have. All the easy questions that we have, first we'll take care of that. Then we'll come to complex question or adjustment questions which has difficulties. Okay. We'll do this one more question today and then we'll end today's session. Tomorrow we'll take one more question based on intrinsic value and then we'll start the next chapter. Okay. The summarized balance sheet of A Limited and B Limited as on 31st March 22 is given below. Share capital, securities premium, general reserve, P&L, retirement gratuity fund, 10% debentures, unsecured loan, including loan from A Limited. This you will adjust only after taking over. You will not adjust before. Okay. Trade payables, land and building, plant and machinery, long-term advance to B Limited. Okay, so I think in case of A Limited, it has to be B Limited. We'll see the number. Okay, including loan. So here also I think it should be including loan. So we'll see what is the number. Inventories 1040, 520, trade receivables, cash at bank. B Limited is to declare and pay 1 per equity share as dividend before the following amalgamation takes place with Z Limited. B Limited will pay 1 per equity share as dividend. Means what? When I declare dividend, when I pay dividend, first I have to use my P&L account balance. Okay, so I'll say P&L debit to dividend payable, then dividend payable to bank. Okay, so that is what I'll do. Z Limited was incorporated to take over the business of A Limited and B Limited. So both these businesses, A Limited and B Limited, will be taken over by Z Limited. The authorized share capital of Z is 60 lakhs divided into 6 lakh equity share of 10 each. This is needed for notes purpose. As per valuer, value of equity shares of A Limited is 18 per share and B Limited is 12 per share respectively and agreed. So here what we are saying is the value of equity shares is 18 and 12 per share respectively, and that has been agreed. What does that mean? When you issue shares in Z Limited, they should get 18 into, so it is 30 lakhs divided by 10, 3 lakhs. 18 into 3 lakhs is what they should get. 10% debentures of A Limited is to be issued 12% debentures at par in consideration of their holdings. Now here, do we change? Do we say income has to be changed? No, that is not asked in the question. Okay. Then contingent liability of 2 lakh is to be treated as actual liability. Means what? This will be your liability. A Limited. So when you incorporate assets and liabilities of A Limited, you will also take this 2 lakhs of liability. Liquidation expenses including valuer fees of 50,000 and 30,000 to be borne by Z Limited. Who is bearing? Z Limited. When Z Limited bears this, we will debit it to goodwill or capital reserve as the case may be. Shareholders of A Limited and B Limited is to be paid by issuing sufficient numbers of fully paid up equity shares of 10 each at a premium of 10 per share. So when Z Limited issues, the value of Z Limited shares is 20. The value of Z Limited shares is 20. We will take total value of A, B, divide by 20 to get the number of shares to be issued. Assuming amalgamation in the nature of purchase, you are required to pass the necessary journal entries, narration not required, in the books of Z. Prepare the balance sheet of Z immediately after the amalgamation. Now here, B Limited is to declare and pay 1 per equity share. Do we need to pass any entry for this? No, because B Limited is declaring, not Z Limited. Right. Now coming to how we should approach for Z Limited. First, the working number of shares 3 lakhs, 2,40,000 as per the balance sheet. Agreed value 18, 12. They have agreed. A Limited shares is 18 per share. B Limited shares is 12 per share. That is what is agreed. Means total purchase consideration will be 54 lakhs and 28 lakhs 80,000. Alright. Then how many shares to be issued? Valued at 20. So 54 divided by 20, 2,70,000 and 1,44,800. That is the total purchase consideration. You will split between face value and securities premium for accounting purpose. This is very simple. There is no complexity, right? Then journal entries, right? They have asked. When we say journal entries, first there is a business purchase. So you will have business purchase account to liquidator of A Limited. Same way, you will have business purchase account to liquidator of B Limited with what? With purchase consideration. Okay. Then all the assets taken over, land and building 28 lakhs, plant and machinery 20, 220, 10, 40, 820, 3 lakhs and 1220. This is what all coming from here. 28 lakhs land and building 28 lakhs. Then 20 lakhs, 220, 10, 40, 820, 3 lakhs. Everything has been taken over. Sir, can we assume cash has not been taken over? They have not mentioned anything. So all assets and liabilities have been taken over. Okay. If they specifically say only these many assets, then only you will restrict it to those many number of assets. Then when it comes to liability, gratuity fund account 1 lakh, this liability, then debentures 20 lakhs, loan 6 lakhs and this 1 lakh. Debentures 20 lakhs, 6 lakhs and 1 lakh. Then there was this contingent liability 2 lakhs, that also has to become an actual liability. So that has become our actual liability. To business purchase account, the replication of first entry. So you will pass this credit side, you will pass all of this on the debit side. The difference 12,20,000 is goodwill. Now in these type of questions, don't waste time to calculate goodwill separately as a working note, because you are not required to calculate net asset and you are required to pass journal entries. Can I calculate goodwill in the journal entry itself? Yes, I can. So don't prepare one more working note to calculate goodwill. Here itself we can say balancing figure. You can say balancing figure. This is the goodwill. Same thing will repeat for the other party, that is B Limited. I think here in the thing, this 3 lakhs is missing number. Okay. So this 3 lakhs of cash is there. Equity shares are 24 lakhs. 1% debenture, 1% dividend is 2,40,000. So what you will do? 3 lakhs minus 2,40,000, 60,000 is what is remaining. Okay. So when you incorporate, you will incorporate 6 lakhs here. Now here what has happened? When you pass the entry, you got a capital reserve of 1 lakh. You got a capital reserve of 1 lakh. Then to settle the issue of shares or purchase consideration, liquidators of B Limited and liquidators of A Limited, you can pass a combined entry also. 2 equity share capital to securities premium as per the purchase consideration. 2 equity share capital to securities premium as per the purchase consideration. So what did we do so far? First, business purchase entry, that is business purchase to liquidator. Then assets to liabilities to business purchase, balancing figure to goodwill or capital reserve. Then issue of shares, debit liquidator to equity share capital to securities premium. At what value? As per the working note. Right? Then here it says long-term advance to B Limited 220. This is the total number of 220. This 220 has to be set up against this unsecured loan. So for the entry for that will be unsecured loan debit 220, long-term advances 220. Right? Then liquidation expenses of 50,000 and 30,000 to be borne by Z Limited. So 30 and 50, how much? 80,000. 80,000. So A Limited is 50,000, B Limited is 30,000. So what you can do? Goodwill, debit. A limited is 50,000. So A limited we got goodwill. So you'll say goodwill debit 50,000 to bank. Okay, this is not the appropriate way. Yeah, this is the right way. This is not the correct way. This is the right way. Goodwill to bank 50,000 and capital reserve to cash in bank 30,000, and they have done this offsetting. This offsetting should not be done because goodwill and this has arisen out of two different transactions. Or you can say that, sir, everything was done as a single package. That is why whatever capital reserve has arisen, it has been offset against goodwill. That assumption also can be taken. See, if it was different acquisition, that is another thing. Here it is a single acquisition. So when it is a single acquisition, you can set off the goodwill and capital reserve. So first you will adjust goodwill for A limited, capital reserve for B limited, and because both these entities are coming together as a part of single transaction, then the goodwill or capital reserve arising has been offset. Then while preparing balance sheet, what is not relevant? This equity share capital, securities premium, general reserve, profit and loss account, all of these are not relevant. You will not take this. Okay. Instead of this, what you will take? Equity shares which are issued by the selling company. That is what you will consider. Same way, equity shares issued by, not by the selling company, by the buying company to both this party. That is what you will consider. So, how many shares have been issued? We have here in the working note, right? Here. So, face value 10 lakhs, 27 lakhs and 14 lakh 40,000. 27 plus 14 is 41. 41 lakhs 40,000. So here you have 41 lakhs 40,000. Okay. Securities premium 41 lakh 40,000. Debentures. The question had mentioned 10% debentures to be issued, 12% debentures in consideration of their holdings. So 12%, 10%, how much? 20 lakhs. Here don't do the value change, saying that income should be same. The question has not mentioned that. Question has just said issue these many debentures. Who will issue? The buying company will issue. So for that we also need to pass an entry. 10% debentures to 12% debentures, 20 lakhs, 20 lakhs. Right? So we are done with share capital, reserves, debentures, then provisions, short-term borrowings after adjustment, and trade payables. Then non-current assets, PPE at the total value, goodwill after incorporation and adjustment, inventories, trade receivable, cash and cash equivalent. Right? Give the relevant working notes for each one of them. Right? Now here when it comes to cash and cash equivalent, A limited, B limited 3 lakh 60 minus liquidation expenses 80,000, 2 lakh 80,000. Your balance sheet will 100% tally. Just that you have to ensure, have we taken care of all these adjustment? And in examination you may tend, because see, there is a lot of pressure to solve the question, we may miss out how to solve. So what you can do is, in that case, 10% debentures is to be adjusted. So you can put a small tick here. This has to be adjusted. Then contingent liability, new liability is getting added. Okay. Then that you can put it under, let us say here, one adjustment. Then liquidation expenses. So liquidation expenses, when you pass the journal entry, you will take care of that. Then shareholders, it will directly go to the equity, share capital when we do the adjustment. Then unsecured loan, including loan from A limited, this needs adjustment. So like this, you can make a note of it. So when you're solving the question, you can actually make the adjustment. Right? Is that clear? So idea should be practice at least 3 to 4 questions thoroughly, including the ones which we have done, so that you know how to approach. So step by step, if I have to just summarize for you on how to approach the questions in the examination. First, if required, calculate net assets. This is if required. If not required, no need to calculate. Then calculate purchase consideration. Calculate purchase consideration. Then what is the goodwill or capital reserve? Then add assets of both companies, add liabilities of both companies, record issue of equity shares, and if at all there is preference shares, debentures, all of this you issue. Then if there are liquidation expenses, adjust against goodwill or capital reserve. Follow a structured approach. Okay, now some of you may have this confusion, sir, how much of space to be left? So what you do is, don't do balance sheet at the front. Okay, typically if I were doing, I will do working notes. For working notes, around 2 pages would be sufficient, not more than that. After that, so page 1 and page 2 is left for working note. Page 2, page 3 and page 4 is left for journal entries. Page 5 is for balance sheet. Page 6 is for notes to accounts. So as you read some information, you can directly plot wherever you have to plot. Follow this approach. Once you get used to following this approach, you'll be able to handle. And please remember, questions on amalgamation and consolidation will be lengthy. Okay, don't try to speed up the process and you do a simple mistake and you lose out on marks. So that should not be done. Unless the question is very tricky, that the adjustments are not clear or we are not able to understand how to do a particular treatment, then that is a different thing. Otherwise, you should definitely attempt this question. If required, attempt it towards the end. Allot yourself 30 to 35 minutes of time, and in that time frame, you should attempt this question in the examination. Are we clear? Okay. Now, what we should do is, all of you, as homework or for practice, take this question number 4 of Well and Nice Limited. Okay. This is a 14-mark question, I think. Right? Try to do it on own. Try to do it on own as a practice and see how much time you will take. Okay, I'll not be discussing this question right now. I want you to do it. Then tomorrow we'll have a look at it on how to handle this question also. But I want each one of you to do this on your own so that you're thorough. So if you practice these 3 questions, 4 questions and 1 question, what I'm doing tomorrow, I can say you are 90% prepared for this particular chapter. All right. Okay, so I'll conclude the session here today. Sorry, it has to be a shorter session because of the issues that had come up yesterday. I have to address them. Tomorrow we'll continue at 10 o'clock. Okay. Yeah. Thank you. Thank you, everyone. And thanks for understanding. Good morning, everyone. So any questions on whatever we did yesterday after you had a look at the exam question? Do you think there is something where you need more clarity? So when I say more clarity, any area you want me to take it up again before I take up the next set of questions. Are you able to see the screen? Some difficulty in identifying merger or purchase. Okay. So Ram, what happens is in most of the questions, what they are asking is in the nature of purchase only. They have not asked merger or something like that. Most of the cases, I will still tell you what are the things you should keep in mind, or what are the things you should look at it before deciding merger or purchase. That I will cover up. Okay, can you just confirm that? Okay, it is clear, right? We'll start off now. Okay, so your question was on merger or purchase, right? So see, we have seen 5 conditions. Okay, and in one of those 5 conditions, there is a condition which states that business has to be continued. Now, if business has to be continued, if the question specifically mentions that yes, business has to be continued and other conditions are satisfied, it is in the nature of merger. Okay. Now, what are the other conditions? We said everything has to be taken over at book values. Now, if the question has cases where the values are different, if they said that okay, it has to be taken over at a different value, then in that case, this condition will not be satisfied. Then you have to see the 90% shareholders criteria, that okay, the equity shareholders who hold 90% by face value, they will become shareholders. All right. Then after this, there is one more criteria where we say that consideration is in equity shares. Now, in the questions that we saw, consideration was in preference shares, consideration was in debentures, consideration was in equity shares, in cash. So This condition also you need to check properly. But if this condition is not given that the business will be continued, if that condition is not given, then in that case, there is no need to dig further down into the other condition. Or the question will clearly mention that yes, this is amalgamation in the nature of merger or amalgamation in the nature of purchase. Okay. Is it clear? Ram, is your doubt clarified? Let us look at this question. This is again a 15-mark question. So what we'll do is after this question, we'll take one question which is on intrinsic value. Then we'll take other two questions which are, from the study material already there. Then we'll also discuss the September 24 question. After we discuss these many questions, it would be, fairly clear on how to handle these type of questions in the examination. Dark Limited and Fair Limited were amalgamated on and from 1st of April. A new company was formed to take over the business of the existing companies. The balance sheets of Dark Limited and Fair Limited as on 31st March are given below. So, Dark Limited, Fair Limited transferred to Bright Limited. Okay. You have shareholder funds, share capital, reserves and surplus, non-current liabilities, which is 10% debentures, current liability, that is trade payables. Property, plant and equipment, investments, current assets, inventories, trade, cash and cash equivalents. Share capital has been given. Reserves and surplus, revaluation, general reserve, investment allowance, profit and loss. All right. Bright Limited will issue 5 equity shares for each equity share of Dark Limited and 4 equity shares for each equity share of Fair Limited. The shares are to be issued at 35 each, having a face value of 10 per share. Now, what does this mean? This means that the share, the company which is issuing the share, which is Bright Limited, will value its shares at 35. How much will each one get? Dark Limited will get 5 equity shares and Fair will get 4. So, what are the number of shares? Equity shares of 100 each. Equity shares of 100 each. How much is that? 1200 lakhs divided by 100. Here we have 12 lakh shares and here we have 1.25 lakh shares. How many shares are issued? Multiplied by 5 multiplied by 4. Okay, that will give the purchase consideration for equity shares. Then preference shares of the two companies are issued equivalent number of 16% preference shares at a price of 160 per share. Now, what does this mean? This basically means that preference shareholders will get 16% preference shares equivalent number. So here we don't need to equate the earnings. It was 14%. Now we are giving them at 16%. What is the valuation? Valuation is 160. Face value is 100. So 160 into whatever is the number here. Here it is 4.5 lakh shares and here it is 3 lakh shares. Those many shares will be issued. So how did we get 3 lakhs? 100 each. 450 divided by 100. Number of shares are 4.5 lakhs. All the numbers are given here in lakhs. If the question itself gives you numbers in lakhs, you can continue to do all your working in lakhs. Okay, so don't try to add extra zeros and all of that, which will confuse you in the examination. Okay, then 10% debentures of Dark Limited and Fair Limited are discharged by Bright Limited, issuing. Now here you see such number of 16% debentures of 100 each so as to maintain the same amount of interest. So what is the difference? For preference shares, they didn't say you have to maintain the same dividend. Whereas for debentures, what did they say? For debentures, they said you have to maintain the same interest. Now, for that, it is 10% debenture. So what we will do? We will calculate earnings. Earnings divided by new percentage. We discussed this yesterday also. What is the earning? Earning is 90 lakhs multiplied by 10%. 90 lakhs multiplied by 10% divided by 16%. So 90 into 10 divided by 16, 90 into 10% divided by 0.16, we get 56.25 worth of debentures to be discharged. And that is the value you can say at which we will be discharging the debentures. All right. Then investment allowance reserve is to be maintained for 4 more months. So they have said this is a reserve which you have to maintain. Okay. Liquidation expenses for Dark Limited 6 lakhs, Fair Limited 3 lakhs. It is decided that these expenses will be borne by Bright Limited. Now, if Bright Limited is bearing the expenses, what do? We will debit that to goodwill or capital reserve as the case. All assets and liabilities are taken over at book value. All assets are taken at book value. Equity shares have been given shares only. Authorized equity share capital of Bright Limited was 15 crore divided into equity share of 10 each. After issuing required number of shares to the liquidators of Dark Limited and Fair Limited, they issued balance shares to public. Issue was fully subscribed. Now, this is one extra item where they have just given it that we have issued shares. We have issued shares and that has been fully subscribed. You are required to prepare balance sheet of Bright Limited on 1st of April after amalgamation has been carried out on the basis of amalgamation in the nature of purchase. Now, here they have directly said you use amalgamation in the nature of purchase. Now, just to address the question what Ram had asked, can I do it in the basis of amalgamation in the nature of merger? Now, let us say the condition. One condition is equity shares 90% criteria. Here, all equity shares have become the equity shareholders. So that criteria is satisfied. Second criteria, we have to issue equity shares only to the equity shareholders. That criteria also is satisfied. Third criteria, everything has to be taken over at book value. Even that criteria is satisfied. Correct. Then the business has to be continued. Even that criteria has been satisfied. Correct. So, and all assets and liabilities have to be taken over. Even that criteria has been satisfied. Book value also has been satisfied. All the 5 conditions are satisfied in this case. But I can solve the question using merger method if the question had not said that it is in the nature of purchase. Because the question has told me that it is in the nature of purchase, I will follow in the nature of purchase method. So what if this was not given? Now, if this was not given, what we would have done? We could have made an assumption that it is amalgamation in the nature of merger and solved it accordingly. Or we would have made an assumption that it is amalgamation in the nature of purchase and solved it accordingly. Generally, 99% of the times in the examination, they will mention clearly which method has to be followed. All right. Okay, clear? After we have done this, first thing is what? First step for us is to determine the purchase consideration. We have already discussed the purchase consideration. Again, we can do that. Now, as far as purchase consideration is concerned, for preference shareholders, whatever is the number of shares, they have said 450 lakhs divided by 100 multiplied by 160 is the value. So 450 divided by 100 multiplied by 160, I get 720. Same way, we can do for Fair Limited 480. Now, in examination, you can save time by preparing 2 columns simultaneously. All right. Then, equity shareholders, 5 shares here and 4 shares here, 35 each, 2100 lakhs, 1575 lakhs. So, first step, purchase consideration, 2820 and 2055. After we have determined the purchase consideration, the next step is to determine goodwill or capital reserve. Okay. Now here they have not asked us journal entry. If they asked us journal entry, we would have incorporated the working in journal entry itself. Now here they have not asked us journal entry. What they have asked us is they have asked us only the balance sheet. So after purchase consideration has been calculated, the next step is to determine goodwill or capital reserve. How do we get that? First, net assets taken over. Now, what are the net assets taken over? You have, property, plant, and not equipment, it is equipment. Then non-current investment, inventory, trade receivable, cash and bank. Okay, so this is done. Then what are the liabilities taken over? See, for debentures, we calculated, right? Debentures, we had calculated here 56.25. The same thing you can do the calculation. How do we do it? Existing earnings divided by new rate. That is the value of debentures to be taken over. Now that, okay, so one catch which we missed. Debentures are not taken over at book value. Debentures are taken over at less than 56.25. So the statement that I made now stands corrected because debentures we did not take at 90. We took at 56.25. Same way for here, 45, 4.5 divided by 16%. 4.5 divided by 16%. 4.5 divided by 0.16, we get 28.125. So, as far as debentures are concerned, it is not at book value. We missed when we were, discussing it. So, this has to be in the nature of purchase only. Okay. So all assets at book value, liabilities, debentures, 56.25 and 28.125, we just calculated. Trade payables, 630. There's some alignment issue. Okay. So 300 plus, sorry, 56 plus 630, 686.25 and 1313.25. Net asset taken over is 3000 minus this, 2313 and 1936. Purchase consideration, 2820, So first, purchase consideration, next, goodwill of capital reserve. So goodwill is 506 and 118. Goodwill has been calculated. Debentures, we have already calculated in our working capital. Okay, so this is as far as the workings are concerned. Then you have taken preference shares, you have considered this. Investment allowance reserve is to be maintained for 4 more years. So that 75 and 75 you will consider when you do, you have to prepare something called as amalgamation adjustment account, and there you will represent this 75 and 75. Revaluation reserve, general reserve and P&L will not be taken over. This also will be knocked off and fresh entries will come. Okay. Now preparing the consolidated balance sheet, as far as shareholders' funds are concerned, what happens is, first, you have to see how many shares are issued. So here, 4,50,000 shares for preference shares and 3 lakh shares for preference shares. So 7,50,000 shares for preference shares. 7.5 lakh, 7,50,000 shares for preference shares has been issued. This 7.5 lakhs, 100 is the face value, 60 is the securities premium. So 100 I will write under fair value, a face value, 60 I will write under securities premium. So 7,50,000, 16% preference shares of 100 each, 750. So here the shares will mention how many shares has been issued for consideration other than cash, because it is in the amalgamation, cash has not been received. So to that extent, we will mention in the note. Then coming to equity share capital. Now, equity share capital, if you see the last adjustment, they said balance also has been issued. So how many shares are there? 15 crores divided into share of 10 each. 15 crores. That is 1500 lakhs divided by 10. We have 150 lakhs shares. We have 150 lakhs shares. Out of this 150 lakhs shares, how many has been given to the existing company? 60 lakh shares and 45 lakh shares. So out of this 150, 60 lakhs has been given to first company, 45 has been given to second company. We have issued 105. How much is left? 45 is left. Now this 45 left has been issued to public. At what price? We can assume 35, because that is what has been given, considered for both the entities. So 45 into 35, if you do, you get 1575, more cash by this issue. 1575 cash. Okay, so that when you do the cash working, 45 lakhs into 35, this you have to consider here, because we have issued those shares. Now in the balance sheet, what will happen is, out of this 35, 10 out of this 35, 10 will be the face value and 25 will be your premium. 10 will be the face value, 25 will be your premium. All right. Now, if 10 is the face value, can I say 60 plus 45 plus another 45, entire 150 has been issued at 10, and for entire 150, securities premium is 25. So 150 lakhs equity shares of 10 each, 1500, and securities premium 150 lakh shares at 25, which is 3750, and preference shares 450. Total securities premium is 4200. Okay, is this calculation clear? Because all the equity shares have been issued, entire at face value of 10 each will be considered, and preference shares 7,50,000, 100 will be considered. In securities premium, entire 1,50,000, 150 lakhs and 750 lakhs for preference share. All right, that is the issue. Then that takes care of the equity share capital. When it comes to reserves and surplus, we have to take investment allowance reserve of this entity 75 plus 75, but that will be offset by amalgamation adjustment reserve 150 minus 150. So this basically becomes 0. 4,200 is the premium number. Then long-term borrowings 90 plus 45 at whatever value it has been issued, 56.25 and 28.15, that put together will be placed here. Trade payables will remain this. Okay. Then property, plant and equipment as it is. You have intangible asset that you will add, which is goodwill. So property, plant and equipment, intangible asset. Inventories, sum of the balance sheet. Trade receivables, sum of the balance sheet. Cash and cash equivalent requires working. What is the working? What was the company? Bright, dark and fair. So dark plus fair, cash balance. Then they have said some liquidation expenses have been paid. So dark limited and fair limited and dark limited minus liquidation expense of 9. So that has been incurred. You will reduce it. And 1575 is the shares issued. So this becomes the closing balance. Okay. Now this 9 has to be adjusted to goodwill, which is here 624.375 plus liquidation expenses 9, 633.375. Okay, that is how the goodwill number has been calculated and presented in the balance sheet. After that, remaining all items are simple and straightforward. Okay, so this is how you can do this question. Now here, what was tricky? Nothing was very tricky other than this new adjustment which says authorized capital is so much and we have issued the balance capital, right? Then apart from that, there is nothing significant for us to worry about in this particular question. Okay, then this one question we'll see, and then we'll go back to our study material. We'll take 2 questions from that. Okay. The balance sheet of Truth Limited and Myth Limited, they get really good names, As on 31st March 21 is given below. Myth Limited is to be amalgamated with Truth Limited from 1st of April of 21. Amalgamation is to be carried out in the nature of purchase. So this also they have said it is in the nature of purchase. Shareholders fund, share capital is given. So Myth is to be amalgamated. So Truth is buying Myth Limited. Okay. Shareholders fund is given, non-current liabilities 1,50,000 here, current liabilities so much, property, plant and equipment, investment, and assets. Notes have been given, share capital, reserves and surplus, non-current liabilities, trade payables, other current liabilities, inventory, trade receivable, cash and cash. Now, Truth Limited would issue 12% debentures to discharge the claim of debenture holders of Myth Limited so as to maintain their present annual interest income. So standard adjustment. Standard adjustment. Okay. So 12%. Current is how much? 14%. So what we will do? 1,50,000 into 14% divided by 12%. So 150 into 14% divided by 12%. If I do, I get 175. 175 the number. Okay. So see, this is a standard adjustment, and by now you should be aware that okay, I will handle this adjustment this way in the examination. Okay. Then non-trade investment, which constitute 80% of the respective total investment, yielded income of 20% to Truth Limited and 15% to Myth Limited. This income is to be deducted from profits while computing average profit for the purpose of calculating goodwill. Profit before tax of both the companies during the last 3 years are as follows. Okay, so what they're saying is you have some investment. Out of this, 80% are non-trade investment, and they are returning, they give us a return of 20% and 15% respectively. So while calculating goodwill, considering the profits, this profit on investment has to be removed or adjusted. So what we will do, we'll take this total profit, we'll take the average, and when calculating that average, we will remove the income from non-trade investment that is yielding to each of the companies. Goodwill is to be calculated on the basis of simple average of 3 years profit by using capitalization method, taking 18% as normal rate of return. So you will take total profits. Okay. Using that total profits, you will consider the capitalization rate of 18%. So you'll get to know how much capital is needed. That you will compare with the other assets, existing assets, and then the goodwill number. Ignore taxation. Purchase consideration is to be discharged by Truth Limited on the basis of intrinsic value per share. Prepare balance sheet after the amalgamation. Now here, what is the only challenge? The only challenge is this part. They have said Myth Limited is to be amalgamated with Truth Limited. Everything will be taken over based on intrinsic value. So first what we need to do is we need to calculate what is the intrinsic value. Okay. Now, for calculation of intrinsic value for the purpose of goodwill, first thing is what is the average profit? Average profit. So they have given us 1819, 1920, 2021, 3 years profit has been given. Okay. Sir, why are we calculating goodwill of Truth Limited? We are calculating goodwill of Truth Limited so that we will get to know what is the, excess amount or what is the intrinsic value. What is the intrinsic value of the shares? Okay. So 3 years total comes to 21,69,000 and 6,84,000. Average is 723 to 28. Now, from this, we have to remove the non-trading income. What is the non-trading income adjustment? The non-trading income adjustment is 80% of the investment is non-trade investment and it is giving 20% to Truth, 15% to Myth. So, on this investment, 187,500, 80% if I calculate, I get 1,50,000. On this 1,50,000, we are earning 20%, which means we are earning 30,000 of interest income. Now, this interest income is not by regular operating income. See, whatever we pay when we calculate goodwill, it is for operations, the operational synergies, brand, and all of that. Non-trade investment, you and I can also go and invest and make money. So 30,000 is for Truth. Same way if we calculate here, 80,000 into 15%. 18,000 into 15%, it becomes 12,000. So these two have to be removed. 30,000 minus 12,000. So what is goodwill? For calculation of goodwill, we need to do the capitalization basis. Okay. Now, what is the capitalization basis? What do we mean by that? Basically, 6,93,000 is your normal simple average of profit. 6,93,000 is normal profit. 6,93,000 is normal profit. Same way 2,16,000 is normal trading average profit. Now this is expected to give us 18% return. We are expected to earn 18% return. So to get 18% return, how much capital do we need? We need 6,93,000 divided by 0.18. We need 38,50,000. So what we are trying to say here is, if I need 6,93,000 of profit, how much of capital do I need? 693 divided by 18%. Okay. Same way, if I need 2,16,000 of profit, 2,16,000 divided by 18%, I need 12 lakhs of capital. That is the capital requirement. That is the total capital requirement. Now, this is the capitalized value of profit we have calculated. How much is the capital employed? Now, to calculate the capital employed, we will see the existing capital, that is total asset. We'll take the total assets. To calculate the capital employed, we'll take total assets minus non-trade investment, because we have excluded the income of non-trade investment while calculating the capital requirement. So non-trade investment should also be excluded. Then liabilities of debentures, trade payables have been removed and other current liabilities will remove. So we'll get what is called as the actual capital employed. This 1985 is nothing but, if you go to the balance sheet here, for this, if you have to calculate, if you see, here you have this share capital and reserves and surplus. This is 10 lakh plus 11 lakh, 21,35,000. From this, you will remove non-trade investment, 1,50,000. So 2135 minus 150, you get 19,85,000. This way also you can do the calculation. Basically, net worth minus non-trade investment will give you the net capital employed. Or you can take total assets minus the non-trade investment minus the liabilities, you get 1985 and 733. This is the actual capital. You need 3850 of capital, which means the extra amount of capital which we need, or the difference gap, represents goodwill. Okay, because this is the tangible assets that you see in the business. Balance 1985, 3850 minus 1985, you have 1865. This represents goodwill. So tangible assets plus goodwill 1865 will make the total capital of 3850. So here capital is goodwill is 1865 and here it is 467. So far clear till the time we have calculated goodwill? Okay. Now that gives us the goodwill value. Okay. Now to calculate the intrinsic value, what do we need is we need total of assets minus liabilities. Now here we don't have preference shares. Here in the share capital, we don't have preference shares. If there is preference shares, that also needs to be reduced. Okay. So after we have calculated that yes, our goodwill is 18,65,000. So what is the intrinsic value or net assets that we should consider? Okay, what you can do is, instead of going this detailed working, what you can do is, goodwill is 1865. Goodwill is 1865. Net assets that we have calculated here is 1985. So 1865 plus 1985 plus non-trade investment. See, non-trade investment was excluded for the purpose of goodwill calculation, but non-trade investment is my asset, so I should consider that, plus 1,50,000. So if you do this, goodwill plus net assets plus non-trade investment, 1865 plus 1985 plus 150 lakhs, you get net assets of 40 lakhs. Or if you want, take total assets as per the balance sheet. Take total assets as per the balance sheet, add goodwill, less liabilities, you will get the same number. What I'm telling you is how we can save time in the examination, because we have already calculated 1985 here. To this 1985, we just need to add this 1,50,000. We just need to add this 1,50,000. Okay. So 1985 plus 1,50,000 will become 1985 plus 1,50,000 will become 2135 plus 1865 will become 40 lakhs. So either ways you can do. You can do it basis the total assets add goodwill, or you can do it the basis of what we have done in the question. Or one another way could be, here take this 2135 plus goodwill, because that is the net assets. Okay. So 40 lakhs is the total value of assets divided by number of shares. If you do, you get intrinsic value of 40 here. Same thing if you repeat here, you get 31.37. This is the intrinsic value per share. Now, how do we discharge? How do we discharge based on intrinsic value? Basically, here you will see what is the total value. Total value is 31.375 multiplied by 40,000. Or this number 12,55,000 directly you can say this is the total value or total intrinsic value which the purchasing company Truth Limited will pay to Myth Limited. How much is that? 12,55,000. On this 12,55,000, we will discharge it by issuing shares at 40. So 1255 divided by 40, we get 31,375 shares. Are we clear on how did we calculate the shares to be issued? Yes. Others? Okay. Right. Now 31,375 shares are to be issued. Out of this, 10 will be the face value and balance 30 will be the premium component. So this bifurcation, you have to do it carefully, right? Now, after doing this, there are no other adjustments. We can prepare the balance sheet. Now, how to prepare the balance sheet? Share capital. Share capital, you will take Truth Limited 10 lakhs plus 313,750. So that becomes 13 lakhs, 13,750. Then coming to reserves and surplus. Coming to reserves and surplus. How much is the reserves and surplus? Reserves and surplus, if you see, you will take 1135 here, their original reserves and surplus, plus the securities premium, 941,250. Okay. Did they mention anything about export profit reserve? Okay, they have assumed that export profit reserve should be maintained. So you will add 185, then you will do minus amalgamation adjustment. All right. No, just a second. Yeah, they have added, so not 185, 25,000 of export profit reserve and amalgamation adjustment reserve of 25. You get 2076,250. This is an assumption that export profit reserve has to be maintained. Okay, that is why generally, because it's a statutory reserve. So how do we cross check? For cross checking, what you can do? Here we have 11,35,000, this number, plus securities premium 941,250, 941. I'm again doing it. We'll take 11,35,000 here, 11,35,000 plus securities premium 941,250, 941,250. You get 2076,250. So this 941,250 securities premium plus export profit reserve and original balance, right? That is your reserves and surplus. Then 12% debentures, which has been issued. What did we say? 14%, 1,50,000. At 12%, it becomes 1,75,000 that we had calculated. So 1,75,000 lakhs is the debentures. Okay. Then trade payables, other current liabilities, straightforward. Property, plant and equipment addition only. Goodwill as per working note number 1. So here we have calculated goodwill of 467. Now, while calculating goodwill here, one thing that you have to keep in mind is your 12% debentures. 1,75,000. Book value is 1,50,000. They have taken the actual settlement value of 1,75,000, and hence this is the value at which the liability has been incorporated. Okay. Then your trade payables taken over, other current liabilities, PPE, investment taken over 187, 1 lakh. Remaining part is simple and straightforward. And cash and cash equivalents also, your original balance of 95,000 and 1,05,000. Now, in this question, only thing that was tricky was first calculation of goodwill and then issue of shares. So, whenever you get these type of questions where shares have to be issued based on intrinsic value, what we need to do, we need to calculate net assets. Now, this net assets has to be calculated considering the existing values. So, sometimes the question may tell you that, okay, this asset has to be valued at this number. This liability has to be valued at this number. You will consider those values and do the calculation. Okay. So it is more about calmly handling these questions or these type of questions in the examination so that you get a proper hang of it. Okay. Right. Now, what we'll do is we have discussed a good number of questions this way. Now, what we'll do is we'll take 2 more questions from our material. And we will also have a quick discussion on the September 24th question. Okay. Yeah. So let's look at this question. Super Express and Fast Express were in competition. They decided to form a new company named Super Fast Express Limited. Summarized balance sheet of both the companies are given below. Okay. So you have Super Fast, liabilities, assets, asset. You can expect sometimes a question in this format being given in the examination, but your answer has to be in the Schedule 3 format. Okay. The assets and liabilities of both the companies were taken over by the new company at the book value. Companies were allotted equity shares of rupees 100 each in lieu of purchase consideration amounting to 30 lakhs. 20 lakhs for Superfast Express or Super Express? Super Express, not Superfast. Okay. And 10 lakhs for Fast Express. Prepare opening balance sheet of Superfast Express Limited. Simple question, but again, one by one, we have to see how things have to be dealt with and how do we prepare that in the examination. All right. Now, when it comes to this question, here, now the question comes whether we should consider it to be a purchase question or merger question. Now, see what they have said. Assets have been taken over. They have formed the new company. Of course, they will continue the business. They will continue the business. So you can assume that it is under purchase method, or you can also assume that it is in the pooling of interest method. Right now, this number of goodwill that you see when you take over or when the new company incorporates or when you calculate goodwill, you will not consider that goodwill number for the purpose of calculation. Okay. Goodwill you have to determine. Goodwill you have to determine separately. Goodwill you have to determine separately. You will not generally tend to add that goodwill when you are doing the calculation. You have to do it separately. You have to determine it separately. Okay. So here, if you see, if we assume that it is in the nature of purchase, if it is in the nature of purchase, what has happened here? You have to see what is the net assets taken over. What is the net assets taken over? 22,60,000 minus 1 lakh minus 60 minus 1 lakh. If you do, you get 20 lakhs. So this is the net asset. This is the net asset taken over. How much? 20 lakhs. Okay. How much has been paid? 20 lakhs has been paid. How much has been paid? 20 lakhs has been paid. Now, there may be a question in the examination, and in fact, when this question was originally asked, it was asked in 2000, year 2000. It's a very old question. The question did not give this number. The question simply said that we will issue shares at 100 each. Then what you will do? You will see what is the net asset. Net asset is so much, then shares were issued at 100 each, and that became 20 lakhs. That is how 20 lakhs number has come. And this goodwill was considered to be existing goodwill. So what was done is, net asset taken over, excluding goodwill. So 10 lakhs minus, see, this goodwill, 1 lakh, we will not consider as a part of asset taken over. Okay. So if you take 10 lakhs, and again, this reserve account of 1 lakh should not be considered. Okay. Then this surplus of 1 lakh also should not be considered because we are considering it in the nature of purchase. So these 2 lakhs are also not there. Okay. Here, these are different, there is nothing given on reserves here. But here, this 1 lakh and 1 lakh we need not consider. So what will happen is 12 lakhs minus 1 lakh. So basically 13 minus 1, 12 lakhs minus 60 plus 40, 1 lakh. You have 11 lakhs. For this 11 lakhs, we have issued 10 lakhs worth of share. So here, there could be a scenario of capital reserve being created as well. Okay. So that scenario is also possible if you are, taking this net assets of 6 plus 5, 11, 11 plus 1, 12 lakhs, whereas 100 is a liability, 1100 is the net asset. So there becomes a capital reserve scenario. So that scenario is also possible. Please understand that scenario is also possible. Okay. Now, while preparing, this opening balance sheet of Superfast Limited, here what they have considered or what they have assumed is it is in the nature of merger. Whatever I have explained you so far is in the nature of purchase. Okay. That is in the nature of purchase. But if it is in the nature of merger, then what happens? Then we will take all the assets line by line. And because it is merger, we'll take goodwill also. Because all the assets we have to maintain the individual identity of all the assets. We have to maintain individual identity of all the assets. So if you are assuming it is in the nature of merger, even goodwill has to be considered. If you are assuming it is not in the nature of merger, if you are assuming that it is in the nature of purchase, then this goodwill will not be there. In fact, you will get capital reserve on acquisition of this particular asset or this particular business. Are we clear? Okay. So merger means even goodwill has to be taken. Now, when you have this merger thing coming up, the thing what you have to do is the difference between this share capital and the share capital that you are issuing, that difference should be credited to reserves. Now here, this is also 20, issue is also 20, no difference. 10 lakhs, 10 lakhs, no difference. And the balance you can do the balance sheet total. All right. Now, I need a 5-minute break. After that, we'll do this particular question, and then we'll do September 24 question. And after that, we will start the branch accounting, which is again one of the most complicated topics which students find. We'll start off with branch accounting. Okay. Let's look at this question now. The next one. The following are the summarized balance sheet of P Limited and V Limited as on 31st March. Equity share capital, securities premium, foreign project reserve. So generally, we have to make a conscious call. Do we assume foreign project reserve as an amalgam, mandatory reserve or a statutory reserve? Because the term it says, one is like, for example, one is the case of that you have export profit reserve. Now, when would export profit reserve arise? Export profit reserve would arise when you have some exports to be considered and that you have to maintain. Here also, foreign project reserve indicates generally that, okay, you have carried out some foreign project, for that some reserve has been cleared. That is one thing that could be statutory. Or you can say, no, this is the company's internal foreign project reserve that did not be taken. Okay, depends on the question what they have given, or depends on the question that is being asked, right? We cannot have a standard number, standard thing. You can say, yes, this is related to a foreign project, foreign investment, so it should be taken forward. Okay. Then you have general reserve, P&L account, 12% debenture, trade payables, provisions, land and building, plant, furniture, inventory, trade, cash at bank, cost of issue of debentures. Now, this cost of issue of debentures is a fictitious asset. It is a fictitious asset, and what we should do is we should write that off. We should not consider, because it is not a, what do you call, asset that can be realized, or it is not an asset that can be actually transferred. Then all the bills receivable held by V Limited were P Limited acceptances. So here you have bills received. There is no bills receivable given. We'll see the number. Yeah, here is the number. Okay. So there are these bills receivable, which is worth 80. Which is worth 80. These bills receivable are held. These are acceptances of whose P Limited. Means in this bills payable, you have 120, and bills receivable, you have 80. These will offset one another. This will offset one another. On the 1st April 2012, P Limited took over V Limited in an amalgamation in the nature of merger. So they have themselves said it is in the nature of merger. It was agreed that in discharge of consideration for the business, P Limited would allot 3 fully paid equity shares of rupees 10 each at par for every 2 shares held in V Limited. So how many shares are there in V Limited? 10 each, 6,000 lakhs. So what you will do? 6,000 lakhs means 6,000 lakhs, 10 rupees each. That is 600 shares. So they're saying for every 2 shares held in V Limited, so 600, total number of shares in V Limited, for every 2 shares held, they will issue 3 fully paid shares of 10 rupees at par. So 600 divided by 2 into 3, this makes it 900 into 10, 9,000 lakhs. So the total purchase consideration that we have calculated is 9,000 lakhs. All right. Then it was also agreed that 12% debentures in V Limited would be converted into 13% debentures of P Limited of the same amount and denomination. See, the amount of the liability has to be same. Instead of 12%, I can give 13%. That's a different thing. So here the debenture value will be the same. Details of receivable and payables are given below. Bills payable 120, creditors 1080, 1200. Trade receivable 2120, 1020, bills receivable 80, 2120, and 1100. Okay. Expenses of amalgamation of 1 lakh were borne by P Limited. Who is P Limited? P Limited is the one who is acquiring. So they have incurred an expenses of 1 lakh. This we will debit to the reserves. You are required to pass the journal entries in the books of P Limited. Prepare P Limited balance sheet immediately after the merger. Right. As far as purchase consideration is there, we have already done it. Then journal entries. What should be the sequence of journal entry? First, business purchase to liquidate our 9,000 lakhs. How did we get that? We already calculated. Okay. Then incorporate assets and all the reserves in corporate assets, all the reserves, liability as it is. So here you have 5,000, 1,700, 4,041, all of that will come 5,000. Then furniture is 1750, 551, 1750. I think some, just a second, let me just check it. 5,000 plus 750 plus 4,041. Just give me a moment. Okay, I think this is not 1750, it has to be 1,700 only. I don't know how it could be a printing solution error. So it has to be 1,700 only as far as this number is concerned. Okay, then this cost of issue of debentures should be actually written off against the P&L balance. Or what you can do, you can add that cost of issue of debentures and then write it off against the P&L balance, or you can write this 50 off against this 825. Both ways it is possible. Okay, so what we'll do here is we'll add this line item, debenture issue cost 50. See the earlier explanation that I gave you for purchase purpose. Now this debenture issue cost 50 actually should be adjusted against this 825, whatever number you get, 825 minus 50. What you do, that should be the net amount of P&L that should be shown in the balance sheet. Okay, so this is the entry we have passed, and the difference, whatever is the difference, balancing figure. How do you get this balancing figure? Either do the total of assets, do the total of liability side, adjust it in the reserves, or what you can do is here reserves is 3,200. Equity share capital is 6,000. We are issuing 9,000 of equity share capital. So 3,000 to 6,000 is the equity share capital. 9,000 is what we are issuing. So we are giving 3,000 extra. This 3,000 extra is not goodwill. Whatever 3,000 extra we are giving, that will be reduced from this reserve. So you have 3,200 minus 3,000. You get 200. If this is confusing for you in the examination, what you can do is you can directly take the total of all of this, total of all other items excluding reserves, and this will become your balancing figure. Both ways are acceptable. I'm repeating once again. First is total reserves was 3,200. This 3,000 is basically 9,000 minus 6,000. That is one way to do. Second way to do is total all of this and adjust against this. Okay, and the balancing figure goes to general reserve. Right? Then issue of share capital 9,000. It is issued at par. Then you can directly say P&L to bank for liquidation expenses paid 1 lakh, or you can debit it to reserves. Then 12% settled by 13% of same value. Bills payable and bills receivable intercompany cancelled. So whenever there is an intercompany receivable payable, we will cancel that out. Now after the merger, what is the balance sheet? You will take equity shares of existing company 15,000 plus 9,000 issued. So this will become 24,000. Securities premium will remain at 3,000. There is no further adjustment. Then foreign project reserve as it is will come, because it's in the nature of merger. You will as it is pick up the book values of P Limited and V Limited and sum them up. When it comes to P&L account, we have 2870 plus 825. 2870 plus 825 minus liquidation expenses of 1 minus this 50, which is no longer required. So 2870 plus 825 minus 1 minus 50. I get 3644. So in the balance sheet, profit and loss account 3644. I'm repeating once again. This is basically P Limited plus V Limited minus liquidation expenses minus discount on issue. Discount on issue of shares should not be shown separately. Okay, that is one way. Or while passing this first entry itself, you should say that we will take over only 825 minus 50 and pass this journal entry. Okay. Then trade payables 1200 plus 463 minus 80. Why minus 80? Because there is a bills receivable, bills payable intercompany adjustment. Provisions 1830 minus 702 total. Land and building 6,000. Plant and machinery total. Furniture and fixtures as it is total. Inventory total as it is. Trade receivable this plus this minus 80. Cash at bank as it is total. Cost of issue of debentures will not be expected. And you will prepare the balance sheet. Any doubt? Any question? Okay. Right. Now, yesterday's what we're seeing, right? This question, we'll just quickly discuss this and then we will start with branch accounting. Question number 4. The following are the summarized balance sheet of Well Limited and Nice Limited as of 31st of March. Shareholders' funds, share capital reserves and surplus, non-current liabilities, current liabilities, borrowings, assets, all of this are given. Then the breakup is also given. Now we have 9% share, 10% share, differently. Balance of profit and loss. There is a loss. 9% debenture, 10% debenture, loan from bank. Details of trade receivable and trade payable, 6,200, 1,800. Bills receivable so much, trade payables so much total. On 31st March, Nice Limited absorbs the business of Well Limited on the following terms. Balance sheet is given on which date? It is given on 31st of March on the same day. Okay. Now, 14 marks, so many adjustments. 14 marks, so many adjustments, but they have just said record journal entries and balance sheet, so we have to do all the workings, everything. For every 5 shares held by the equity shares of Well Limited, they will receive 3 equity shares of Nice Limited issued at premium of 20 per share. What does that mean? Well Limited has how many shares? You have 12,500 thousands divided by 100. You get 125 or 1,25,000 multiplied by 3 shares of Nice for 5 in their company. So multiplied by 3 divided by 5 issued at a premium of 20. What is the current face value is 100. So this multiplied by 1. So if you do 1,25,000 into 3 divided by 5 into 120, that is 90 lakhs. Or if you want to present in thousands, it will come to 9,000. Okay. So that is the first part of the purchase consideration for equity shareholders. Equity shareholders 125 into 3 by 5 is 90 lakhs. Okay. Then 10% debenture holders of Well Limited were to be allotted such 9% debentures as will bring the same amount of interest. Same adjustment. Okay. What do we do? Existing income 10%. 900. So 900 into 10% existing income divided by 9%. This will become 1,000. Debentures 1,000. All right. Then 10% preference shares of Well Limited are to be paid at 10% discount by issue of 9% preference shares at par in Nice Limited. So 10% preference shares of Well Limited. 10% preference shares of Well Limited 1,800. So what we will do? 1,800 discount of 10%. So 1,800 discount of 10% means what? Minus 180. You are left with 1,620. At this value, this value, you will issue the preference share. Okay. Now, the purchase consideration is 1,620 and your 90 lakhs, 1 crore 6 lakhs 20,000. That is the total purchase consideration. Okay. Then banks agreed to waive off 270,000 of Well Limited. So where is bank? Bank is 4,525. Out of this 270 is waived off. So that is the value at which you will incorporate. Then expenses of Well Limited are to be reimbursed by Nice Limited 55,000. Who incurred? Well Limited incurred. Who will reimburse? Nice Limited will reimburse. Nice Limited will reimburse. Okay. So Nice Limited, when they reimburse, this expense will be debited to goodwill or capital reserve as the case. Inventory of Well Limited is taken over at 10% more than the book value. So whatever is the book value, we will add 10%. Debtors of Nice Limited include 215 receivable from Well Limited. This is cancelled after absorption. PPE are revalued at 20% above their book value, increase it by 20%. Remaining assets are taken over at book value. So apart from the assets that we mentioned, remaining will be taken over at book. Prepare the journal entries and prepare the balance sheet. Very simple question. Now journal entry first, this we will do for business purchase account. Then PPE 20% more, this number. Inventory 10% more, this number. Trade receivables 1950. 1950. First you will incorporate the total, then you will do the net off. Okay. Then trade payables 4850, debenture holders 1000, bank they said 270 will be waived off, so 4255. Short term borrowings 1975 to business purchase account 10,620. Just cross check if we have taken everything. That is very important. Okay, so long term borrowings we have taken, trade payables we have taken, short term borrowings we have taken, PPE we have taken, inventories taken, trade receivables taken. That's it. Right? So this is done. Then to the liquidator of Well Limited, we will issue equity shares, we will issue preference shares, including the premium component. That's how we'll record. So debit liquidator of Well Limited, we are issuing them shares. Equity share capital 100, 20 is the premium. Preference share capital at par value, that is 1620. Debenture holders will be settled by issuing 9% debentures. So existing 10% debentures will be settled by 9% debentures. Intercompany cancelled, and liquidation expenses you will debit it to goodwill account. Okay. Now, after this, what is left? The balance sheet. In the balance sheet, share capital, you will take existing share capital plus issued share capital, equity share capital, preference share capital. In the reserves, existing reserves plus your premium. Then long-term borrowings as it is will take plus the acquired entity, PPA original entity plus acquired entity at revalued amount. When we did the journal entry, here the balancing figure is goodwill 137 and 137 plus here we have 55. So 137 plus 55, it becomes 192. Okay, then non-current investment, inventories, trade receivable, cash equivalents. Trade receivable, here you take care of the adjustment, and trade payables, so you need to take care of adjustment. And in the working note, equity share capital mandatory. And yes, very important to note, the out of so many shares, these many shares are issued for consideration other than cash. That has to be written properly, neatly. Reserves and surplus, long-term borrowings as it is, trade payables minus intercompany adjustment. Now, this, if you don't have sufficient time, what you can do is in the balance sheet phase itself, you can directly say 15,740 plus 4,850 minus 215 because you may be short of time. Okay. Same thing, PPE, goodwill, already we have discussed. Inventories, you can directly do the total on the face of the balance sheet. Okay. Trade receivables, again, you can directly do the total on the face of the balance sheet. Cash and cash equivalent, this is on the assumption that it has already been reimbursed. That is how we have calculated. Okay. So what I'm saying, suggesting is inventories working note, trade receivables working note, cash and cash equivalent working note, PPE working note. Because it's a longer question, you can do it here itself. Breakup of marks. 1 mark, 1 plus 2, 3, 3 plus 1, 4, 4, 5, maybe 5.5 around here. This is 1 mark, this is 1 mark. Okay, then 3 plus 2, 5 plus 3, 8 plus 11, this will be about 3 marks. So 3, 4, 5 plus 5, 10, 10.5. Okay, 10.5 and remaining your some 4 marks for your working note. Slightly lengthy question. So these adjustments, you can directly do it in the face of the balance sheet also. No need to prepare a separate schedule because it is a longer question. Okay. Now, we have discussed enough number of questions, around 8 or 9 questions we have discussed. We have discussed various different scenarios. Okay. After this discussion, what I want you to do or what you can go back and do is from the compiler, pick up other questions that you have not done in the class, solve 3 to 4 questions on your own. That will give you immense confidence in this particular chapter. Okay. And do you think after this, it went off for about today 1.5 hours plus yesterday 1.5 hours, around 4 to 5 hours of discussion. Do you think amalgamation, the comfort on handling amalgamation questions have improved? Or you think we need to do more questions? Or with our discussion so far, you can go back and practice questions on your own? Can you just let me know in the chat box? And then after that, we'll start off with branch accounting. Yes, please. All clear? Yes, of course. Self-practice is needed. See, I can solve 20 questions in the class. And you will feel, oh, this is also easy. That is also easy. This I can manage, that I can manage. What I'm simply saying is, don't try to go overboard and solve 50 questions. Take at least, okay, simple way, if I have to ask you, if I have to tell you, we discussed September 24 paper, right? We discussed other previous year paper also. Just take these question papers, last 3-4 attempt question papers and 3-4 attempt RTPs, and solve question on amalgamation. You will be able to. Okay. So with this, we conclude amalgamation, and we will move on to branch accounting, which is again a thing where we face a lot of students face a lot of challenge, because the chapter itself is very vast. So we'll start branch accounting, and we'll proceed on that. Good morning once again, and today, as a part of our marathon, we will start with one of the most important chapters again, that is consolidated financial statement. Now, this has been tested almost every attempt, and there is no exception to it. Just that in the September 24 attempt, they didn't ask the full balance sheet, but it is a very, very important chapter as far as examination is concerned. 14 marks is a definite question, plus another 2 to 4 marks you may get in terms of MCQ. And we should not be scared of this chapter. We should learn it in a way such that we are able to score maximum in this particular chapter. Out of 14, I'll tell you the breakup of marks and how we can score at least 10 to 12 marks easily in this particular chapter. Now, typically, when it comes to consolidation question in the examination, we will have a question like, there are two companies, A, B. Balance sheet of both the companies are given with some assets, liabilities, and equity. Here also we'll have assets, liabilities, and equity. And the question would be to combine these two entities and prepare a consolidated financial statement. That is what is a requirement of the question. All right. Now, when they say prepare consolidated financial statement in examination, they want us to prepare balance sheet. This typically accounts for 3 to 4 marks. Then we will have working notes. I'll come to each one of the working notes. Working notes generally will have 4 to 5 marks. And then we'll have notes to accounts. Unless the question says prepare balance sheet without notes to accounts, we will prepare notes to accounts, and notes to accounts will have about 4 to 5 marks depending on the structure of the question. Now, the best thing is, because we have stepwise marking, we can score good number in balance sheet and notes to accounts, even if some of our working notes are wrong. So even if you get a question where one adjustment might be tricky, we should focus on attempting this question. Even if you want to attempt it towards the end, you should attempt this question, because here out of 3 to 4 marks, 2 to 3 marks is easily scoreable. Here also you can score 2 to 3 marks easily just by preparing the balance sheet and notes to accounts because of stepwise marking. Okay. Now, coming to the question in the examination, how we should approach this particular question on consolidation. So we have a balance sheet of two entities given in the question. First thing, we need to decide what is the payment done, or what is what we call as purchase consideration, which is made by the holding company to the subsidiary company, or to the owners of subsidiary company, or to acquire the subsidiary company. This is the first step we need to do. Now, this will be given to you in the question, so no need to worry about that. Right? Then, second thing that we need to do is compute the net assets or equity plus pre-acquisition reserves. So typically what happens is, we have a holding company, we have a subsidiary company. Say for example, holding company has 75% stake in subsidiary company. Means holding company can make decisions on behalf of subsidiary company. Holding company can get subsidiary company to do certain things. So the 75% holding, whenever it is there, we say H controls S. H controls S. Now, when 75% is held by H, what about the balance 25%? This balance 25% is held by something called as minority interest. Minority interest. All right. Now, H to acquire S will make certain payment. Assume for a moment the payment is 10,000. How to do and all of that, we'll come with specific questions and we'll discuss in that. H made a payment of 10,000 to acquire, let us say, 75% of S, and the net assets on the date of acquisition, of S is say 12,000. Is how much? 12,000. So what has happened? H has 75% control over S. H paid 12,000 to acquire 75%. Sorry, H paid 10,000 to acquire 75%, and the net asset on the balance sheet is net asset on the balance sheet is 12,000. Net asset on the balance sheet is 12,000. Now, S net assets on date of acquisition is equal to 12,000. This represents 100%. This represents 100%. Whereas our share, the holding company share that we say, so S has net asset on the date of acquisition, the net asset of S is 12,000. This represents 100%. Now, how much does holding company control? Holding company has 75%, minority interest has 25%. So what do? Out of this 12,000, we say that 75% belongs to the holding company. 75% belongs to the holding company. So 12,000 multiplied by 75% when I do, we get 9,000. So as on date of acquisition, H has 9,000 worth of interest, or H has net asset worth 9,000 in S. Or we can say, if S has to liquidate, H will get 9,000. Now for this 9,000, how much did we pay? We paid 10,000. So if payment is greater than net asset, what do we get? We get something called as goodwill. We get something called as goodwill. And just a minute. And if payment is less than net asset, we get something called as capital reserve. Same concept we have learned in amalgamation also. So if we have payment which is more than net asset, means the other party is worth let us say 12,000, out of which I have share of only 9,000, but I still paid 10,000. That 10,000 minus 9,000, this extra amount is called goodwill of 1,000. This is the most important step in your examination. This is the most important step in your examination that is dependent on first and second step. Now that is where we have to pay more time on. So what you will do? You will check the payment, you will calculate net asset or equity plus pre-acquisition reserve on the date of acquisition. That is the second thing. After you are done with this, the third step, as we did, we will calculate goodwill or capital reserve. Then after that, we'll calculate what is the balance of something called as minority interest. So typically what happens is, we said assets minus liability, net asset is equal to, in this case, 12,000. Out of this 12,000, 9,000 belongs to shareholders of holding company, or you can say it belongs to holding company. Okay. Then the balance 3,000, this balance 3,000 belongs to whom? This belongs to something called as minority interest. Means the holding company, the company which controls, it has your 9,000 of interest, and minority interest is controlling 3,000, or minority interest says, I will take 3,000. So out of the net assets, I mentioned here, out of the net assets of the subsidiary, 12,000 is out of the net asset of subsidiary of 12,000, 9,000 is owned, or 9,000 is the ownership or the net asset belonging to holding company. 3,000 is what is belonging to minority interest. So next step, we will calculate minority interest. Here we will also need to check post-acquisition reserves that will come to subsequently. Then we need to calculate something called as consolidated P&L balance plus the reserve balance. Then we need to eliminate intra-group transaction, also unrealized profit, and very important, revaluation adjustment. After this, we just need to add balance sheets of A and B to get to the consolidated financial statement. Now, in this, the reason why I've noted down these 7 or 8 steps. Now, you might have learned it in a different way. Institute has maybe 6 steps. Your faculty would have taught you 9 steps, 7 steps. The only thing is there has to be a framework. So quickly know the payment, decide how much is the net asset on date of acquisition. This is very important. Then calculate goodwill. We'll calculate minority interest. I will come to each one of this. Then consolidated balance of P&L. This is holding plus subsidiary post acquisition. Eliminate intra-group transaction, unrealized profit, any revaluation adjustment, and add balance sheets of A and B. If you are able to do this for 3 or 4 questions comfortably, consolidation will not be a challenge. Now, when we combine the balance sheet, holding company has assets, liabilities, equity, share capital, reserves. Subsidiary company has, and here we have investment in subsidiary. Subsidiary has equity, share capital, reserves, assets. Okay. Now, how do we add the balance sheet? For assets, you will take 100% of A holding and 100% of subsidiary. Means assets will be 100% of A and B. This is subject to revaluation adjustment. So which revaluation adjustment? Revaluation adjustment as on date of acquisition. That's the first thing. Then liabilities also, this also will have some liabilities. You will take 100%. So liabilities also, you will take 100%. Okay. Then equity share capital, you will take 100% of holding plus nil from subsidiary. Subsidiaries share capital, you will not consider. Reserves, you will take 100% of holding company plus out of this reserves, we will prepare one working note called as analysis of reserves. What we will do is we'll split this between pre and post. Pre and post. Whatever is there in pre, that you will not consider. Whatever is there in post, that you will consider. So 100% of H plus post acquisition profits from S. That is only with respect to H share. So if H has 75%, we will take 75% of post acquisition profit of subsidiary. Then what about balance 25%? That balance 25% will add it to something called as minority interest. So what will happen is out of these reserves, whatever is the post acquisition, pre acquisition, the one which belongs to the minority will be added as a separate line item called minority. So you'll have minority interest. You will take whatever is the share, 25% of equity share capital plus reserves. That is what is a minority interest, right? So this reserves will split between pre and post, and again that will split between holding and minority. That is what we will do. Then investment in subsidiary and this equity share capital and pre-acquisition reserve. So what will happen? We have investment in subsidiary. We have investment in subsidiary. This, whatever we paid, in our case, it was 10,000. This will be knocked off against equity share capital and pre-acquisition reserve. Now, equity share capital and pre-acquisition reserve is equal to your net asset. That net asset was 12,000 in our case. So what you will do, 10,000 you will not take. This investment will not come. Out of this 12,000, 9,000 will be knocked off against the investment and 1,000 will come as goodwill. So here you will have goodwill component. So what about 3,000 of minority interest? That will be added to the interest. So this is how you'll combine the balance sheet. Even if you are not able to do adjustments because of shortage of time, just by combining the two balance sheets quickly, even half of the balance sheet, 2 to 3 marks you can easily score. Any questions so far? No question. Okay. Now, first step, as I told you, payment is very clear. Second step is analysis of reserve. Now, what is this analysis of reserve? Basically, if you look at the balance sheet in shareholders fund of S, you are just looking at reserves of subsidiary. So whatever reserves subsidiary has, what we need to do is we need to see what is the pre-acquisition amount and what is the post-acquisition amount. Okay, so for example, you have P&L balance, you have general reserve balance, all of this, how much is pre-acquisition and how much is post-acquisition. All right, that is one thing. Now, as far as pre-acquisition is concerned, either the question will tell you that on date of acquisition, P&L was some 1000, reserves was some 2000, for example. They will tell you directly. In that case, what we will do, let us say we have the total balance on date of balance sheet. This is 5000, this is 3000. The question itself told you that pre-acquisition reserve is 1000 and 2000. So what we will do, 1000 here, 2000 here. So total balance is 5000. Out of 5000, 1000 is pre-acquisition. So 4000 becomes post-acquisition. 3000 was general reserve, 2000 is post-acquisition, pre-acquisition, 1000 is post-acquisition. So this 1 plus 2, 3000, this becomes a pre-acquisition, and this 5000 becomes post-acquisition. Now here, one tricky point where a lot of students make mistake is dividend adjustment, especially when the investment has been made during the mid of the year. So that when we do a question, I'll tell you how to handle that. For now, just understand this. 3000, 5000, pre-acquisition, post-acquisition. Now, what you will do, what is holding companies? What is minority interest? Holding company say 75%, minority interest say 25%. So 2250 is holding share and 750 is minority interest. Same way, out of this 5000, 1250 is minority interest and 3750 is holding company. Now, once you have done this table correctly, just a moment, again, I need to charge the pencil. Once you have calculated that, holding company share in the pre-acquisition is 2250, post-acquisition is 3750, minority 750, and post-acquisition 1250. What we'll do is this component of 2250, which is pre-acquisition profit, what we'll do, we will take it to some working note called as cost of control, basically to calculate goodwill or capital reserve, whatever is the pre-acquisition. Then whatever is the post-acquisition 3750, this will be added to P&L. What do I mean by that? This 3750 will be added to our consolidated reserves, and the pre-acquisition profit will be considered in determining the net assets on date of acquisition or here. Okay, so that is how you will split. Then whatever is left, this 750 and 1250, these two, what you will do is 750 and 1250, these two will be added to minority interest balance. Okay, so that is how we will calculate what is the pre-acquisition profit, what is the minority interest, what is the post-acquisition profit, and that we will use to compute the goodwill. This you have to do it very, very carefully. If you are lucky, they will give date of acquisition, P&L and reserves. It is straightforward. If at all, they give mid-year acquisition, that is where we have to do certain adjustments and see how to compute that. That we will do, with the question instead of just putting it into theory. That is what we will do at analysis of reserve. Now, after we have done analysis of reserve, net asset on date of acquisition is nothing but equity share capital of subsidiary plus pre-acquisition reserve. Now, for calculation of goodwill, when we have to do, what we will do, we will see what is the H limited share in equity share capital, what is H limited share in pre-acquisition profit. Here we'll do a total. In our example, we assumed this was 9000. Then what is the purchase consideration or payment made? That was 10,000. Because we paid more, that results in goodwill. 10,000 minus 9,000, 1,000 is goodwill. 10,000 minus 9,000, 1,000 is goodwill. With this, we'll be able to compute the goodwill. As far as minority interest is concerned, minority interest is equal to 25% of equity share capital, 25% of pre-acquisition profits, and 25% of post-acquisition profits. Pre and post. That is how we will do. Okay. Now, when it comes to consolidated reserves, we will take 100% of holding plus 75% of post from subsidiary. Right. Then there are two very critical adjustments, in fact, three actually, but one of that intercompany you can handle easily. Then what we will do, we'll carry out some adjustments called as intercompany balances. Intercompany balances. Now, what is this intercompany balances? Let us say H Limited has to pay 10,000 to S Limited. H Limited has to pay 10,000 to S Limited. Now, in H financial statement, you will have trade payable 10,000. And in subsidiaries financial statement, you have trade receivable 10,000. Now, when we are preparing consolidated financial statement, basically we are preparing holding plus subsidiary as a family. Holding plus subsidiary as a family. Correct? Now, when we are preparing holding plus subsidiary as a family, this trade payable is holding to subsidiary. Subsidiary says, I have to receive 10,000. Now, when you prepare holding plus subsidiary as a group, will you go out and say that, the parent has to pay something to the subsidiary, or children has to pay something to the parent? We will not do that. So we'll cancel out these two, 10,000, 10,000. Now here, one specific adjustment sometimes comes in terms of bills payable. They would say bills payable of subsidiary is equal to 10,000 to holding. But in holding company's book, bills receivable of holding shows only 2,000 and 8,000 has been endorsed or discounted. In that case, what do we do? Total bill payable of subsidiary is 10,000. Holding had 10,000, but holding what they did was they have only 2,000. They transferred 8,000 to some other party. So as far as the group is concerned, this 8,000 is outside the group. This 8,000 is outside the group. So what we will do? What we will do is we will take 10,000 total bills payable. Out of that, 2,000 of bills receivable that we have to pay to the holding company, we will adjust that. So net bills payable will be 10,000 minus 2,000, that is 8,000. This is 8,000 which has to be paid to outsider. So if at all there is an endorsement, if at all there is discounting with the bank, you will adjust the portion which the holding or the subsidiary has. So for examination, bills payable will be equal to balance minus bills receivable held by another party. Same way for bills receivable minus whatever is held by the, or whatever is due to the other party. Balance you will still show. So in our example, 10,000 was the total balance, 2,000 is with the holding, 8,000 is still bills payable in the financial statement or in the balance sheet. That is one adjustment. Then we have an adjustment of unrealized profit. A lot of time what happens is holding company sells goods to subsidiary, or subsidiary company sells to holding. Okay. Subsidiary can sell to holding, holding can sell to subsidiary. In technical terms, this is called downstream, coming from up to down, and this is called upstream. And what we are interested in is, if holding sells to subsidiary, let us say cost is equal to 10,000, selling price is equal to 12,000. Now, subsidiary company would say, my inventory my inventory is how much? It is 12,000. My inventory is 12,000. Subsidiary company says my inventory is 12,000. But when I'm preparing holding plus subsidiary as a group, as a family, I cannot say my inventory is 12,000 because the cost of my inventory is 10,000 only. The cost of my inventory is 10,000 only. So what we say, in consolidated financial statement, inventory should be shown at 10,000 only. But as per our discussion, if you understand earlier, we take 100% of holding plus 100% of subsidiary. So here we'll have 12,000. This 12,000 cannot be shown at 12,000. We have to reduce the unrealized profit and show it at 10,000 only. Show it at 10,000 only. So what do we do with this unrealized profit? This unrealized profit will be removed from the consolidated P&L. This unrealized profit will be removed from consolidated P&L. So 12,000 minus 2,000, 10,000 will be shown and 2,000 will be the unrealized profit, which will be removed from the consolidated P&L. All right. Now, students' confusion would be, sir, when holding sales, what is to be done? When subsidiary done, what is to be done? And should we adjust it from minority interest? Should we adjust this from minority interest? That is one more question or one more doubt. Now, what you have to understand is who booked the profit? What you have to understand? Who booked the profit? If holding booked the profit, you will reduce from reserves of holding only. If subsidiary booked the profit, means if subsidiary sold it to holding company, then you will adjust it from post acquisition profit. Automatically, minority interest will also get adjusted. Automatically, minority interest will also get adjusted. All right. So far clear? I always get confused between pre and post, but now it is clear. Okay, very good. That is the purpose of this revision. You should get 100% clarity. Okay. Now, one last critical adjustment before we take up questions is that sometimes what happens is we carry out revaluation of assets on date of acquisition. So what do you mean by that? Say, for example, this is the subsidiary balance sheet. We have assets of 10,000. Assets of 10,000. Now, for the purpose of consolidation or when we have acquired, H Limited has agreed that these assets will now be considered to be worth 12,000. So what H Limited is saying is that these assets going forward or for our purpose, for consolidation purpose, for acquisition purpose, it is 12,000. S continues to show it at 10,000. We are not doing revaluation as per accounting standard 10. S will continue to show it at 10,000. What H would do is, H would say, for my purpose, for my acquisition purpose, my number is 12,000. Okay, no problem. Now, this will have two impact, and you have to remember this. Every alternate question gets this adjustment. Every alternate question, we have this adjustment, and we should not be struggling for that. Okay. First thing what happens is, I have something called as net asset on date of acquisition. On date of acquisition, I have net asset or equity share capital plus reserves. Equity share capital plus reserves. This is as per balance sheet of S. So, for example, just for argument's sake, there are some other assets, or let us say there are some liabilities of 2,000. So, net asset is 8,000. Net asset is 8,000. But what is H telling? H is saying that for my consolidation purpose, for my acquisition purpose, this is not 10,000. This you should consider at 12,000. So, my net asset will now become 10,000, 12,000 minus 2,000. This has to be adjusted. So how to adjust? See, first thing what you have to do is when you calculate this pre-acquisition reserves, or when you calculate the goodwill component here, you have to add revaluation of asset. You need to increase. So basically what you will do, here you will add revaluation of 2,000. You will add. We'll see with the question. If you now understand the format, we'll see with the question. Here you will add revaluation of 2,000. What will happen because of that? Net asset will increase. Net asset will increase. And when net assets increases, what happens? Our goodwill value will come down. That is the first thing. That is the first thing. Okay. That is the first thing. Second thing what happens is When we are preparing consolidated financial statement, we will not take asset at 10,000, we will take subsidiaries asset at 12,000. Subsidiary will continue to show or calculate at 10,000, but for consolidation purpose, we will say those assets are worth 12,000. Those assets are worth 12,000. That is one more thing, right? Then, because this asset are worth 12,000, I have increased the value of asset. Should my depreciation not increase? So my depreciation should increase. By what number? There are two types of again adjustment. One is mid-year acquisition and one is beginning of the year acquisition. Depreciation should be increased, or on the 2000 I should charge extra depreciation. Let us say at 10%. So this becomes 200. In the consolidated financial statement, one adjustment is we should increase the value of asset by 2000. Second adjustment is we should charge extra depreciation on that amount, which works out to 200. So in the consolidated financial statement, in the balance sheet, asset value will go up by 2000 and accumulated depreciation will be shown at higher value by 200. So net impact is 1800. Now, because I am charging more depreciation, my P&L balance should also reflect that. So in the post-acquisition column, for this 2000, I will charge depreciation of 200, which will be split between the holding and the minority. Okay, this is one adjustment which keeps coming up in the examination. Any doubt on this? Of course, I will take a full-fledged. Now we'll now jump to questions and see how do we handle those questions in the examination. Now, when we look at some questions, what will happen is you will get that confidence of answering these questions in the examination. Okay. Now look at this question, May 24, 14 marks question. Now we'll see what are the tricky points we need to take care of, when we are handling this question and how we can score maximum marks. Okay. The balance sheet of Art and Craft Limited as on 31st March is given below. So that is what we have understood. That is what they will give us. Then you have share capital reserves, trade payables, short-term borrowings, PPE, non-current investment, inventory, trade receivables, cash and cash. Okay. This is just moved upwards. Share capital breakup has been given. Reserves breakup has been given. Short-term borrowings has been given. PPE, building and plant machinery. Non-current investment in craft at cost 4,32,000. So here you have 4,32,000. That is what? Non-current investment, art into craft. Art into craft. Now, this 432 is the first thing that I told you, how much payment has been made. This is what is relevant for our calculation purpose. This is what is relevant for our calculation purpose. Then, Art Limited acquired 3,200 ordinary shares of Craft Limited on 1st of October. This is a mid-year acquisition. When there is mid-year acquisition, we have to be extra careful in calculating the pre-acquisition and post-acquisition profits. The reserves and surplus and profit and loss account of Craft Limited showed a credit balance of 40,000 and 58,700 on 1st of April. So they have given us information on 1st of April of 23 balance. They have given us information of 31st March of 24 balance, but acquisition happened mid-year. So what we need to do is we need to calculate profit earned during this period and profit earned during this period and accordingly split between pre and post. The plant and machinery of Craft Limited, which stood at 2,50,000 on 1st of April, was considered worth 2,20,000 on the date of acquisition. Now, in the example that I gave you, there was upward revaluation. Whereas in this case, what you can see, there is a downward revaluation. There is a downward revaluation. All right. Now, when there is a downward revaluation, what will happen? We will reduce the value of PPE. Now, when we reduce the value of PPE, the other thing that happens is the depreciation part will also be reduced. If it is upward revaluation, PPE value will increase, depreciation value will increase. If there is a downward revaluation, the PPE value will be reduced and depreciation will also be reduced. Okay. Now here, if it is mid-year calculation, one more thing you have to keep in mind, don't take the difference and directly compute 5%. It will not give you the correct number. You have to do the balancing figure computation. Kraft Limited deducts 1% from trade receivable as a general provision against doubtful debt. This is not followed by Art. Now, one of the requirements of Accounting Standard 21 is that if there are differences in accounting policies, we have to take the accounting policy of the holding company. We have to take the accounting policy of holding company. So who is deducting? Subsidiary is deducting, holding is not deducting. So this has to be added back. On 31st March, inventory includes goods which it had purchased from Art Limited for 1,03,500, which made a profit on 15% on cost right. This is unrealized. So 4 adjustments have been given. Okay. Now, you are required to prepare consolidated balance sheet on 31st of March of 2020. Now, how do you solve in the examination? First full page, leave it for balance sheet. The next 1.5 page or 2 page, leave for notes to accounts. Then, after that, you can put the working notes. Now, if you want, you can put the working notes in the beginning also. It is up to you. So, when I was a student, first I used to prepare the working notes and then I used to go to the preparation of balance sheet and notes to account. But if you have been used to like, first we will purchase, we will prepare the balance sheet, then P&L, then we'll do the working notes, that is also fine. Both approaches are acceptable. Okay. Now you'll leave that page, and when you prepare the balance sheet, there generally, if balance sheet isn't given in your schedule format, same format you can use, no problem. Mandatory notes for share capital, reserves and surplus, compulsory. Minority interest, you will have working notes. Okay. Then trade payables, inventories, trade receivables, here in the bracket itself, you can do the working. No need to prepare a separate notes because that will take more time. You can do working like this. For PP also, mandatory notes to accounts. So these 3 are mandatory. And the remaining part, if there is goodwill, because here you don't have goodwill heading, so here you'll have intangible assets, that also you'll need to prepare a separate notes to. Okay, that is the format. Now, first thing, coming to working note, the question says 3,200 shares. Out of how many shares? Out of, we have shares of 4 lakhs, that is 4,000 shares. So what is the percentage? Percentage is 80%. 80% is held by Art and 20% is held by what we call as minority interest. That is the first thing. Then in 99% of the questions, what you will get is you will get, and you have to do analysis of profit. Sometimes they may say the balance sheet on date of acquisition, but I have not seen so many questions on that. So you'll have questions with equity, share capital, and reserves on the date of acquisition. That is what you need to calculate. Now, here, one very important thing, we have P&L balance of 1st of April and we have P&L balance of 31st of March. In that situation, what we will assume is whatever is the difference after adjusting for profits, that difference is profit for the year. That difference is profit for the year. And this profit has been earned equally or evenly throughout the year. What do I mean by that? Here we have 40,000 and 58,700 on 1st of April. So what you can do? Either you can prepare a ledger balance or a ledger account like P&L account you can prepare and general reserve account you can prepare, where you will say by balance brought down. P&L opening balance is 58,700. Balance carried down is 2,08,000. So the balancing figure 1,49,300 is profit earned during the period. If there is some dividend paid, dividend also will be debited to P&L. If there is some transfer to reserves, that will also be debited to P&L. And this 149,300, in this case, the difference between these two balances is the profit earned during the period. If there are no adjustments, you can do the statement format. If there are adjustments, I would suggest you to prepare P&L and general reserve account. Have opening balance. Now here opening balance is 40, closing is 40, means no movement in general reserve. There is nothing which is earned during the period or transferred during the period. But if 40 became 60, we can assume that 20 has been transferred to P&L. That 20 again you will debit to P&L and the balancing figure will be profit. That is how you will work out. Okay. If there are more adjustments between P&L and general reserve, try to prepare the P&L account in ledger format. The mistakes that you will do will actually reduce. Okay. If you try to prepare in statement format, a lot of time there can be mistakes. Now, when you prepare in the statement format, what you will do is you will take opening balance plus you will, for reserves, transferred from P&L Then you will compare that with closing balance. Difference is post-acquisition reserves during the period. Same way, P&L. What you will do? You will take opening balance, then add profit is not given, so it will be less only, less dividend paid, less general reserve. This you will compare with closing balance. Difference will be the profit for the period. But I would prefer P&L in statement format, but I'm not asking you to do the same thing. Up to you whether you want to prepare statement or whether you want to prepare check. Okay. Now this profit is what during the year profit. This profit is what during the year profit. What are we interested in? Because it is a mid-year acquisition, we need to know how much is the profit which is earned in the first part of the year and how much is the profit which is earned in the second part of the year. All right. Now, if you see here, this 40,000 is your pre-acquisition only, and profit earned between 1st of April to 30th of September, that is also pre-acquisition. Same thing is in case of P&L as well. All right. So how much is profit earned for 6 months period? Profit earned for 6 months period is 74,650 and 74,650. Sir, how did we get this? 74,650 and 74,650 is basically 1,49,300 divided by 2. 1,49,300 divided by 2. This is pre-acquisition. This is post-acquisition. Then this opening balance of 40,000 and 58,700. Opening balance as on 1st of April, that entirely is a part of pre-acquisition. That entirely is a part of pre-acquisition. That is one thing. Okay. Now, some of you may be used to doing like, here you have general reserve, here you have P&L. So what you do is, you would be doing in a particular format like, you have pre, you have post. Whatever is the opening balance of, let us say, for example, P&L. Opening balance is how much? 58,700 is anyways pre, and post acquisition, or in the current year, you can say current year. Current year also there are two components, pre and post. So current year profit is 149,300. Out of this, you would say 74,650 is pre, 74,650 is post. Okay. When it comes to general reserve, opening balance is 40,000. Entirely it is pre. Entirely it is pre. So if you are doing in this format also, it is perfectly fine, no problem at all. Okay. Then coming to adjustments, adjustments is where we tend to miss out things. One is they have said you have 1% trade receivable deduction, and second is plant and machinery revaluation. Okay. Now 1% deduction of trade receivable provision. What is the trade receivable balance? Trade receivable balance is 168,300. This 168,300 is after deduction of 1% provision. After deduction of 1% provision means this is 99%. This is 99%. So how much will be 100%? You will simply do 168,300 divided by 99%. If you do, you will get the number. So 168,300 divided by 99%, it is 170,000. Okay. Now 170 minus this provision is 17. This provision we have to write back. This provision we have to write back. Write back means what? It will increase my profit. Now out of this 1,700, 850 is for the 6 months before acquisition and 850 is 6 months post acquisition. So we will add back provision of 850 and 850 both in re-acquisition as well as post acquisition. Then revaluation loss, the question has told us that there is a machinery which stood at 250,000 on 1st of April. We need to know the number on 1st of October. What is this number? 250 on 1st of April. So on 1st of April, the balance is 250,000. What is the depreciation? 10% per annum or 5%. So depreciation at 5% would be 12,500. This will be 237,500. Now this 237,500 is now considered worth 220. So value considered is 220,000. The difference is 17,500. This is revaluation loss on date of acquisition. The revaluation loss on date of acquisition has to be reduced from the pre-acquisition profit. Now, in this question, two important adjustment: reversal of provision and revaluation of loss. So, what if there was a revaluation of gain? You will add it to the pre-acquisition profit column here. Okay, that is one thing. Now, the depreciation impact of this will be given in post-acquisition column. Depreciation impact will be given in post-acquisition column. Now, please keep in mind, if it is 1st of April acquisition, directly you can take the difference and calculate the amount. But if it is mid-year acquisition, you have to see what is the depreciation charged by subsidiary. Now, depreciation charged by subsidiary is how much? Depreciation charged by subsidiary for the full year will be 25,000. Depreciation charged by subsidiary for the full year will be 25,000. Out of this 25,000, 12,500 is pre and 12,500 is post. So subsidiary charges 12,500 is as depreciation post acquisition. Now, what is the value we gave on this machinery? We said it is worth 2 lakh. How much did we consider? 2,20,000. What? 2,20,000. So our worth is 2,20,000. On this 2,20,000, what is the depreciation? On this 2,25,000, our depreciation will be 2,20,000 into 5%, right? 2,20,000 into 5%. That is what we will consider as our, depreciation for the 6 months period. Because we have acquired at 220, our 6 months period depreciation is 5%. 6 months period depreciation is 5%. So how much is this? 11,000 is the depreciation. We should charge 11,000 of depreciation. Subsidiary charged 12,500 of depreciation. Means what? Subsidiary charge extra depreciation. If subsidiary charge extra depreciation, we have to reverse that. So we will add back that 1,500 of depreciation. In which column? Post acquisition. So whenever there is revaluation, immediately next impact will be depreciation. If it is revaluation gain, you will add higher depreciation, you will do a less here. So if this is plus here, it will be minus here. If it is minus here, it will be plus. So this gives us the pre-acquisition and post-acquisition profit. Any questions so far? Any questions so far in this question? Clear? Okay. Right? So two things, again I'm repeating, different accounting policies and revaluation gain or loss we have discussed. Right? Now, whatever is the pre-column total, we will split between holding and minority interest. Holding 125,360, minority 31,350, and here 61,600, 15,400. Now, where will it go? Please, I know all of you will be aware of it, but still a quick recap. Holding, this portion will go to cost of control or goodwill calculation. Minority interest will get added to minority interest. This will get added to minority interest. This will go to post-acquisition reserves. Right? Now, coming to cost of control, cost of investment already given. What is our share in equity share capital? 3,20,000. This you can do by doing 80% into 3,20,000. 4 lakhs also. Then capital profit, what we calculated here, or pre-acquisition profit, 125,360. It is 445,360. Now remember, if we pay more, it is goodwill. Here we have paid less, so this is capital reserve. Now, whenever this cost of control comes, immediately either go and post in the balance sheet goodwill and capital reserve. Basically, in the notes to accounts, if it is capital reserve, immediately add it in reserves and surplus so that you don't fund it. Okay. After we are done with this, next thing we need to calculate is minority interest. What do we include in minority interest? Share capital for their share, that is 20%. Capital profit from here and revenue profit from here. This is the total minority interest. Then consolidated P&L. What do we take? We will take, as per balance sheet, 100% of holding plus revenue profit of 61,600 of subsidiary. This 61,600 comes from here. Then there is an inventory transaction. Now, inventory transaction, first thing you have to ask, who sold? Craft Limited includes goods which purchased from Art. Who sold? Art Limited sold. So if holding company sells, you will reduce the profit from holding company. How much? 1,03,500, which is 15% on cost price. So if cost is equal to 100, If cost is 100, profit is equal to 15, selling price is 115. This 1,03,500 represents 115. We need to know what is 15. So what we will do, we will take 1,03,500 divided by 115 multiplied by 15. So 1,03,500 divided by 115 multiplied by 15, we get 13,500. This 13,500, we say that this is our unrealized profit in inventory, and that will be eliminated. When we say eliminated, there is always a two-sided impact. The impact is, first, you will remove from the inventory. Second, you will remove from the P&L. Okay, so 13,500 will remove from P&L. Whose P&L? Who has sold? Who has sold? Art has sold. So Art Limited P&L. Sir, what if subsidiary would have sold this to holding company? Then what we would have done is, in this post-acquisition column, you would have one more line item called unrealized profit on inventory, 13,500. This will split between holding company and subsidiary company. This we have already done. Savings also we have already done. Now, after doing this, balance sheet is very, very easy, straightforward. We may miss out on some adjustment. So what I suggest is, for example, here, plant and machinery, there is revaluation. So here you put a small tick. Then 1% from trade receivable, there is an adjustment, you put a tick here. And inventory also, there is an adjustment. So these three adjustments, you should not miss out. See, we have done the working notes correctly. In the balance sheet, if you do not do it correctly, then it becomes a... Okay. Now, how to prepare the balance sheet? Shareholders fund, share capital, you will take 650. Reserves and surplus, we have already prepared the working note. From there, you will take the total. But you will have a notes to account for that. This you don't need to take because this is split between pre and post already. Trade payables, you will add 100%. Short-term borrowings, 100%. Non-current assets, this plus this minus the adjustment. Now, what is the adjustment? See, there was an adjustment of decrease 17,500, and depreciation impact is plus 1,500. So, simple thing, minus 17,500 plus 1,500, you will do the adjustment. In the PPE, minus 17,500 plus 1,500, you will do the adjustment. If it is revaluation, positive revaluation, you will take 17,500 minus 1,500. Now, this depreciation, please keep in mind, it is not only for the year. If the subsidiary was acquired 2 years back, 3 years back, and all of that, it is not only for the year, it is for the number of years from the date of acquisition. So that is what you have to consider. Then, non-current investment, this will not be taken. If there is any other investment, that will be taken. But investment in subsidiary will not be taken. Inventories 166 plus 205 minus unrealized profit. Trade receivable 133 plus 168. Here provision will be reversed. So you will add back provision of, I think, 1,500 is what we had calculated. Cash and cash equivalent 224 plus 67, you will take directly. Okay, 24 plus 67, you will take directly in the balance sheet. Now, coming to notes, as I told you, notes to accounts. This is important. Reserves and surplus. Now, how we will take? General reserve, P&L, and capital reserve. Capital reserve, it is as per what we have calculated in cost of control. General reserve is what? General reserve is your we have done the total, no? Somewhere. Consolidated general reserve 120. This is 100% of the holding. If there is post acquisition of subsidiary, we will have post acquisition profit of subsidiary also. Okay. So in notes to accounts, important is equity share capital compulsory. This is also mandatory. Minority interest 126. You can directly show it here. No need to add it back. You can directly show it here. This is not required for examination purpose. If you skip that also, it is okay. Current liabilities, this we have done. Trade payables, this we have done. As I told you, you can directly show it here. Inventory also, you can take art plus craft minus unrealized profit. Trade receivable, art plus craft plus provision reversed. Okay, that also can be done. And cash equivalents. Now, what is the breakup of marks? Generally, if you appear for this paper, or if you have attempted this question, 3 marks is for this. Typically, half mark is for this, 1 mark is for this. So 4.5, 4.5, 0.55, Sir, why are you showing bank overdraft here? Because there in the balance sheet, we don't have bank overdraft heading. That's why we gave over 5. This is 1, 6. This is 1, 7. These two put together. 7. Then 1, 8. Plus 2, 10. Plus 1, 11. Plus 1, 12. Plus 1, 13. Plus 1, 14. Somewhere around that. Okay. Or 0.5, 0.5, something like that. Question is slightly lengthier. Earlier, we used to get the same question for 16 marks. Now they're giving for 14 marks. We have discussed earlier also that after the MCQs have been introduced, they have actually, increased the length of the question. So this is a 14 marks sure short question. If you see, right, there is no complicated adjustment and we'll be able to handle this in the examination. Okay. Is that clear? Okay. All right. So one adjustment in case of intercompany transaction is here. When on 31st of March, bills payable of 12,000 shown in S Limited balance sheet had been accepted in favor of H Limited. So here, if you see, bills payable you have holding and subsidiary. Bills payable you have 60,000 and 14,800. Bills payable of 12,000 shown in S balance sheet had been accepted in favor of H Limited. So bills payable shown of 12,000. So what is the bills payable here? Out of 1,400, 12,000 has been shown as accepted in favor of H Limited. So H Limited has a bills receivable of 1 lakh. So from 1 lakh, you'll remove 12,000. Okay, so that is one adjustment, which is normal. But sometimes what happens is they would say out of this 12,000, for example, S has accepted 12,000, 10,000 has been endorsed in favor of creditors. So only 2,000 should be adjusted. So that is one thing you have to keep in mind. Then we'll look at this question, this particular question. We'll take a break before that and then we'll continue. So we'll resume at 11:20. Okay, so by the time my pencil also will get charged, at 11:20 we'll resume. The following balance sheets of subsidiary MNT Limited is given 17, 18, 18, 19. The first adjustment says LTC values inventory on FIFO basis, MNT uses LIFO basis, which means difference in accounting policies. Now, if there is a difference in accounting policy, what do? We bring it to the accounting policy of the holding company. Okay, so we'll have to bring it down to FIFO. To bring MNT's limited inventories in line with those of LTC, its value of inventory is required to be reduced by 5,000 at the end of 1718 and increased by 12,000 at the end of 18. Means what? For 1718, they are saying reduce it by 5,000. If I reduce closing inventory by 5,000, what will be the impact? The impact will be that the profit will also be lower by 5,000. Now, if closing inventory is lower in the current year, please understand, in the next year, opening inventory will be higher. In the next year, opening inventory will be higher. If the closing not higher, lower, opening inventory will be lower. If opening inventory is lower in the next year, what will happen to profit? Profit balance will increase. Okay, then. And it has to be increased by 12,000 at the end of 1819. Increased by 18,000 means what? In 1819, again, you are increasing the closing inventory. That will again increase the profit. So you have to give both the impacts. MNT Limited deducts 2% from trade receivable as a general provision against doubtful debts. Prepaid expenses in MNT include sales promotion expenditure carried forward of 25,000 in 1718, 12,500 1819, being part of initial sales promotion expense of 37,500 in 1718. Now, please understand, any prepaid expenditure or any sales promotion expenditure as per accounting standard 26, you cannot defer. So whatever is this 37,500, fully you have to write in 1718. Fully you have to write in 1718 itself, which is being written off over 3 years period. We cannot do that. We have to write it off in the year of incurring itself. So this 25,000, whatever is the prepaid expenses that you're carrying it forward, that has to be written off, and 12,500 also has to be written off. Similar nature of sales promotion expenditure has been fully written off in 1718. This is what the accounting standard also requires. Restate the balance sheet of MNT Limited as of 31st March after considering the above information for the purpose of consolidation. Now, what do we do? Simple. Revenue reserves, if you see in the question, or the total revenue reserve, you see, closing balance is 5,05,000. Now, what are the questions said? For 31st March 19, so we need to only restate the next year thing. MNT deducts 2% from trade receivable as a general provision against doubtful debt. So, trade receivable, they are saying that we will deduct how much? 2%. On what value? Trade receivable, we are doing only current year, that is 1819. 3,43,000. Now this is after deducting 2% provision, means this represents 98%. We need to know how much is 2%. So what we will do, 343 divided by 98 multiplied by 2. So 343 multiplied by 2 divided by 98. 343 multiplied by 2 divided by 98. We get reserves or provision is 7,000. Provision is 7,000. Now, this provision of 7,000 is not required by the holding company. This is not required by the holding company. So we will add back. Then closing inventory has been increased by 12,000. So we'll add back. Now you may ask, sir, what about the opening inventory? See, what happened was opening inventory of 1819 is to be reduced by 5,000. So P&L will be higher by 5,000. But in the previous period, that is 1718, you have to reduce the inventory by 5,000, which will reduce the P&L by 5,000. So this 5,000 and 5,000 impact will be net off, and you will only consider 12,000. Then sales promotion expenditure, whatever is there as prepaid balance, 12,500 you have to fully write off. Adjusted reserve is 5,11,500. So adjusted reserves will show as 5,11,500. 5,11,500. Apart from that, what is to be done? Respective adjustments have to be done. For example, in inventories you will increase, trade receivable you will restate. That is the second adjustment. And there was a prepaid expense, right? Prepaid expenses of 65,000. From that, you will reduce. From that, you will reduce 12,500 and you will show the closing balance as 52,500. Okay. Simple question, but you can score good marks, right? Let's look at this particular question. Again, a 15 marks question. White Limited acquired 2250 shares of Black Limited on 1st of October. Again, a mid-year acquisition. Summarized balance sheet of both the companies as on 31st March are given below. Shareholders fund, share capital 100 each, fully paid up. Reserves and surplus, profit and loss account. Current liabilities, trade payables. Amount due to White Limited is 30,000 in this question. Non-current assets, PPE, investments, shares in Black Limited 2250 shares. Current assets, inventories, due from Black Limited, amount receivable, and cash and cash equivalent. During the year, Black Limited fabricated a machine which is sold to White Limited for 39,000. The transaction being completed on 30th September of 21. Now, this is one thing which has happened. They have sold a machine on which date? On 30th of March of 21. They have not given cost for this. So we cannot adjust the depreciation. Had they given cost for this, for example, cost was 30,000. Then depreciation has to be adjusted. Why adjusted? Because the White Limited, which is the holding company, would have charged depreciation at a higher value. We should reduce the depreciation for this purpose. Cash in transit from Black Limited to White Limited was 6,000 on 31st March. Profit during the year was earned evenly. So cash in transit is 6,000 means what? Black has sent to White. Black says trade payable. The number is, I think, 30,000. When you do the solution, we'll get to the number. Trade payable due to White Limited. So amount has to be paid to White Limited. That is what they're saying. Whereas Black has sent 6,000. Now, what do we do with cash in transit? For cash in transit, what we will do is we will reduce from receivable. We will reduce from receivable and show it independently as a cash in transit amount. Balance of reserves and profit and loss account on 1st of April were as follows: 30,000, 30,000, 15,000, 10,000 loss. You are required to prepare consolidated balance sheet of the group as on 31st March as per the requirement of Schedule 3 of the Companies Act of 2013. Now here, what has happened? Balance of reserves are given 15,000 and 10,000. On which date? 1st of April. When are we preparing the balance sheet? On 31st of March. When did the acquisition happen? Acquisition happened on 1st of October. Acquisition happened on 1st of October. Right? Now, if you see, we need whose Black Limited analysis. Black Limited is showing that general reserve is 30,000 and profit and loss account is 90,000. General reserve is 30 and 10,000 loss. General reserve is 30,000 and 10,000 is loss here. Now, can you tell me how much is the profit made during the year 2020? What is the profit made during 2020? What is the profit made during 2020? This is as on 1st of April of, sorry, not 2021. This is as on 1st of April of 20. This is as on 31st of March of 21. What is the profit made during the year? The profit made during the year is, don't do 90 minus 10. It is 90 minus of 10,000. 90 minus of 10,000, or 10,000 loss became 90,000 profit. So profit for the period is 1 lakh. That is how you have to calculate. Okay, that is how you have to calculate. Now that 1 lakh is for the entire period. So what we will do, 50,000 pre-acquisition, 50,000 post-acquisition. And as far as general reserve is concerned, there is no movement. Entirely it is pre-acquisition. So when it comes to pre and post acquisition, again, no need to do in two different columns. You can do in a single table itself. So what you can do is you can have pre-acquisition here and post-acquisition here. Now pre-acquisition, general reserve. Now whatever is there in general reserve, entirely it is pre-acquisition. So general reserve 30,000 pre-acquisition. Then P&L balance. P&L balance is, here it is minus 10,000. So you will say minus 10,000 is pre. Then profit for 6 months, 50,000. Profit for 6 months, 50,000. That is what? That is your pre-component. That is your pre-component. So you have 70,000 of pre-acquisition profit, 70,000 of pre-acquisition profit. Are we clear how to calculate when there is a loss? Okay, great. Then what is post-acquisition? Post-acquisition general reserve, there is no balance. P&L, there is a balance of 50,000. This is post-acquisition. Then what we will do? From post-acquisition, take 75% of this. This will be added to reserves. 25% here. This will be added to minority interest. Here, this will go to cost of control. This will be added to minority interest. Now, when it comes to minority interest, we'll take their share of equity share capital and 12,500 and 17,500, you get minority interest here. Then while calculating cost of control, amount paid, would like 70 minus 2250 shares, so much, capital reserve, so much, you have capital reserve of 7,500. This immediately post in reserves and surplus working note so that you don't forget. Now, when it comes to consolidated balance sheet, share capital, only holding entity. Reserves and surplus, general reserve of holding company, P&L account of holding company, 75% post-acquisition profit and capital reserve. Then minority interest, we have already calculated. Trade payables. Trade payable is 1,15,000 plus 75,000. I'll just pull out the number. This is missing here. Just give me a moment. So due to Y limited is 30,000 here. Okay, so there is a separate number. Trade payable 1,15,000 and 75,000 and 30,000 is there. Okay, so this is 75 and there is one more number of 30,000, which is trade payable. So this 30,000 is intercompany, you will not consider. 30,000 is intercompany, you will not consider. 1,15,000 plus 75, 1,90,000 is what is the trade payable. 1,90,000. Then due from Black Limited, here we are showing 36,000. Now, out of this 36,000, 30,000 is shown as trade payable already by the other party. So you will do minus 30,000. From trade payable, you will remove 30,000. From trade receivable, you will remove 30,000. And 6,000 is cash in transit. So what you will do, you will remove 6,000 from here and you will add 6,000 to cash and cash equivalent. That is one adjustment when there is cash in transit. So whenever there is cash in transit, what you will do is you will reduce cash in transit number from the receivable part and you will show it as a separate line item. So when it comes to cash, you will take black, white and cash in transit. Inventory, black, white total, and that is what you will. Any questions in this? Simple question. Again, you can score easily 15 out of 15. Now, whenever a difficult question comes in the examination, especially in consolidation, that is what you have to do it towards the end. Okay. This one has adjustment of dividend. This one has adjustment of dividend. On 31st March, H Limited and S Limited gave the following information: equity share capital, issued capital, general reserve, profit and loss account, credit balance, trade payables, provision for tax and other provision, plant and machinery, furniture, investment. This is the cost, inventory, trade receivable, cash in bank, sundry advances. H Limited purchased 90,000 equity shares of S on 1st of April, on which date general reserve is 1500, P&L is 633. When did we purchase? We purchased on 1st of April. When did we purchase? We purchased on 1st of April. On 14 July, S Limited declared a dividend of 20% out of pre-acquisition profit. H Limited credited the dividend received to its P&L. Now, this is a typical adjustment which comes where if it is pre-acquisition dividend, what do? We credit to investment. We credit the amount to investment account. If it is pre-acquisition, what they have done here? They have credited to P&L. We have to rectify this. Rectification means what? From this investment, you will reduce that amount, and from your P&L balance also, you have to reduce the amount. And one more thing that you have to keep in mind is this closing balance 810 that you see, you will not compare with 633 because there is some dividend paid. So that dividend part also needs to be considered. On 1st November, they issued 3 fully paid equity shares of 10 each for every 5 shares held as bonus shares out of pre-acquisition general reserve. So pre-acquisition profit, dividend paid, and also bonus is issued. Now, what is the treatment of bonus issue? As far as bonus issue is concerned, what you will do is you will add to equity share capital of subsidiary, and you will reduce from pre-acquisition profit of subsidiary or pre-acquisition general reserve of subsidiary. So dividend, pre-acquisition, remove from the cost of investment of holding company and reduce from the P&L balance of the holding company if it is incorrectly done. Bonus issue, what we will do? Bonus issue, we will add it to the share capital of the subsidiary company if they have not done the adjustment, and we will reduce it from the reserves. Okay. Now, sir, what do we assume? Have they may pass that entry or not? We'll assume they have passed the entry. We'll assume they have passed the entry unless the question says that the entry is not passed. Okay. On 31st of March, the inventory of S Limited included goods purchased for 50,000 from H Limited, which had made a profit of 25%. So this is closing inventory adjustment. Trade receivable, trade payable details are given below. Prepare the consolidated sheet. Prepare the consolidated sheet. Okay. Now here, first thing, do we have profit as a date of acquisition? Yes. But out of this profit, bonus has been paid or bonus has been issued. How much? They have issued bonus of 3 for every 5 shares held as bonus shares. 3 out of 5. Means if you have 5 shares, you have to add 3 more shares and final number will be 8 shares. Now, this number in the balance sheets will assume this is post-bonus. Sir, what if it is pre-bonus? If it is pre-bonus, then you will have to pass the adjustment of bonus also. You have to remove from the general reserve balance here and add it to the share capital. But this is post-bonus. This represents 8 shares. This represents 8 shares. So, what is the bonus issue? Bonus issue is 2,400 divided by 8 multiplied by 3. I'm repeating once again. If I have 5 shares, I'll get 3 shares. If I have 5 shares, I will get 3 shares. Now, this 5 shares and 3 shares totally now becomes 8 shares. We need to know what is the bonus component. Sir, why do we need to know? So that from the opening reserves, we can remove that amount. From the opening reserves, we can remove that amount to calculate the amount earned during the period. Okay. So how much is that? 3. 2,400 divided by 8 multiplied by 3. Bonus issue is 900. Bonus issue is 900. Meaning to say the company has transferred 900 from general reserve to capital account. So what we will do, and what I would like to do is prepare a ledger balance or ledger account of general reserve like this. So in that, what we will take, whenever there are bonus, dividend and all, I strongly suggest you to prepare the ledger account. I strongly suggest you to prepare the ledger account. Okay. So what is the general reserve balance? 1500. So what you will do? You will say by balance brought down 1500. By balance brought down 1500. Then to bonus issue. How much is the bonus issue? Bonus issue is for 900. So you will say to equity share capital 900. Okay, that is one thing. Then sorry, general reserve 1500. Closing balance of general reserve is 690. To balance carried down 690. 1500 and this side 900 plus 690. So 90 is the balancing figure. Where will we get this balancing figure from? This has come from our P&L. Where will we get this balancing figure from? This has come from P&L. All right. This has come from P&L. Now we'll also prepare the P&L account. Opening balance 633. That is as given in the question. We have transferred 90 to general reserve. All right. We have paid dividend of 300. Very good. Balance carried down 810 from the balance sheet. So the balancing figure is 567. What is this 567? This is the profit earned during the year. This is the profit earned during the year. This is the profit earned during the year. Now, when it comes to calculation of your cost of control, calculation of cost of control. Now, when it comes to calculation of cost of control, how we will do is that first, you will take what is the opening balance? Opening balance of 1500 in general reserve and 633 in P&L. So you have pre-acquisition 1500 of general reserve and you have 633 of P&L. This is the number that is given. Now what we need to do is out of this 900 has been issued as bonus. So closing balance is opening balance remaining is 600. Out of the 633, 300 has been declared as dividend. So close balance left is 333. So 600 plus 333 is the pre-acquisition. 600 plus 333 is pre-acquisition. The same thing can be received or derived from here also. 1500 minus 900. 600 is pre-acquisition number. Then here 633 minus 300. We can say 350 is pre-acquisition. Okay, that is the pre-acquisition profits. Okay, now how much did we pay? We paid 1500 to acquire this. Out of 1500, we have received some dividend. Now, how much of dividend has been received? We would have received dividend to the extent of our share. What is our share? We have purchased 90,000 shares. Currently, here there are 2,2400. 2,40,000 shares are there. How many shares did we purchase? 90. Now on this 90, we would have received the bonus issue. We would have received the bonus. So our holding will be 90 into. Currently we have 5 shares. Now our holding will be multiplied by 8. So this will be 90 into total of 8, original of 5. If we do, we get 90,000 into 8 by 5. That works out to 1,44,000. Now this 1,44,000 is our share. That is our share, which represents 60%. Which represents 60%. Now, when we have to calculate the cost of control and goodwill, our share in the share capital is how much? Out of, I'll just erase this, slightly become more clumsy. Our share has become 1440. That is our share capital. A share of share capital in subsidiary. Then reserves, we said 1500 minus 900, 600. So 600 into 60%, general reserve share is 360. Then 633 minus 300, 333 is the P&L balance. Out of that 80%, 60%, so 333 into 60%, if I do, I'll get 199.8. I'll get 199.8. I'm repeating once again. This is 60% of share capital. This is 60% of pre-acquisition reserve, and 198.8 is 60% of P&L balance. So what is the total? 1440 plus 360 plus 198.8, we get 1998.8. That is the total net asset, and there are no other adjustment apart from this. Goods purchase, we'll assume it is subsequent. Okay, there are no other adjustment than this. Now, out of this, for 1998.8, that is the total net asset. What is the investment? 1500. This 1500 is before dividend. So what we will do? We will say 1500 minus our dividend. How much dividend did we receive? We would have received dividend of how much? They said 20% out of pre-acquisition on 14th July. So on this 90,000, we would have received 20%. So the dividend number, if you see, is 180. So how 180? 90,000 into 10 into 20%. This we are credited to P&L. Now we will remove from the P&L. We have credited to P&L. Now we will remove from the P&L 180. This will also be removed from the investment for cost of control. So 1500 minus this, you have 12. Sorry, not 1200. 1500 minus 180. 1500 minus 180. 1500 minus 180. If I do, I get 1320. 1320. Net asset share is 1998. What I have paid is only 1320. The balance will represent my capital reserve. So capital reserve is 679.8. So if we do this, 1998.8 minus 1320, 1998.8 minus 1320. If I do, I get 678.8. 679. 333, I think 333, I did a mistake. 333 into 60%, 199.8. So this is not 198.8. This is 199.8. So this will become 1999.8. So this will become 679.8. The only complexity here is calculation of this capital reserve. Only complexity in this question is calculation of capital reserve because of multiple adjustments involved in the cost of control. So what did we do? Just to quickly recap on this. We took the P&L as given in the balance sheet, opening balance sheet. We prepared a ledger account for that. We also took the opening P&L balance. From the opening P&L balance, we removed the dividend paid out of pre-acquisition. So whatever was opening P&L balance 633, out of this pre-acquisition dividend that was paid, whatever was paid, that we have removed. That we have removed in totality. So how did we get the dividend? See, this number 2400 is post-acquisition. So we calculated how much is, so not post-acquisition, that is post-bonus. How much was pre-bonus? And on that, we have calculated what is the dividend. That is 300 we have removed here. Same way from general reserve, the bonus issue we have removed. So we got opening balance of bonus, general reserve, opening balance of P&L. That is one thing what we did. Then we took equity share capital. All of this we took 60%. Compared that with the investment minus whatever dividend we have received, that is minus 180, which is 1320. The balancing figure works out to your capital reserve. Is there any doubt in this? This is one question I would want you to do before the examination also because of multiple calculations involved. So step by step, if you ask me, I'll just summarize this for you. First, P&L opening balance minus dividend paid, which is pre-acquisition. general reserve opening balance minus bonus issue. Okay, this is what will give you pre-acquisition. This you will take 60% of whatever is our share and compare with investment made minus pre-acquisition dividend. Then you will get the number of capital. Now, sometimes what happens is you have opening balance of P&L, let us say 10,000. Closing balance of P&L of, let us say, 15,000. And normally we will say 5,000 is post-acquisition profit or profit for the period. But say, for example, they have made dividend paid. They have paid dividend of 3,000 from opening balance. They have paid dividend of 3,000 from opening balance. Then what happens? You would prepare a P&L and say by balance brought down 10,000 to dividend 3,000 to balance carried down 15,000. So by profit for the year 8,000. By profit for the year 8,000. And now if it is mid-year acquisition, then what do? If it is a mid-year acquisition, we would have normally said 8,000, 4,000 is pre and 4,000 is post. Okay, but here we have a dividend which is paid out of opening balance itself. We have a dividend which is paid out of opening balance itself, right? So in that case, this 4,000 is your post-acquisition for sure. When it comes to pre-acquisition, opening balance it is 10,000. Opening balance it is 10,000 minus dividend paid 3,000. You are left with 7,000. So 7,000 plus 4,000, 11,000 will be pre-acquisition. I'm repeating once again. If it is a mid-year acquisition, then what you will do? First, you will prepare a P&L account, calculate the profit for the period, divide it equally between the pre and post. Okay. To this pre, you cannot add fully 10,000 because out of this 10,000, 3,000 of dividend has been paid. So what you will add is 10,000 minus 3,000. You will add only 7,000 in the pre-acquisition column. So you'll have 4,000 plus 7,000, 11,000 pre-acquisition, 4,000 post-acquisition, total is 15,000. If you want to prepare in a statement format, P&L, your closing balance is 15,000. Closing balance is 15,000. As per the opening balance, what you have 10,000 in the opening balance. 10,000 in the opening balance. That is what you will do. Minus dividend of 3,000. You are left with 7,000. 7,000 will be your post part will be 8,000. Not post part, current year. Then what you will do? You will do a time adjustment of 4,000 here and you will add 4,000 here. So you'll get 11,000 and here you will get 4,000. So whenever dividends are paid out of pre-acquisition profit or opening balance, then first you will do the dividend adjustment. Then from the remaining balance, you will move half of the profit to pre-acquisition and get to this. Are we clear? Others, are we clear? Okay. So this is also done. So we have seen pre-acquisition dividends. We have seen mid-year acquisition with dividend adjustment. That is one where you revise again so that you don't make a mistake. Then we also saw a case where we have, adjustment related to revaluation. So revaluation, I'm revising once again for you. Revaluation, if it is upward revaluation, add to pre-acquisition and less depreciation from post-acquisition. In the balance sheet, you will take pre-acquisition, let us say 10,000, and here depreciation is 2,000. You will take net of 8,000. Okay, this will be adjusted to PPE. That is one adjustment of two. Unrealized inventory, if holding sells to subsidiary, remove from the consolidated reserves. If subsidiary sells to holding, then remove from the post-acquisition profits. Okay. Then we have this concept of minority share of losses. Now, whenever there is minority who takes share of profit, post-acquisition profit, if there is loss, then what is to be done? So what you have to do is, say for example, on date of acquisition, P&L has a balance of 10,000. Equity share capital, we have a balance of 20,000. Total is 30,000. Minority interest is 20%. So minority balance is 20% of 30,000. That is equal to 6,000. Minority balance is 6,000. Let us say in year one, there is a loss of 40,000. There is a loss of 40,000. Now, this loss of 40,000, generally what happens? You will have holding company 80%, minority interest 20%. So what would happen? Generally, they would take 32,000 of loss and minority interest would bear 8,000 of loss. Now, balance in minority itself is 6,000. How will they bear 8,000 of loss? They cannot bear. We cannot show minority as a negative balance. So what the standard requires is, for minority interest, let us say opening balance was 6,000. Then share of loss. Actually, it is 8,000, but we cannot give 8,000 to minority. We can give only 6,000 to minority. So this will become 0. So what about the 2,000 loss? The 2,000 loss will be borne by holding company. So for consolidated P&L purpose, you will say in the holding entity or in the holding company, you would say minus 34,000. You will say minus 34,000. Then let us say in year 2, there is a profit of 10,000. Now, out of this profit of 10,000, typically you would say 8,000 belongs to holding company and 2,000 belongs to minority interest. But before that, what you have to see, what is the balance of minority interest absorbed by holding? Now here, out of 8,000, we gave only 6,000 to minority. Here we have a balance of 2,000. So when you get the profit first time, from the minority interest share out of 2,000, first you will recover this 2,000. So minority will not get anything. What will happen? Holding will get 8,000 plus 2,000. Holding will get entire 10,000. Then subsequently, if there are any profits and all, you will continue to calculate accordingly. So for this, we have a question. Typically, I don't expect that you'll get a 15 marks question, but still, because it is there as a part of study material also. Important that you revise this question before the examination. GB Limited acquired 80% of TB Limited on 1st of April at a cost of 58 lakhs, when TB had equity share capital of 50 and reserves of 464. So first thing, what is the minority interest? 20%. 20% of what? 20% of 50 and 464, 20% of these two numbers, that comes to 1092, 800. Okay. That is the opening balance. Then following information is provided. Loss, 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 profit, profit, profit. You are required to calculate minority interest and cost of control at the end of each year. Cost of control, you can directly calculate. I have done the question and you would have also practiced enough number of times. Minority interest at the date of acquisition is 1092, 800. Okay. Now, what is the first year's loss? 1450. Out of this, 80% is parent, 20% is minority. So, out of this 1450, 20% goes to minority, 80% goes to holding. So, this minus 20, 8,02,800 is the closing balance. And as far as the holding company is concerned, they will add it to their P&L. Then, next year it is loss of 2320. Out of this 2320, 464 goes to minority, balance goes to holding. Then next year it is loss of 29. Now our closing balance is 338. For 29 lakhs, 20% loss is 580. Can the minority take 580? Minority cannot take 580 because they don't have balance. So what will happen? If minority cannot take 580, minority can take how much? Minority can take only up to 338. Minority can take only up to 338. So out of 580, 338 can be taken by minority. balance that is left, which is 241,200. This 241,200 is absorbed by the holding company. So what will happen is, apart from their share of 2320, whatever is the number, 241,200 will be borne by holding company. 41,200 will be borne by holding company. Subsequently, you will maintain a track. What is the minority share of losses borne by holding company? 241,200. You will keep a track of this, and you will continue to maintain this. Subsequently, when there is profit, we will recover. Okay. Then the balance in minority interest is nil, and holding company has taken entire 25,61,200 of loss. Not entire. 388 is taken by minority, balance is taken. 1920, 696 is the loss. Out of this, what is their share? Minority share is 139. Do they have balance? They don't have balance. So give it to holding company. So you'll add the balance to the holding company, you get 380,400. Okay. Then in 2021, there is a profit of 1,90,000. Now what do? Minority has profit of 3,800. But 380,400, holding company says, wait, I have taken your past losses. First, give me this 380,400. So out of 38,000, 38,000 is adjusted against this number. So you will have 380,400 minus 38,000, balance of 342,400. Okay. Then 680 is the profit, 136 is the share. Still we have to recover 342. So entire will be given to holding. Then 1270 is there, profit. 254 is the balance. 206 we have to give to holding. So out of 254, 206 will be given to holding, and 47,600 will be added to minority balance. Please practice this once again. Okay, I've explained the logic in the previous concepts also, but please practice this. It may come for MCQ. It may come from MCQ. I don't expect a full 40 marks question like this in the examination. Okay, so that is about consolidated balance sheet. Any doubt you have? Any doubt you have? Any specific question you want me to take up? Yes, you can use alternate method of presentation, whichever method suits you. No need to follow this method only. The essence is what? Every year, what is the loss which is borne by the holding and what is the cumulative balance? You follow if you have done some other way of presentation. Institute also has two different ways of presentation. Your faculty would have taught it that way. Anything is fine. That is up to you. Any specific question on consolidation where you feel stuck, you want me to take up? See, we have taken about 4 or 5 questions from the past examination paper. Now, the reason why I took past examination paper and RT is for you to get comfort that yes, if a question like that comes in the examination, we will be able to solve it. Now, if you don't have any more questions, we will pause here. Tomorrow, what we will do is we'll complete the consolidated P&L, associates, and joint venture with again a quick revision of all the adjustments that we are likely to see in the examination. Okay, adjustments that you have to be careful about: pre-acquisition dividend, mid-year acquisition, revaluation. These 3 adjustments are typically where students make mistakes. Okay. Right. So we'll continue tomorrow. Tomorrow we will have the class at 9:30. I hope you are okay. I'll put the message in the WhatsApp group also. We'll have the class at 9:30. Okay. Sure. Thank you. So before we take on to the P&L, we'll again have a quick recap of whatever we discussed, because consolidation as such is not something that 1 class or 2 class will help you. You would have done enough number of questions, and you would also be knowing on how to what are the adjustments that will be difficult for you or that has been troubling you, and all of that all of you would be aware of. So now what we'll do is we'll have a quick recap. When there is a consolidated balance sheet question, you have a holding company, you have a subsidiary company. They will give you assets, liability, equity. Here also they'll give you assets, liability, equity. Here they'll give you something called as investment. Okay. Now, first thing what we have to do, we have to determine what is the purchase consideration or what is the payment made. Then after that, we need to determine what is the net asset on date of acquisition. This is nothing but equity share capital plus pre-acquisition profits or pre-acquisition reserves. Okay. Now when you have pre-acquisition profit or pre-acquisition reserve, this you will prepare by doing something called as analysis of profit. So what you will do, whatever is the reserves in subsidiary, this you will split between pre-acquisition and post-acquisition. Okay, that is the first thing. Then net asset you will take only parents share. Now when you do analysis of profit, you have pre-acquisition, you have post-acquisition, you will have holding company share and you will have minority interest. Holding company share, let us say 80%, 80%, 20%, 20%. This holding company share, this you will take to cost of control. This 20% minority interest you will add to minority interest balance. This 80% you will add to consolidated reserves. This you will add to minority interest balance. Then we saw that there could be cases where we have questions or aspects around dividend adjustment. Now whenever dividend is given, the best way is to prepare a P&L account in T-shape format. You will take opening balance to dividend paid to closing balance, and whatever is the balancing figure, this is profit for the year. Now if there is a mid-year acquisition, this profit for the year you will again split between, let us say 6 months. This 6 months will be pre, this 6 months will be post. Okay, that is what is as far as analysis of profit is concerned. Then we will calculate a minority interest balance, which is share of minority in equity share capital, then share of minority in pre plus post. Please remember, minority balance cannot be negative. If at all it reaches a negative state, you will take that loss, or that loss will be given to the parent entity or the holding company. Alright, so that is one more thing which we have to be clear about. Then consolidated reserves. In consolidated reserves, you will take 100% of holding plus 80% in our example of post acquisition. That is what we will do. Okay. Then after doing this, there are some adjustments. One is intercompany balances. This you will net off only to the extent of balances appearing in the books. So if there is something, let's say like bills are discounted or bills have been endorsed in the favor of creditors or all of that, then you will not consider. Whatever is there in the balance sheet, for example, if holding says bills receivable 10,000, subsidiary says bills payable 2,000 in respect of holding subsidiary transaction, balance 8,000, sorry, I do the ulta example. Holding says bills receivable 2,000, bills payable subsidiary says 10,000. What holding has done is 8,000 they have discounted with the bank, or 8,000 they are given to supplier. In that case, only 2,000 will be adjusted, balance 8,000 will be shown. Then we have in inventory, we have something called as unrealized profit. This you will do inventory balance on balance sheet date multiplied by, if it is gross profit, it is on sale, as profit is given on sale percentage, then you will multiply the gross profit percentage on sales. Or if it is given on cost basis, for example, if they say 20% on cost, then what you will do, 20 divided by 120, and you will calculate unrealized profit. This unrealized profit, if it is holding to subsidiary, means holding is the seller, subsidiary is the buyer, then you will eliminate from post acquisition profit. If subsidiary is the seller, holding company is the buyer, then if holding has sold, you will eliminate from reserves. I wrote ulta. Reserves of holding. If subsidiary has sold and holding has purchased, then you will eliminate from post column. Okay, now the question you have to ask is, who made the profit? If holding made the profit, remove from holding. If subsidiary made the profit, remove from post acquisition of subsidiary. Then one final adjustment, revaluation of assets. If revaluation of assets are given, then you will increase pre-acquisition profit for gains, and you will reduce pre-acquisition profit for losses. So if there is increase, you will add. If there is decrease, you will reduce. This is on the date of acquisition. Then subsequently, if there is gain, you will charge excess depreciation in post column. If there is loss, you will reduce depreciation in post column. So if here it is plus, here it has to be minus, and this net impact will be given in the balance sheet. Okay, this is the summary of all the discussions that we had, as far as consolidations are concerned. If you are clear with this, and if you have practiced enough number of questions, it will be easy for you to handle this in the examination. Now, one more thing for your revision purpose, when you are again revising this chapter, don't do all questions. So your strategy should be, for 4 chapters I am writing: financial statements, amalgamation, consolidation, and internal reconstruction. For these 4 chapters, don't do all the questions again and again. Don't do all the questions from starting till end. What you should do is, do at least 3 to 4 questions only, and for remaining questions, have a look at only the adjustments. Only the adjustments: financial statement, amalgamation, consolidation, internal reconstruction. Have a look at only the adjustments and see, are you able to understand and give the impact of adjustment? Okay, that is what will help you to revise. In the revision stage, you should not be doing all the questions again and again and again, because you can prepare the consolidated balance sheet or balance sheet after the amalgamation, or balance sheet after the reconstruction. All of that is possible. What is important is, am I able to take care of the adjustment? Is my adjustment treatment correct or not? That is what you should be looking at. Right? Now, we'll start with consolidated P&L. Now, what is consolidated P&L? Basically, holding plus subsidiaries combined P&L. Combined P&L of holding and subsidiary. Okay. Now, when I say combined P&L, what you will do, line by line, you will, for example, sales, you will take holding plus subsidiary, you will get the total. Same way purchase, same way expenses, everything you will total. There are 2 things you need to take care of. One, the subsidiary component that you take should be post acquisition only, meaning to say, only from the date of acquisition. For example, you have 1st of April, you have 31st of March, acquisition happened on 1st of October. Then you will not take full year sales for subsidiary. You will take only post acquisition sales, post acquisition expenses, everything only post acquisition. Sir, why are we not taking pre acquisition? This pre acquisition will go and form part of your cost of control calculation. So that is why you will not take pre acquisition, you will take only post acquisition. Now, sometimes the problem in these type of questions is, institute does not tell clearly whether it, what is the date of acquisition. Then you have to make an assumption. If nothing has been given, take full year. But if the date of acquisition is given, then take only post acquisition. Take only post acquisition. Okay, that's the first thing. Second, if there are any intercompany transactions, intercompany sales, purchases, interest, whatever is there, if at all there are any intercompany transaction, you will reduce or eliminate. Meaning to say, let us say holding sales is 10,000, subsidiary sales is 3,000, holding sold to subsidiary 2,000. So for the total number, what you will do, you will take 10,000 plus 3,000 minus 2,000. That is how you will do. Same adjustment you will do in case of purchases also. Same adjustment you will do in case of purchases also, or any other income or expenses. Between holding and subsidiary, whatever are the transaction, that is what you will eliminate. Once you do that, then the remaining part of the problem is not a challenge. You will be able to manage it. Okay. Any question in this so far? Any question? Okay. Now we'll look at a question. Moon Limited and its subsidiary Star Limited provided the following information for the year ended 31st March of 21. Equity share capital, finished goods inventory as on 31st March. So this is what, this is opening. This is closing. Dividend income, other non-operating income, raw material consumed, selling and distribution, production, loss on sale of investment, sale and other operating income, wages, general administrative expenses, royalty paid, depreciation, interest expense. On 1st of September of 2018, Moon Limited acquired 50,000 equity shares of rupees 100 each, fully paid up in Star Limited. So when is the acquisition? Acquisition is 1st of April of 18. 1st of September of 18. 1st of September of 18. Now tell me, how many months of revenue should we take? If the acquisition is happening on 1st of September of 18, how many months of revenue should we take? Yes? 7 months. September, October, November, December, January, February, March, 7 months. That is what we typically do in the examination. But please keep in mind, we are doing for 31st March of 21. We are not doing. Acquisition is when? Acquisition is on 1st of September of 18. So, reading question becomes very, very important in the examination. If I take September and immediately calculate 7 months, it will become a problem. Because acquisition is on 18, we are consolidating for 21. So, in this year, everything is post-acquisition. There is nothing pre-acquisition, everything is post-acquisition. Okay, everything is post-acquisition. Star Limited paid a dividend of 10% for the year ended 31st March of 20. The dividend was correctly accounted for by Moon Limited. So, Star Limited paid dividend at 10% and the dividend was correctly accounted for. Okay. Moon Limited sold goods of 17,50,000 to Star Limited at a profit of 20% on selling price. Inventory of Star Limited includes goods of 7 lakhs received from Moon Limited. Now, for this transaction, there are three adjustments actually. Moon sold goods of 17,50,000. This is included in the sales of Moon. So, you will reduce from that. This is also included in the purchases of Star. From there also you will reduce. Then, inventory includes 7 lakhs received from Moon. My closing inventory is overvalued. So, what will I do? I will reduce the profit element from the closing inventory. So, 3 adjustments will be done. Selling and distribution expenses of Star Limited include 2,12,500 paid to Moon Limited as brokerage fees. So, Star Limited selling and expenses include 2,12,500 received, paid to Moon. So, Moon also has shown in income. Where did Moon show in its income? Moon has showed brokerage fees as its income. Okay. So, you will reduce from selling and distribution here and income from here. Every adjustment you have to do it twice. General administrative expenses of Moon Limited include 280 paid to Star Limited as consultancy fee. So, 2,80,000. Here it is consultancy income. Here it is general administrative expenses. Reduced from general administrative expenses and reduced from consultancy fees. Star used some resources of Moon and they paid 50,000 to royalty. So, this also you have to reduce. Prepare consolidated statement of P&L and its subsidiary for the year ended 31st March as per Schedule 3. So, what do we need to do? First, sales and other operating revenues. Sales and other operating revenues is given. Now, here we have to remove intercompany sales. Then, they paid some brokerage fees, then some consultancy fees and then some royalty. So, these income has to be reduced. Correspondingly, those expenses also needs to be removed. So, when you calculate revenue, Moon, Star, total. Intercompany sales, you will reduce. Consultancy fees, you will reduce. Royalty, you will reduce. Brokerage, you will reduce. Clear? Okay. Then, Star Limited paid dividend of 10% for the year ended 31st March of 20. The dividend was correctly accounted for by Moon Limited. Who paid? Star paid. To whom? Moon. Now, normally in the standalone financial statement, where will Moon account for the dividend? Moon will account for the dividend as a part of dividend income. Now, this dividend income includes dividend received from Star Limited. So, this 1680 includes dividend received from Star Limited that we have to eliminate. So, we will take 1680, 437 total dividend income. 1680, 437, they have not deducted it, but it is incorrect. You have to say less dividend received from Star. Now, because it is not pre-acquisition dividend, acquisition happened in September 18. They paid for the year ended 31st March of 20. So, this is post-acquisition dividend only. They would have included in dividend income. So, from that we have to reduce. How much is our stake? Our stake is 50,000 into 100 and they paid 10%. So 50,000 into 100 is 50 lakhs. 10% of that is, oh my god, so this cannot be 50,000 into 10, 5 lakhs. This 5 lakh has to be reduced from dividend. So here when you do this adjustment, you will say minus 5 lakhs. Sir, where will be the second impact? This 5 lakhs, you will add it to the reserves of the subsidiary. See, ultimately the balance sheet will not be, mismatched, balance sheet will tally. You will reduce from income of holding, which means you are reducing the reserves of holding, and this 5 lakhs you will add to reserves of subsidiary because it is post acquisition dividend. Then other non-operating income, you can take it as it is. Then material purchased, Moon Star minus 17 lakh 50,000 minus 17 lakh 50,000, which is intercompany sales. This has to be reduced. So 1750 here has to be reduced from 1750 here. Sales reduced, purchase reduced. Okay. Direct expenses take as it is, you will get the total number. Then changes in inventory. Now whenever you see changes in inventory, this is basically your opening stock minus closing stock. What is the inventory? Inventory, opening inventory is 42 lakhs. Closing inventory is 8575. So there is an increase in inventory. There is an increase in inventory. So what you will do? You will say increase in inventory. You will put it as a negative number because if I'm increasing, it is actually kind of an income for me. For examination purpose, just do opening minus closing. So if you do opening minus closing here, you get this number. Opening minus closing 4375 and 752. By that number, my inventory has increased. But the inventory has a profit element which I need to reduce. So that I will reduce separately. How will I reduce? They have said 20% on selling price. So directly multiply 20% and then you will reduce it. Then employee benefit expenses, take as it is. Finance cost, take as it is. Depreciation, take as it is. Then general administrative expenses. You have consultancy fee 2,80,000, royalty 50,000 and selling and distribution adjustment 2,12,500. How will we check this? Here if you see 280, 50, 212. So when you are reducing from revenue, corresponding expenses should be reduced from the other party. So here you have reduced, same way here you will reduce the intercompany number. So you will put the final number outside. Okay. So by plotting that, you have revenue, other income, cost of material purchased, changes in inventory after adjustment, employee benefit, finance, depreciation, other expense, total tax expense, and profit before tax, which is 1 crore 10 lakhs 10,000. Okay, any doubt here in this question? Okay, no doubt. Let's look at this one. Profit and loss accounts of A Limited and its subsidiary B Limited for the year ended 31st March are given below. You have income, increase in inventory. So this actually is not an income. You have to show it as a negative number in the expenses side, and all other expenses are given. Provision for tax, dividend paid, balance of profit. A following information is given. A sold goods of 180 to B at cost plus 25%. 1/6 of goods were still lying in inventory. So 180 lakhs, first what you will do, that 180 lakhs, first thing you will reduce from the sales. Second thing, inventory. It is cost plus 25%. So 180 into 25 by 125 into 1/6. This profit element should be reduced from changes in inventory. So when you do changes in inventory, this number, you will reduce the unrealized profit. That is one thing you have to keep in mind. That is one thing you have to keep in mind. Okay. Then cost of material, again intercompany purchases will remove. Any consultancy fees etc. received, that you will remove. Okay. Then dividend paid is 225. Dividend paid is 225. Now always be mindful that this dividend, the holding company would have accounted for somewhere in other income. Now here what they have said it is assumed that dividend adjustment has not been done in sales and other income of A Limited. That is, dividend is not included in other income. This is not a proper assumption. Assumption has to be that dividend is included. So what we will do? Our share of dividend we will remove from sales and other income. So whatever dividend that subsidiary company has paid to the holding company, that will be removed. Okay. So with this, consolidated P&L is also done, right? Very less chances. So what happens is, generally after 4 or 5 attempts, one attempt they'll simply dump in the consolidated P&L question. But for MCQs, you may expect that there would be some or the other kind of consolidated P&L also being tested. Okay. Now what we'll do is we'll start off with the next 2 standards on consolidation, that is Accounting Standard 23 and Accounting Standard 27. Now, when we talk about Accounting Standard 23, this deals with something called as associates in consolidated financial statement. Associates in consolidated financial statement. Now, when you have associates in consolidated financial statement, how do we account for it? Now, please understand, if there are 2 companies, A and B, A can hold multiple levels or multiple percentage of stakes in subsidiary. For example, A can hold 10%, A can hold 20%, A can hold 50%, A can hold 75%, or also maybe 100%. If A holds 10%, this is covered by Accounting Standard 13, which deals with accounting for investment. If it holds 20% to 50%, this is what is covered by Accounting Standard 23, associates. Okay, here the assumption is A has significant influence over B. A has significant influence over B. So when A has significant influence over B, that significant influence part is covered by Accounting Standard 23. Okay. Now, if it is, so this is 20% up to 49.99. If it is 50%, this 50% is covered by accounting for joint venture, where we say there is joint control. If there is joint control, it is covered by Accounting Standard 27. If it is greater than 50%, we treat that there is a control element, and in that control element there is a holding to subsidiary company relationship, and that is covered by Accounting Standard 21, consolidated financial statement. So up to less than 20%, you will take it as 13. 20 to 50, just less than 50, as 23. Exactly 50, joint venture. 75%, it is more than 50% control, that is holding subsidiary. Now please keep in mind, this is just an indicative number. There could be possibility that you have only 40%, but with 40% you have joint control. So if you have joint control, you will take it to Accounting Standard 27. Okay. Same way, you may have 40%, you may still have control. So that is what you have to see. But for examination purpose, this is largely what is being tested. Or look for the term significant influence, Accounting Standard 23, joint control, Accounting Standard 27, and control, Accounting Standard 21. So AS 21, this talks about control, where we take holding plus subsidiary. Accounting Standard 23, this talks about significant influence. Here we will take one method which is called the equity method, and Accounting Standard 27 talks about where you have joint ventures. Okay, here it is joint control. And when we come to joint ventures, we'll understand there can be joint operations, jointly controlled assets, and jointly controlled entities. Any of these 3 that can be possible. Now first we'll start with Accounting Standard 23. The most important thing that you need to remember is the method. Equity method. Now what is this equity method? For you to simply remember and understand, think of it like partnership accounts. Now in partnership accounts, what do we do? If you prepare a partner's account, whatever is contributed by bank, let us say capital, you will credit. By profit, you will credit. To losses, you will debit. This, for example, you can have profit or loss. If there are drawings, to bank drawings, you will debit, and then you will get the balance. This is the partners account. Now this partners account, when the partners maintain in their books. When I say when the partners maintain in their books, what am I referring to? I am referring to, let us say, this partner has mentioned something called as investment in partnership account. Now if you have investment in partnership account, they would say to bank some number. So here this will be 10,000. To P&L profit 2,000. By P&L losses 5,000. By bank 1,000. By balance, whatever is the number, 12 minus 6, 6,000. This method is called equity method. Basically, this 6,000 represents share in net assets. So when we follow equity method, we calculate something called as share in net assets or share in equity. We calculate share in net assets or share in equity. How do we calculate that number? Whatever amount we have given as investment, we will debit to the investment account. Whatever is the share of profit, we will debit it to that account. If there are losses, we will reduce it from investment. If any dividend has been received, here I am saying drawings, in companies we have dividends. If dividends have been received, we will reduce it from the investment. And this is the closing balance. Alright, this is the closing balance. Now, if this is the closing balance, this will be shown in consolidated financial statement. We will say investment balance is 6,000. In standalone financial statement, we will show as per accounting standard 13 using the cost model only. Okay, but here we will show this number in the consolidated financial statement. So whenever we have associates and the company is preparing consolidated financial statements, we will follow equity method to calculate the value of investment. We will take the equity method to calculate the value of investment. Okay, that is how it is done. Now here we have one more thing, calculation of goodwill or capital reserve. So on the date of acquisition, like we do in the case of subsidiary, what we will say, we will calculate share in net assets. Share in net assets. We will compare that with amount invested. So let us say share in net asset of this associate works out to 10,000. Amount invested, let us say 12,000. If we pay more, this balance is called goodwill. We will show 2,000 as goodwill in the, we'll show 2,000 or we'll calculate 2,000 as the goodwill, and we will disclose this goodwill. We will not show a separate line item called goodwill. We'll disclose this goodwill in the balance sheet. So in balance sheet, what you can have, investment in associate, you will have 12,000, that is the amount invested. Here you can have net assets 10,000, goodwill 2,000. So basically what we are saying, we have a share of 12,000 in the associate. In that, 10,000 represents share in net assets and 2,000 represents the goodwill component. But this goodwill will not be shown separately in the balance sheet. Like in case of consolidation, we show goodwill separately in the balance sheet, or we show capital reserve. Here capital reserve will be shown, but goodwill, intangible asset that we show in the balance sheet, that will not be shown separately. It can be shown as a part of this breakup. Okay. What if there is a capital reserve? Then in that case, what happens is investment in associate. Let us say share in net assets. Share in net asset is 10,000, amount paid is 8,000. So 2,000 is your capital reserve. So here you will say investment in associate, either you can show 8,000 by showing 10,000 net asset minus 2,000 capital reserve, or closing balance 10,000 and capital reserve on the liability side or reserve side of 2,000. These are the two different ways to present. And the balance in investment in associate, the balance is calculated as you will take the initial investment plus share in profits minus share in losses minus dividends received, you will get closing balance. Any question on this? Any questions? No questions? No. Okay. An associate is an enterprise which the investor has significant influence and which is neither a subsidiary nor a joint venture. So one thing is you need to have an associate. Second thing, you need to have significant influence. And second thing is it should not be a joint venture or subsidiary. Typically what happens is for subsidiary and joint venture you need control and joint control. For subsidiary control, for joint venture, joint control. Significant influence is the power to participate in the financial or operating policy decisions of the investee but not control over these policies, and we'll assume 20% or more whenever stake is there, unless it is proven otherwise we will say there is a significant influence. A Limited acquired, so let us see how to calculate the amount, 45% of B Limited shares on 1st of April of year 1. The price paid was 15 lakhs. So this is the cost of investment. Following are the extracts of balance sheet as on 1st of April. So we will take the date of acquisition. Paid up share capital 10 lakhs, securities premium 1 lakh, reserves and surplus 5 lakhs. So this put together 10 plus 1 11, 11 plus 5 16 lakhs. 16 lakhs is the net asset. How much did we acquire? 45%. So share in net asset is equal to 16 lakhs into 45%. So if I do 16 lakhs into 45%, 16 into 45%, it is 720. So 720000, 720000. What is the amount paid? Amount paid is 15 lakhs. Amount paid is 15 lakhs. The difference between these two is called goodwill. So 15 minus 7, 8. It is 7,80,000. That is the goodwill. So what you will do? You will calculate goodwill as 7,80,000. Now, then they said B Limited reported net profit of 3 lakhs and paid dividend of 1 lakh for the year ended 31st March of year 2. Out of this 3 lakh, we will add 45% to our investment balance. Out of this 1 lakh, we will reduce 45%. Why reduce? Because we have received the money. So what we will do while calculating, cost of investment is 15 lakhs. You can show the breakup of these two. Net assets as 7,20,000 and goodwill as 7,80,000 in the inner column. Then profit during there, our share 45%, 1,35,000, and dividend paid minus 45,000. This becomes the closing balance for consolidated financial statement. Please remember, this is for consolidated financial statement. In standalone financial statement, you will show it at 15 lakhs only. This is in the standalone, you will follow accounting standard 13. But for consolidated, in consolidated balance sheet, you will follow the equity method, which is prescribed by accounting standard 23. Very simple. If a question comes from this chapter, blindly you should be able to score 5 out of 5, or if they ask 4 marks, 4 out of 4. Okay. So this we have already done. Then what happens is, sometimes we have step acquisition. Now, step acquisition means what? Step acquisition means first we have acquired, let us say 10%, then we have acquired another 15%. So when we acquired 10%, we did not have significant influence. When we acquired 15%, we had significant influence, because 10 plus 15 makes it 25%. Or sometimes it may happen that we already have 20%, then we added 10 more percent. So what do we do when we have this multiple step acquisition? That is what we are discussing. So first case, Conversion from a passive investor to an associate in the same year. Meaning to say, earlier it was passive investor, 10% stake. Subsequently acquired 15%. So when we acquired 10%, was it an associate? It was not an associate. But what did we do? Subsequently we acquired 15%, then it became an associate. In that case, what we'll do is, for 10% we'll calculate the goodwill or capital reserve component separately. For 15% we'll calculate goodwill or capital reserve component separately and see what is the net number. Okay. Cost of investment for 10% is 1 lakh and 15% is 1,45,000. Net asset is 850 and 10 lakhs on each of these days. So what we will do, on 1st of April, what is the net asset? 8,50,000. What is our share? 85,000. What is the goodwill? 15,000. 1 lakh paid minus 85, 15,000. Then, second, when we acquired 15%, what is the net asset? Net asset is 10 lakhs. So 10 lakhs, 15% of 10 lakhs, we have 1,50,000. This is the share in net asset. What is the amount paid? Amount paid is 1,45,000. So for 1,50,000, we paid an amount of 1,45,000. So the difference actually becomes a capital reserve. So what is the net goodwill? 1,15,000 minus 10,000. This becomes, 15,000 minus 5,000, 10,000 becomes net goodwill. Are we clear? Any questions here? No. Okay. Then, conversion from a passive investor to an associate in the same year. See, accounting is the same. Accounting is the same. The calculation is also the same. A Limited acquired 10% stake of B Limited on April 1st and further 15% on October 1st of the same year. Other information is given below. Cost of investment 10%, 1 lakh, 15% 155. Net asset is also same. So basically what you will do, 850 of net asset, there you will take 10%, and on 1st of October you have 10 lakhs, here you will take 15%. But sometimes what may happen is they will say net asset on 1st of April is, let us say, 8,50,000 and profit earned during the year, full year, is equal to, let us say, 1 lakh. In this case, what you will do, this profit earned in the full year, you will split between first 6 months and next 6 months, that is 50,000 and 50,000. This 50,000 gets added to net asset on 8 lakh on 1st of April, so that you get the net assets on 1st of October. Remaining calculation is pretty same. Okay, there is no difficulty or there is no complexity in this calculation. Any questions so far? No. Okay. Then, further acquisition in the associate in the same year. Now, what does this mean? This basically means that it is already an associate. It is already an associate, and we are acquiring more stake in the associate. So, two things. One, 25% stake on April 1 is acquired. So, on this date itself, it has become an associate. Okay, on this date itself it has become an associate, and further 5% on October 1st of the same year. So 1st of April we acquired 25%, 1st of October we acquired 5%. Cost of investment for 25% is 1,50,000 and for 5% is 20,000. Net asset on 1st of April is 5 lakhs. Profit for the year 90,000, earned in the ratio 2:1 respectively. Now when did we acquire? Second set was acquired on 1st of October. Profit was earned in 2:1, means total profit 90,000. 2/3 is earned in the first part, that is 2/3 of 90,000 is 60,000, and 1/3 of 30,000 earned in the second part. Okay. On date of acquisition, very simple, you will take 25% of net asset. 5 lakhs into 25%, we get 1,25,000. 5 lakhs into 25%, we get 1,25,000. Then, against this 1,25,000, how much did we pay? we paid 1,50,000. So the share in net assets versus the amount paid, the difference 25,000 is your goodwill. The difference 25,000 is your goodwill. Okay. Then when we acquired on 1st of October, what is the net asset? Net asset is equal to 5 lakhs, that is on 1st of April. 5 lakhs, that is on 1st of April, plus 60,000. That gives me 5,60,000. That gives me 5,60,000. Clear? Okay. Now this 5,60,000, how much did we acquire? We acquired 5% additional stake. So 5,60,000 into 5%. 5,60,000 into 5%. What is the number? Five lakh 60 into 5%. 28,000. 5,60,000 into 5%, 28,000. How much did we pay? We paid 20,000. We paid only 20,000. So 28,000 is the net asset minus 25,000 minus 20,000 what we paid. 8,000 is your capital reserve. 8,000 is the capital reserve. Now here they have done a very complicated way to calculate. Basically 3,000 here and 5,000 here. This 3 plus 5 makes it 8,000. You can directly do the same number. Okay. Now what is the cost of investment? The cost of investment is 1,50,000 on 1st of April. 1,50,000 on 1st of April. That is my cost of investment. Alright. Then what is my second investment value? Second investment value is 20,000. So what we will do? 1,50,000 plus 20,000. 1,50,000 plus 20,000. 1,50,000 plus 20,000. So total is 1,70,000. Then add share in profit. What is the share in profit? Share in profit is 25% for first 6 months. That is 60,000. So share in profit, I am writing here down below. 1,50,000 is the first investment. 20,000 is the second investment. Total is 1,70,000. Add share in profit. 25% of 60,000. That is first 6 months. 30% of 30,000. So 25% of 60,000 is 15,000, and 30% of 30,000 is 9,000. So why 30%? Because from 1st of October our share is 30%. Up to 1st of October our share is only 25%. So 170 plus 15 plus 9, 1,70,000 plus 15,000 plus 9,000. If we do, we get 1,94,000. This is the carrying amount of investment as far as the investment partners are concerned. Okay. Then from this 1,94,000 we have breakup. If you see, we had initial goodwill of 25,000 and capital reserve of 8,000. Okay. Any questions? Okay. Let's look at this illustration. A Limited acquired 40% share in B Limited on 1st of April of year 1 for 10 lakhs. On that date, B Limited had 1 lakh equity shares of 10 each, fully paid, and accumulated profits of 2 lakhs. During the year 1-2, B Limited suffered a loss of 10 lakhs. During the year 2-3, loss of 12,50,000, and during the year 3-4, again a loss of 5 lakhs. Show the extract of consolidated balance sheet of A Limited on all the 4 dates recording the above events. So what happened? 40% share on 1st of April for 10 lakhs. So our investment accounting, when we do investment, what you do, the investment value is how much? Investment value is 10 lakhs. So opening investment is 10 lakhs. Okay. Opening investment is 10 lakhs. Now what did we get? 40% of share capital. So share capital is 1 lakh into 10. 10 lakhs. Accumulated profits of 2 lakhs. Total is 12 lakhs. We get 40% share. 12 lakhs into 40%, 4 lakh 80,000. 4 lakh 80,000, what we invested? 10 lakhs. So balance is goodwill. So the breakup is share of net assets and goodwill. These two number, total amount is 10 lakhs. Total amount is 10 lakhs. During the year 1 to first year, B Limited suffered a loss of 10 lakhs. B Limited suffered a loss of 10 lakhs. Now, if we suffered a lot of 10 lakhs, what is our share? Our share is 4 lakhs. This 4 lakhs you will reduce from the investment. Now think of it. This 10 lakhs has net asset of 4 lakh 80,000 and goodwill of 5 lakh 20,000. Okay. Now net assets of 4 lakh 80,000, you have lost 4 lakhs. So this now becomes 80,000. Goodwill continues at 5 lakh 20,000. So total is 6 lakhs. So this is the total minus loss 4 lakhs. Carrying amount of investment is 6 lakhs. In that, goodwill component is 520 and net assets component is 80,000. Okay. Then in the third year, the loss of 12 lakh 50,000 is incurred. Now 12 lakh 50,000 into 40% means how much? 12 lakh 50,000 into 40%, if we do, it is 5 lakhs. There is a loss of 5 lakhs. Now that 5 lakhs we will reduce from this 6 lakhs. So 6 lakhs minus 5 lakhs, we get 1 lakh. Now what was our breakup? 80,000 and 5 lakh 20,000. Now I have to reduce 5 lakhs. I can reduce only 80,000 here from net asset. So this becomes 0. Balance 4 lakh 20,000 I will reduce from goodwill portion. It becomes 1 lakh. This is only for presentation purpose. In the balance sheet, you will not show goodwill separately. So 1 lakh is the goodwill number which is left. So final value is 1 lakh. In the third year, there is again a loss of 5 lakhs. In the third year, there is again a loss of 5 lakhs. This loss of 5 lakhs, our share is 2 lakhs, but our balance is only 1 lakh. So we will write off 1 lakh. Carrying amount of investment will become 0. You will not make it negative. You will show it as 0 only. Okay. Now here our loss is 2 lakhs. We can write off only 1 lakh. So carrying amount is 0. What about the balance 1 lakh? Whenever the company makes profit, first we will offset the balance amount. Only then we will start recognizing the share in net assets. Is it clear? Then sometimes we have intercompany sales. So what we will do is, whatever is the unrealized profit in inventory multiplied by share, we will reduce. Now what is the meaning of this? Say for example, 10,000 is total unrealized profit. Our share is 40%. So we will reduce 4,000. We will reduce 4,000 from the profit of the associates. We will reduce 4,000 from the profits of the associate. Basically, our share of profit, whatever is there, that we will reduce. Now there are two scenarios possible. One is whoever is the holding company sells to associate, or associates sells to holding company. If holding company sells to associate, who made the profit? Holding company made the profit. So holding company will reduce 4,000 from profit, and investment in associate, they will say minus 4,000. So why minus 4,000? Because holding company is showing closing asset at a higher value. It actually has to be lower. So we will remove it from the investment in associate, because profits will be lower, investment in associate will be lower. If associate sold to holding company, then I will remove from inventory, because holding company is having that inventory. So we'll remove from inventory, and we'll remove from consolidated P&L or the consolidated reserves. Sir, in the first case, when holding sold to associate, why are we not reducing from inventory? We are not reducing from inventory because when we are doing the accounting, we don't show inventory of associate in our consolidated balance sheet. We only show investment value. So that is why we are removing from investment. Whereas when associate sells to the holding company is showing the inventory, so we'll reduce from the inventory and we'll reduce from the P&L only to the extent of our share. Is that correct? Is that clear? Okay. So now we'll take a 5-minute break, and then we'll start with joint venture after the break. Now we'll start with the third part of the consolidation, which is Accounting Standard 27, that deals with financial reporting of interest in joint ventures, right? Now, when we talk about joint ventures, we need to understand that what is joint venture and what are the types of joint venture that we generally come across. So whenever we say joint venture or JV in short forms, joint venture basically means, you are able to see the screen, right? Joint venture basically means there is some kind of joint. Now, when I say joint control, when I say control, we talk about holding and subsidiary. One entity controls the other entity. That is what is a control. But when we talk about joint control, two or more entities, they jointly control either an entity or an operation or asset. So, for example, let us say, two of you or three of you friends, you decided to set up some kind of stall in one of the, let us say, some kind of fair or mela that keeps on happening. Okay, there what you thought, three of you will carry out an activity where you will get, let us say, some food items, you'll prepare the food items and you'll put up a stall there. That falls in the category of jointly controlled operations. You are controlling the operations without buying any asset together and without having a separate entity. Just three of you came up, you said, okay, one of you will buy, another one will prepare, third one will take care of selling. All three of you will carry out the operations, and finally you will share the profit. Now, when we talk about joint controlled operations, one important thing is there is no separate entity generally, no separate entity. And when I say joint control, all three of you should agree. All three of you should agree that yes, we'll do this thing or we'll not do this thing. So that is when we have a jointly controlled operation. Now, sometimes what happens is, out of three, let us say we are three of us, A, B, and C. A has 40% say, B also has 40% say, C has only 20% say. A has 40%, B has 40%, C has only 20% voting rights. And we need a special resolution to pass anything. Now, what is special resolution? Special resolution is 75%. Special resolution is 75%. Now, can A and C come together and take any decision? If A and C come together, you will have 40% and 20%, only 60%. So A and C coming together, you cannot have a separate decision. A and C cannot take any decision. B and C also cannot take decision. Who can take decision? Only A plus B. So we will say A and B are jointly controlling the operation or the entity. C is not required. Sir, so how will C account for it? 20% significant influence, they will account as per Accounting Standard 23. And A and B will account as per Accounting Standard 27. Okay, so that is what is a jointly controlled operation. So what is joint control asset? Say two of you decided to buy a car and run it, okay, and operate it. So that car which is jointly owned is called jointly controlled asset. So then what is jointly controlled entity? You come together and you start a new entity altogether. Okay, you come together and you start a new entity altogether. That is normally what we understand as joint venture. Okay, these are the three categories. Now, what is accounting? As far as jointly controlled operations are concerned, each venturer or operator, you can call it, accounts for its own transaction. Each venturer will account for its own transaction. They were not bothered about what the other party is doing. My part, what am I doing? That is what I will account for. Okay. So say for example, A and B, two of the parties, they came together for an operation. A carried out purchases of 10,000. B did the sales of 15,000. Now, if you prepare the P&L account of the joint venture, purchases 10,000, sales 15,000, you have profit of 5,000. Say for a moment, this profit has to be equally split 2,500, 2,500. Now, how will A account for it? A would say, A will prepare something called as, you can have a joint venture account or joint venture with B account or B account, whatever name you call it. A would say, I have spent 10,000 for the joint venture. To bank, 10,000. Did I collect anything on behalf of joint venture? No. What should I get from the joint venture? 2,500 of profit. This profit I will credit to P&L, and because joint venture has to pay me, I would say to P&L 2,500. What will B do? In B's book, B will have their own JV account, JV with A. B has collected 15,000. So B would say, buy bank 15,000. How much is the profit share? To P&L 2,500. Now here, he will receive 12,500. B will pay to bank 12,500, and like this the accounts gets tallied. Okay, that is when it is a jointly controlled operation. Now, what about, sir, jointly controlled asset? In jointly controlled asset, if you have purchased an asset with someone, let us say worth 5 lakhs, you will split into 2,50,000, 2,50,000. To the extent of your control, you will record in your respective books. Okay. The last one is joint venture. I'll come to that subsequently after we look at some questions on the JCO part. A joint venture is a contractual arrangement whereby two or more parties undertake an economic activity which is subject to joint control. So you have two or more parties, there is some economic activity, they have joint control, and there is an agreement. Joint control is a contractually agreed sharing of control over an economic activity. We said jointly controlled operation, asset and entity. Under jointly controlled operation, there is no separate entity. There is no separate entity. How will you do? Each venturer has their own business. There is no separate entity. All venturers are creating their own assets. I will buy my asset, you buy your asset. All of us will do like that. Each venturer will record only his own transaction without any separate set of books maintained for the joint venture business. So I will maintain my transaction. You maintain your transactions. Then we use our assets. We meet our liabilities ourselves. We only will make the settlement and all of that. Right. Finally, the income earned on the joint venture is shared as per the contractual agreement. Okay. Now, here if you see, Mr. A, B, and C entered into a joint venture to purchase a land, construct, and sell flats. Mr. A purchased land for 60 lakhs on 1st of January, and for the purpose, he took a loan from the bank at 8%, 50 lakhs. He also paid registering fees of 60,000 on the same day. B supplied the materials 4,50,000. He purchased material 5 lakhs for the joint venture. It's actually a jointly controlled operation. C met all other expenses of advertising, labor, and other expenses, which is 9 lakhs. On 30th June, each of the venturer agreed to take away one flat, each to be valued at 10 lakhs, and rest were sold as follows. Mr. A sold 40 lakhs, B sold for 20 lakhs, C for 10 lakhs. Loan was repaid on the same day by Mr. A along with interest, and net proceeds were shared equally. Now, when you have this type of question, first thing that you have to do is you have to prepare draft P&L account. You don't call it consolidated. It's not the right way. You will say draft joint venture P&L account. Draft P&L account means what? For all the venturers, all the expenses, all the income, as if you are preparing the P&L account of the operation. It is draft. It is not maintained by anybody. It is not maintained in any of the books. So that is what you will do. First thing. Okay. Now, once you have done that, what will you do? All the expenses you will debit, all the income you will credit. Expenses like land purchase, registration fees paid, materials incurred, any other expenses, interest that is paid, interest on loan. So that is your expenses. Okay. So who purchased the land? Mr. A. He paid, you'll make a breakup. Then sale. Whatever is individually sold, you will take it, and they have agreed to take one flat each at 10 lakhs. So that also you will credit to P&L, because taking away is also like sale only. Once you do all of that, you get the profit. Total sale minus total of all these expenses you get profit of 18 lakh. This will be shared equally by each of the partners. Okay, this is prepared on a rough sheet or a draft basis. Then what will happen? A will maintain joint venture account. When I say A is maintaining joint venture account, what A will do is any expenses that A has incurred on behalf of the joint venture, you will debit to the joint venture. Any income you have collected on behalf of the joint venture, you will credit to the joint venture. So, for example, purchase of land, 50 lakhs. It is in the books of A. Now, A has taken loan, and A has purchased the land. Okay. Now, A will not say land account to bank. You will not do. Instead of land, you will say joint venture account debit because I have purchased it for the joint venture to bank. We have taken loan of 50 lakhs and we have paid through bank 10 lakhs. That is what you will do. So 50 plus 10, that is debited. Then registration fees paid 60,000, bank interest paid 2 lakhs. These are all the expenses. What is the income that you will credit? Means you have already collected on behalf of the joint venture. So sale of flat, building taken over. This is what you will do. And you have to receive profit of 630 from the JV. So profit will be posted this side, loss will be posted on the credit side. Balancing number you will receive from other parties. How much will receive? Immediately, no need to plot it. You prepare same way joint venture account of B and joint venture account of C. Whatever is the balancing figure, they have paid of 470 and 1420. 470 and 1420, the balances will add. Simple when it comes to jointly controlled operation. Now, when it comes to jointly controlled asset, again, no entity, common control. Venturer shows only their share of asset and total income earned by them along with the total expense incurred by them. So, whatever is their share, that is what they will show. Whatever is their share, that is what they will show in terms of asset. If at all there is any share of income or expenses, then whatever is their share of income and their share of expenses, that is what they will record in their books. A Limited, B Limited and C Limited decided to jointly construct a pipeline to transport the gas from one place to another that was manufactured by them. For the purpose, following expenditure was incurred. Buildings 12 lakhs at 5 to be depreciated at 5%, pipeline 60 lakhs at 15%, computers 33 lakhs at 40%, various vehicles 9 lakhs at 20%. They also decided to equally bear the total expenditure incurred on the maintenance of the pipeline, that is 6 lakhs. You are required to show the consolidated balance sheet and the extract of statement of P&L and the balance sheet of each venture. The first thing is this is not a consolidated balance sheet. We don't have a terminology like consolidated balance sheet. They're constructing a pipeline. To transport the gas. So we are creating an asset. Okay. Now, how we will work out is because we have incurred, now for example, here we have incurred 12 lakhs of cost and depreciation should be at 5%. So as far as the asset is concerned, 12 lakhs minus 5%, if I do, I get 11 lakh 40,000. This is the joint controlled asset. This joint controlled asset will be shared by A, B, and C in their respective financial statement. Same way, plant and machinery, each party will separately own. Each party will separately own. Vehicles also, each party will separately own. Separately own means for the purpose of the books of accounts, we will show it separately. For the purpose of the books of accounts, we will show it separately. So, what did A Limited record? A Limited in the P&L will record their depreciation expense of all these assets and pipeline is 6 lakhs is the cost and they have decided equally to bear the expenses. So 2 lakhs of expenses will be borne by who? Will be borne by A Limited. Same way in the balance sheet they will show the non-property plant and equipment 23 lakhs 80,000 based on land share, land and building. So because it is building, it is being depreciated. Plant and machinery, computers, vehicles. So what is basically happening? Each party is taking their share of asset and accordingly they are charging their share of depreciation in their books. Right? Okay. Then this 2 lakhs of expenses, that is their share of expenses. That is what they are recording in their books. Now, if you compare this with jointly controlled operation, in jointly controlled operation, you did not show expenses and all separately like this in the books. You just said, I have a joint venture. For joint venture, I have incurred so much of expenses. For joint venture, I have earned so much of income. Net amount what I have to receive, that is what you maintain. Whereas, when it comes to JCA, What is your asset share? What is your income share? What is your expenses share? All of that you will record in your respective books. Same way we will do. Same way we will do. It is nothing complicated. It is simply that we are splitting the asset between each of the parties. The most important part is the jointly controlled entities. Now, when we have jointly controlled entities, what you have to understand is if at all there is a question on jointly controlled entity, treat it as consolidation question with some percentage consolidation. For example, let us say 50% consolidation. Means what? How do we do it? Whenever we did consolidation, holding and subsidiary, we took 100% of assets, 100% of liabilities. But when it comes to jointly controlled entities, we will take only 50% of asset, that is our share. So what we will do, whatever is our share in the joint venture, our share we will pick it up and we'll add it to our assets. Same way, liabilities 50%. We will also calculate goodwill or capital reserve and show that in the balance sheet like we do for subsidiary. But assets addition, liabilities addition will be only to the extent of our share, and there is no minority interest. We don't have any minority interest when it is a jointly controlled entity. That is the only difference between a subsidiary and a jointly controlled entity accounting. Then when it comes to P&L, in P&L also you will take your share of profit, income, expenses. In case, for example, when we had the subsidiary thing, we took 100% of profit. But here you will take only your income, your expenses, your profit share. A Limited, a UK-based company, entered into a joint venture with B Limited in India, wherein B Limited will import the goods manufactured by A Limited on account of joint venture and sell them in India. They agreed to share expenses and revenues in the ratio of 5:4, whereas profits are distributed equally. A Limited invested 49% of capital, but has equal share in all assets and is equally liable for all the liabilities of the joint venture. Following is the trial balance of joint venture. Now, what they are saying here, when they're saying they have entered into a joint venture and they have contributed 49% of capital, but they have equal share in assets and equal share in all the liabilities, which means what? It is a joint venture, and then you have to split the assets, liabilities accordingly and incorporate that in the books. Purchase is given, expense, sales, PPE, current assets, unsecured loan, current liabilities, capital is given. You are required to prepare the consolidated financial statements. Okay. Now, again, this in true sense is not a consolidated financial statement. They are basically preparing the financial statement of the joint venture. We are preparing financial statement of the joint venture, the separate entity. Now, for the separate entity, what is the sales? 13,05,000. 13,05,000. What is the expenses? 9 lakhs and 3,06,000. 9 lakhs and 3,06,000. Then closing inventory is 1 lakh. Opening inventory was 0. So closing inventory is higher. Show as a negative expense number. So your profit is 1,99,000. In the balance sheet, they have agreed to share 49% and 51%. That is how you have to split. Now, how will we split that? So they have not given the number. So we'll do a back working of that. Okay. As far as purchases, expenses and all are concerned, how will the split be? Split will be based on they have equal share in assets and equal share in all the liabilities of the joint venture, whereas A Limited and B Limited agreed to share the expenses and revenues in the ratio of 5:4 respectively. So what we will do, if there is an expense of 9 lakhs, this you will split as 5 lakhs for A and 4 lakhs for B. 5 lakhs for A, 4 lakhs for B. Same way other expense, purchase and all of that, he will do the split. So purchases 5 and 4, sales 5:4. Expenses 5:4. All of that 5:4. But closing inventory, this is equal. Right? Then reserves and surplus, profits are distributed equally. Typically, this does not happen in real life. Okay, it is very difficult to say that expenses and revenues you will share in the ratio of 5:4, whereas profits will be distributed equally. That doesn't work. But because they have given in this question, we'll do it that way. Profit is to be distributed equally. What is the profit? 1,99,000. So profit of 1,99,000 is distributed equally. Liabilities distributed equally, long-term borrowings distributed equally, property, plant and equipment equally, inventories equally, other current assets equally. Now this equity share capital that you get, is the balancing number. It is the balancing number. This balancing number, you will give 49% to A and 51% to B. Okay, that is how you will solve in the question. So here you will have in the share capital, the balancing number 49 to A and balance to B. Now this is important. After this, I will also share with you one combined question including A, B and C. It's holding subsidiary and all of that. Please have a look at it once. That is one thing that you need to practice. Okay. A Limited entered into a joint venture with B Limited on 1:1 basis, and a new company C Limited was formed for the same purpose. And the following is the balance sheet of all the three companies: 10 lakhs, share capital, reserves, loans, current liabilities, PP, JV, current assets. So this is investment in JV. This is the JV. Okay, this is very important when it comes to examination. Prepare the balance sheet of A and B under proportionate consolidation method. I will do for A Limited. For B Limited, you can practice it for your own. Okay. Now, when I say proportionate consolidation of A Limited, it is A Limited plus JV C Limited. How much? Our share. How much? Our share. Now, how to compute? You will do as if you are doing consolidation. So first, you will calculate goodwill or capital reserve, if any. Okay. Then, what is the share? 1:1. So you will take 50%, not share capital, 50% of your assets, loans, current liabilities, property, plant and equipment, and current assets. That you will add to A Limited. Okay. And whatever is the post-acquisition share in the reserves and all of that, that also you will add. So how we will do is, first we'll calculate goodwill or capital reserve. Here, I don't think there is any goodwill or capital reserve, but let us say share capital, 10 lakhs, reserves, loans, all of that is given. So how much is the investment? Investment is 2,50,000. Investment is 2,50,000. What is the share capital? 5 lakhs. What is the share capital? 5 lakhs. What is the share in net asset? Share in net asset is share in share capital, 2,50,000. And this entire reserves and surplus is post. So we'll not consider that. So only thing that we'll consider is 2,50,000. 2,50,000 is share in net asset. 2,50,000 is investment. Is there goodwill? No goodwill. Is there capital reserve? No capital reserve. Okay. Then how do we prepare consolidated balance sheet of A? You will take share capital of A. You will take only share capital of A. In reserves and surplus, you will take A fully and you will take 50% of 12 lakhs, which is 6 lakhs. So 18 plus 6, 24. Non-current liabilities, loan, 3 lakhs plus 1 lakh, 4. Current liabilities, 4 lakhs plus 50,000, 4 lakh 50,000. Property, plant and equipment, 30 lakh 50 plus 50% of this number. And current assets, 2 lakhs of this plus 50% of this number, you get the total. Sir, what if there was goodwill? For example, just for argument's sake, share capital is formed at, it is at 5 lakhs. We invested 3 lakhs. Investment is 3 lakhs. But share capital, for whatever reasons, our share is only 2,50,000 net asset. So this becomes 50,000. So how is it possible that in a new company we invest 3 lakhs but only get 2,50,000 of share? I'm not talking about a new company. I'm talking about an existing company. I've invested in an existing company of 3 lakhs. Net asset is only 2,50,000. So the value is how much? 50,000. Or I have agreed with the other venturer that I will give you 3 lakhs, but my share capital, what I will get is only 2,50,000. There can be multiple arrangements. Okay. So this comes out to how much? 50,000 of goodwill. So what you will do? From investment, you will remove 3 lakhs. You will remove 3 lakhs and the net asset automatically will get knocked off there. Balance 50,000 you will show under non-current asset as intangible asset, 50,000 goodwill, like you do in the case of subsidiary. For this, I'll be sharing one link in the group. I'll also add the solution in the your courses. You can get access from that, so that you can go through it. Good question. You should practice it because it may come in the examination or it may come as a part of MCQs. While preparing notes, own company, C Limited, 50% share, you have to prepare it. B Limited, you can do it for homework. Okay, then you have intercompany transactions. Intercompany transactions as in transaction between the holding company and the joint venture. That also you will eliminate accordingly. Any questions? Any questions as far as joint venture is concerned? Okay, so one thing in the examination, what you should do is not be scared. When I'm saying not being scared is, a lot of time what happens is the questions are framed in a way, or lengthy questions are given way which causes us concern. How to solve. Don't be scared because of that. Okay, so now we'll do one combined question. One more combined question. What I told is I'll share it as a link. You can have a look at it. It's a very good question. Okay, that gives you a lot of clarity, and it's not a very long question. It's not a very long question. Give you a good amount of clarity. Now let us have a look at this one. On 1st of February, this is as per September 24 paper, where they have not asked the combined thing, but they have asked the calculations. On 1st of February 24, Best Limited acquired 80% equity shares capital of Cool Limited for 1480. So Best has acquired Cool. This becomes a subsidiary. On 31st March of 24, end of the year, Best acquired 25% of equity shares of Good Limited for 380. So this becomes an associate. The following are the balances extracted from the books of Best Limited, Cool Limited, and Good Limited on 31st March of 24. Equity shares of 100 each, fully paid 30, 20, 10. Securities premium 2,20,000. 9% debentures 630 and 240. General reserve 269, 84, 120. All these numbers are given. P&L balance, investment, PPE, current assets, trade payable, including bills payable, sales, raw material consumed, wages, and production expenses. P&L account of Cool Limited showed a credit balance of 30,000 on 1st of April 23. When did we acquire? We acquired on 1st of February of 24. When did this happen? This balance they have given on 1st of April of 23. Now, why did they give as on 1st of April of 23? So that you can calculate profit for the year. You can calculate profit for the year, and when you calculate profit for the year, you can split it between pre and post. Acquisition happened on which date? 1st of February. So you have 10 months of pre, 2 months of post. General reserve balance is brought forward from the previous year. So it is the same number continuing. So general reserve is same number. P&L, we have a different balance on 30,000. So basically 30 became 270. So we can say 2,40,000 is post acquisition. For the year. Out of 240, for 10 months, that is 2 lakhs is pre-acquisition, 40,000 is post acquisition. Okay. Then investments 1750, 610. Then adjustment we are looking at. On 31st March, all bills payable in Cool Limited balance sheet were acceptance in favor of Best Limited. However, on the date, Best Limited held only 3 lakhs of these acceptance, rest having been endorsed. What is the meaning of this? Cool Limited balance sheet. Who is Cool? Cool is subsidiary. Bills payable. All bills payable. They're saying all bills payable were in favor of Best, but Best had only 30,000 in hand. 3 lakhs in hand. Means Best in its current asset has bills receivable from Cool Limited to the extent of 3 lakhs. Where is balance? Balance is with the creditor or bank, what they have said. It is gone to the bank. So for intercompany adjustment, only 3 lakhs is relevant. Best Limited had purchased goods costing 5 lakhs from Cool Limited on 1st of June of 23. Now, please understand, this purchase happened before the acquisition. This purchase happened before the acquisition. If the purchase happened before the acquisition, We will not adjust in the revenues because this is pre-acquisition. But on the date of acquisition, entire goods remain unsold at the end of the financial year. On the date of acquisition, best purchased goods costing 5 lakhs from Cool. So best purchased from Cool. Whereas on the date of acquisition, these goods are not yet sold. Towards the end also, these goods have not yet been sold. Best Limited is preparing consolidated financial statements for 31st March of 24. You are required to calculate trade payable, consolidated current asset and all of those things. Now, what is trade payable consolidated? Trade payable consolidated is only trade payable of 380 plus 4,10,000. Associate you will not consider. And if it was a joint venture, you will consider only to the extent of percentage. I am repeating once again. Best, you will take 100%. Cool, you will take 100%. Good, you will not take anything because here you will follow equity method. So 380 plus 410 minus 3 lakhs. 380 plus 410 minus 3 lakhs, 4,90,000. Simple, 1 mark as it is. You will. Okay. Then current assets consolidated. What do we do here? Current asset consolidated is 965 plus 560. 965 plus 560 minus 3 lakhs because that is held as bills receivable. Then inventory is there. See, transaction happened before, but when we are consolidating, we'll take the cost only. When we are consolidating, we'll take the cost only. So that adjustment also needs to be done. Best, Cool, minus intercompany ownings minus unrealized profit. How much is unrealized profit? Goods costing 5 lakhs at 650. So unrealized profit is 1,50,000. This unrealized profit has to be eliminated. So you will eliminate the unrealized profit from the stock. You will eliminate unrealized profit from the stock and show the net amount in consolidated. Sir, do we eliminate the minority share and all of that? See, this is 150. This 150 is profit lying in stock. In consolidated balance sheet, we show 100% stock. So 100% will be eliminated from the inventory. Then next is minority interest. Now, as far as minority interest is concerned, how much did they acquire? They acquired 80%. So when we say minority interest, for quicker calculation, equity shares 20 lakhs of this 20%, securities premium of this 20%, general reserve of this 20%, 2,70,000 of this 20%. Directly you can do. Sir, are we required to do analysis of profit pre and post? If you want to do pre and post analysis, that also can be done. Okay, if you want to do directly, that also can be done, because as far as minority interest is concerned, all of these they are entitled to at 20% subject to adjustment. Subject to adjustments. Okay. Then share capital, securities premium, general reserve, profit and loss balance, and all of that. Now, one thing that you have to understand is, though the transaction happened before, when we are consolidating the entity, what did we say? There is unrealized profit on inventory 1,50,000 which we have to eliminate. Who sold this? Subsidiary sold to holding. When subsidiary sells to holding company, if I am eliminating the profit, I have to eliminate from the profit of subsidiary. So if I'm eliminating from profit of subsidiary, minority interest also is there. So what we will do, we'll reduce that unrealized profit stock of 20%. So if I'm taking P&L balance fully, minus unrealized profit, 1,20,000. Of this, 20% is their share, 24,000. This is the adjustment. You get the closing balance of minority. Okay. Then goodwill capital reserve on the acquisition of Cool Limited's share. Goodwill capital reserve on acquisition of Cool Limited share. Now, if you look at Cool Limited share, the acquired cost of investment is 14,80,000. Cost of investment is 14,80,000, and rest all we have to do the normal calculation. Okay. Balance is 30,000 opening balance. So purchase consideration 14,80,000 we know. Then we have share of in the share capital 80% of our net asset, securities premium in our net asset, general reserve net asset, opening balance 30,000, that is also pre-acquisition. Then 270 is a closing balance, minus 30,000 was opening balance, we earned 240 during the period. Who earned? Subsidiary earned 240 during the period. This 240 you will divide between 10 months and 2 months. You will divide between 10 months and 2 months. 10 months will become 2 lakhs. Of this 2 lakhs, our share is 80%, so 1,60,000. Our share is 80%, so 1,60,000. Or if this is slightly confusing for you, you can do your normal analysis of profit where you will take pre-acquisition 30,000, the opening balance of 30,000 as it is goes in pre-acquisition. Then for the year profit is 2,40,000. This 2,40,000 pre is 2 lakhs. Post is 40,000. So what you will do? 30 plus 2 lakhs. 2,30,000 is pre. This multiplied by 80%. So 2,30,000 into 80%, you get 1,84,000, which is nothing but 1,60,000 here and 24 here. So you can do it in the normal tabular format that we have been doing. That is also possible. Then there is profit stock, which is now coming back to the entity, which is unrealized. 1,20,000, this you will remove. So it is down to 40. It's down to 40 because 120 is the unrealized profit. The subsidiary sold to the holding company. But sir, it sold before. We know it sold before, but when we are consolidating, that profit is not yet realized by the group. If the profit was realized by the group, no need of this adjustment. Because the profit is not realized by the group, we will do this adjustment. Okay. Then you get the capital reserve number. Please practice this once in the format that you have been using for the normal, problems. Then for good limited, goodwill or capital reserve on the acquisition of good limited, very simple. Investment made 380. What is our share on date of acquisition? We acquired on 31st of March. So as on 31st of March, 10 lakhs. This is debenture. General reserve 1,20,000. P&L balance 50. So 10 lakhs plus 120 plus 50. 10 lakhs plus 120 plus 50. Of this, 25% difference is goodwill. Profit and loss account consolidated. You will take 100% of profit and loss of the holding plus the post-acquisition share in the subsidiary minus any adjustment that has happened. Now, please understand here, when we are doing the consolidated P&L, inventory adjustment you will not do here. So why not here? Because we have not done that on the date of acquisition. We have done that on the date of acquisition. So directly you will take Best Limited balance and 80% of post-acquisition of Cool Limited, 32,000. Okay. Then general reserve consolidated, 100% of the general reserve consolidated, 100% here. This 84 will not take because this is pre-acquisition. We'll take only post-acquisition. Revenue from operations. So when it comes to revenue from operations, please understand, we will take sales of this plus this and will not do intercompany adjustment because that happened before acquisition. So 56 plus 38 directly we will take 56 plus 38 for 2 months, not for full year. Okay. Then cost of raw material consumed, same thing you will take for 2 months. 14 marks question. Even if you goofed up in 1 or 2 adjustments, this was a question where 10 marks would have been scored easily. Are we comfortable with this, or is there any doubt? Any specific question you have in this? All clear? Okay, great.